by the CFTC, Treasury Secretary Besant. There are rules ready to go, and they're either going to go with clarity with the legislature behind them, or they're going to go without clarity with the power of the executive branch. So I think the most important thing is decision on clarity one way or the other, and the rules will get made.
All right, Fong Bing.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
If you understand why gold is good, that's why you would want to be in Bitcoin.
Is it that the governments always just want inflation because they want to just keep stealing from you and pay for wars, or is it now baked into the system and then that's what makes it certain?
I think you can kill inflation. Theoretically, it's possible. Politically, impossible.
It might make sense, instead of paying off my 30-year mortgage early, buying Bitcoin instead, and thereby performing a speculative attack on the currency. A lot of Bitcoiners are against debt, though.
At a certain point, governments will turn around and say, you can't borrow to buy Bitcoin. If you hold Bitcoin, you can't borrow. You can't have everybody win at the casino. If everybody wins at the casino goes out of business.
It's a trade-off. It's a trade-off, right?
And it's a bad trade-off. We don't have to go to the world where everybody's using their own node on-chain for all transactions in order for us to kill inflation. And that's what matters for me.
A lot of people today make it seem like Bitcoin is the end, but is Bitcoin just one of the means to the end? All right, Saif, first thing, good to see you. Thanks for joining me for this conversation. I'm excited to have it.
My pleasure. Thank you for having me.
There are millions of people who have read your books. Of course, myself, one of them. Michael Saylor, famously, of course, one of them. And there's millions of people that are investing who did what they were seemingly told to do with their money. Worked hard, saved money, bought a house, invested in stocks, the retirement account, all of those things. But somehow they still feel like they're falling behind, and they don't understand why. So give us an understanding of what's going on with their money that's causing them to look like they're winning, but they're not.
Yeah, I think the basic problem ultimately comes down to the fact that fiat money just loses value over time. You're constantly declining in the purchasing power, and so you are essentially having to run to stay where you are. You're running on a treadmill and you're wondering why you're not getting anywhere, because it's a treadmill. It's taking you backward. So if you just hold on to money, that money loses its value, probably something like 7% in terms of the devaluation. If you think of it in terms of the increase in the supply, which I think is the best way of thinking of it, because the supply is increasing, and so the purchasing power is being diluted. Now, granted, the increase in the supply of economic goods and services is itself going to make these goods more valuable, and it's going to increase the purchasing power of your money. Sorry, it's going to make the goods less valuable and make your money more valuable. But that then just means that that's going to reduce the amount of value that is being taken away from your money, but it's still money that's being taken away from you. And so the way out of that is to find a way to run faster than the treadmill. And that just makes life so much harder for everybody. It's you're not supposed to be going through life with a treadmill underneath you that makes it harder for you to get anywhere. It's like you're running on an escalator or on a travelator, whatever they call it, all through your life. Yeah. But, you know, in a world in which we have good money, money that's not made to rob you, money that is not designed to make you poor, in that kind of world, you'll see that you just able to maintain the purchasing power that you obtain by just holding the money. You don't need to be a hedge fund manager in order to increase your wealth over time. You just hold on to your money and it increases in value over time. And that's normal and natural because money is selected in the market precisely for being the thing that loses value the least or gains value over time, because it is the thing that increases the least in supply. Historically, gold is money precisely because it increases in supply the least of all commodities. So you hold on to gold, the supply of gold increases at the lowest rate, but the supply of apples and oranges and cars and houses and all the things that you want goes up faster than gold. So the purchasing power of gold goes up. And that means that you just need to hold on to the gold and you can transfer the purchasing power into the future and get a little bit of a bonus for your delaying gratification. But when the money is made to rob you, when the money is constantly losing value, well, then you're in a different situation. And now it becomes much harder for you to beat that. It becomes much harder for you to keep the value of the money that you've already earned. That's why I like to think that with fiat, you have to earn your money twice. So you could go out there, work a real job as a doctor, an engineer, an athlete, a musician, whatever it is, and you've earned the money and you're trying to focus on your craft, you're trying to get better at it, but you need to be a part-time hedge fund manager. You need to figure out what to do with your money on the side in order to make sure that you can keep the wealth that you've already earned.
Yeah, and I mean, you can't do both of those very well. So now you're doing both of them pretty poorly, which is a massive brain drain on the world. Imagine how much more, how much better technology we could have, or more breakthroughs in medicine, et cetera. But I think what you're saying is that don't save in dollars, and I think at this point most people probably get that. Like most people know, as to the point that you're making, you have to be this hedge fund manager on the side, and so I don't have time, so let me just use the Wall Street industrial complex to be my hedge fund manager, and they can siphon off the majority of the rewards for me. So I think at this point, most people know they don't save in dollars. I think Saylor, there was like that meme that he said, we have a word for them, we call them poor, I think he said. But so people don't know that. So then it becomes okay, then what do I put my money into to hold that purchasing power for me? So then is it sort of like then we have to look for the next best thing? And so then is it gold? So you mentioned gold's been that store of value for all time. Of course, obviously Bitcoin, you wrote the Bitcoin standard. So is it then we need to find something that then holds that purchasing power, but it's really all about a means to a potential end and not the end itself? Meaning a lot of people today make it seem like Bitcoin is the end, but is Bitcoin just one of the means to the end?
Yeah, I mean, money is a medium of exchange. The whole point of money is that you exchange it for other things. That's why everybody wants money, because of the things that you can exchange the money for. But the point is that you want your money to be good at this job of exchanging, and in order to be good at it, it has to hold on to its value over time. And the problem is that wherever else you take your wealth away from the money, it's still going to suffer from the same problem that the money has, which is that there's going to be somebody out there who's going to figure out a way to make more of it. So historically, people move away from gold, and then the next thing they get into was the saving account. Well, you put your money into the saving account, you beat inflation because the interest rate that you get is higher than the inflation. But that stopped working because, well, the whole point of inflation is to finance government. So if everybody can beat inflation, that defeats the purpose. You can't have everybody beat the inflation game, just like you can't have everybody win at the casino. If everybody wins at the casino goes out of business. They can't keep running it as a charity. And I guess that's a good way of thinking about your central bank. It's not out there to make you rich. It has to, the purpose is to take your purchasing power and give it to the government so that the government can murder foreigners and enrich cronies and do all kinds of crazy things that they do.
Yeah.
So if everybody finds a way out of this, if everybody can beat it, then whatever it is that they beat, whatever it is that they used to beat, that is going to be provided in an increased quantity eventually until it stops working. So that happens with savings accounts. Interest rates then go down on saving accounts, and then you can't beat inflation anymore. So then people move to government bonds, and that also same thing happens. People move to government bonds, and it's like moving into an easy money. It's like people moving into copper or moving into something that's easy to make. If everybody tomorrow decides that they wanted to use copper as money, it's just going to mean that copper miners are going to make enormous quantities of copper and dump them on the market and bring the price of copper down. And the same thing happens to the government bonds. When everybody uses government bonds to save, that gives governments far more credit than their fiscal and monetary situation should entitle them to get. And then that, of course, is the mother of all malinvestments. The governments end up spending tons of money on all kinds of stupid and crazy and criminal things. And they eventually, one way or the other, they're going to destroy the value of the wealth that's stored in the bonds, either because the value of the money in which they repay the bonds goes down, or because they default, or both. So it stops working with government bonds. And, now we're in a kind of golden period for stocks, particularly stock indices. They seem to be working fine as a way out of this. But that one, too, I would say is kind of risky, because if everybody in the world can just buy Apple and Nvidia stock or buy the NASDAQ or an S&P, then again, that's going to mean that the inflation game doesn't work. And how do you keep the thing going? So at some point, I think there may be a crash in the market, because monetary policy can't continue to be accommodating, because if it continues to be accommodating, it just leads to more and more bubbles, and it leads to more and more inflation to essentially beat these, more and more inflation to finance government and to allow government to finance itself. So I think what you want is something that cannot be inflated, whose supply cannot be increased. And that just gives us two candidates, really, realistically: gold and Bitcoin. And gold has a supply that grows roughly at around 1.5% to 2% per year, and has always been like that, just because of the chemistry of gold. Gold doesn't ruin, so we're constantly accumulating all of our gold supply over the years and decades. And that then results in the fact that even as we get better at making gold, we're just piling on to an ever-increasing pile. And so our production goes up every year because we get better, roughly. A little, more or less, it goes up every year. And the stockpiles that we have are also growing. So the rate of the new production to the existing stockpiles, or the stock-to-flow ratio, the rate of production stays constant, or the stock-to-flow ratio also stays constant. So, but it stays around 1.5% to 2%. And I think the problem with gold is that ultimately the world has already got a lot of gold. And so everybody, well, not everybody, but I mean, there's about $25-30 trillion of gold held around the world by people in the form of jewelry or in the form of monetary gold. And that just means that it's already highly monetized, but it can't truly function as a form of money because it doesn't have a banking system. And in a modern world, you need money to travel quickly. You need to be able to spend your money as fast as your goods travel. And so this became a problem for gold in the 19th century because of trains and ships and cars moving things around quickly. And it meant you couldn't just keep moving gold back and forth between partners. So you had to rely on bank credit, and bank credit effectively became the money. And that led to the growth of the banking malinvestment boom of the last century and the central banking malinvestment boom of the last century. But Bitcoin really is the solution as far as I'm concerned, and I continue to stick to it, no matter what happens and after every crash. I still think Bitcoin is the one that really delivers on this because Bitcoin, A, has a lower supply growth rate than gold, so it grows at a lower rate than gold supply. And two, which might even be more important, you can actually have clearance of Bitcoin internationally very quickly without having to go through government institutions and without having to go through highly centralized central banks. And so Bitcoin is far faster than gold. And therefore you can continue to have a free market and you can continue to use gold as money, even as its value grows and even as the demand for it grows. You still don't need to have one central bank to manage all the clearance, as was the case with gold.
Hey, look, over 130 million in Bitcoin was just stolen from cold card hardware wallets. This is the largest hardware wallet hack in history. And the sad part about this is that the victims, they did everything right. They had real devices, they kept it all offline, but there was a small firmware update that let hackers access their Bitcoin wallets and completely drain them. Now, don't blame self-custody. Self-custody isn't a problem. It's single key custody. That's the problem, when you have a single point of failure. So here's what I actually do. I've been doing this for years because I was always afraid something like this could happen. Now, this happened before Unchained ever sponsored me. I was a customer, and it's my Bitcoin, it's my parents, it's my sister, my family's Bitcoin, and it all sits in what we call multi-sig wallets. And I do that with Unchained Capital. Instead of one wallet and having one key, there's 3 keys on 3 different devices, 3 different places from 3 different companies, okay? I hold 2 in different locations, Unchained holds 1, and it takes 2 of those wallets to move anything, which means like this exact hack right now that got everybody drained, 1 compromised key won't be enough. It probably sounds complicated. Don't worry. Unchained has a concierge service where they can walk you through the entire thing one-on-one, and they're gonna build out your vault. They'll test your recovery. They'll have an expert review everything, making sure you don't have any problems. If you wanna do the same thing I do, the same thing I have my family do, go to unchained.com/MarkMoss. Again, unchained.com/MarkMoss. Set it up right. Do it once. Don't get vulnerable to a hack like this. Wow, you gave us a lot. You gave us a lot to dig into. So there's a bunch of questions that we have. That's a good thesis. I want to double click into quite a few of these things. So number one, I want to get into, you said that governments need the inflation to continue to pay for all the things that they're doing, the cronyism and the wars, et cetera. I want to talk about that. What's actually baked into that. You said, you mentioned the bonds being part of that, liquidation of government debt. We'll talk about that. You talked about how gold and Bitcoin can't really be increased, and you talked about the stock to flow of gold. I want to get into that, especially in the world of abundant money printing, but also abundance of AI. Bitcoin being a better medium of exchange than gold, the SOV versus MOE. And then I want to talk about Bitcoin delivering on some of these things that you're talking about in light of what's happening today with hacks on self-custody. And then Wall Street financialization. So let's talk about a couple of those things. Well, let's start with at the top. So you had talked about, the governments won't allow inflation to stop because they want to continue to pay for the cronyism that they have and the wars they have and things like that. And certainly I agree with that in one instance, but I want to ask from a different angle because, I like to say that the 2 things in life that are certain, well, the saying goes that death and taxes are certain. And I say money printing is also certain at this point too, so there's like a third thing. I think of it more from like a function of the debt-based monetary system that always has to grow, because in a debt-based monetary system, money's created through debt issuance, and then the debt becomes the collateral for more debt. And so then it kind of creates this Ponzi scheme where like it has to continue to grow. So is it that the governments always just want inflation because they want to just keep stealing from you and pay for wars? Or is it now baked into the system and it's a function of the system, and then that's what makes it certain? So if we got good leaders that don't want to cause wars anymore, does it end? Or again, is it baked into the system that it always has to continue to inflate like that?
I think it's just the way that democracy works makes it inevitable almost that you're going to have to get a bad leader. Because if you have 2 people competing against each other in an election and one of them says, I'm going to run the money printer, well, he's not going to say he's going to run the money printer, but he's going to say, I'm going to deliver all kinds of
promise
things.
You all this free stuff, yeah.
Yeah, I'm going to give you, pink unicorns for all the girls and Superman powers for all the boys and free hospitals and all kinds of nice things. You're going to beat the opposition that says, no, I'm sorry, I can't give you unicorns for all the girls and Superman powers for all the boys. I don't do that. So it's just baked into the system that you are going to have to make ridiculous promises in order to win. And if you don't make your ridiculous promises, you don't win. And if you want to win, you have to make the promises and you have to live up to them. And so it's just, once you place the ability to create money in the hands of government, Mises used to say this, it's just they cannot resist the temptation. It will be used. That temptation will be acted upon because it's providing so much benefit to the people in power, and the cost is so spread out over such a long-term horizon. effectively in a democracy, you're in power for 4 years. And during those 4 years, you can do all kinds of amazing things for you and for your family and for your, tribe, clan, cronies, whatever it is. You can get them all kinds of things by externalizing the costs onto generations of people that are going to have to be paying off the debt and the consequences of the inflation over decades.
Yeah.
So democracy is really just ideally suited for this system. And I think the few places where you see governments that can, up to a point, resist that temptation is places where they don't have a money printer. So I think part of the reason that maybe El Salvador is successful is that they've gotten rid of the money printer. They don't have a money printer. And so they have not had inflation since, I think it was 2001 when they went off that. There's not been a government in El Salvador that has been able to run the money printer effectively. I mean, of course, they can borrow and they can do all kinds of other things, but not having the ability to create money massively hamstrings their ability to fund the present at the expense of the future. And I think also monarchies can be better at resisting this. And if you look historically, you'll find that monarchies do a generally better job of maintaining the value of their currencies because monarchies are far more long-termist in their approach. So as a king, you're not just in power for 4 years and then you are going to be out of power and you're not thinking about how much can I maximize? How can I maximize the amount of input that I get in those 4 years in order to be able to finance myself over those 4 years at the expense of society? Because you're thinking, I'm going to be in power for the rest of my life and then my child and then their child and their child and their child, hopefully for centuries. So you don't want to milk the country dry over 4 years. You want to keep the country healthy so that you and your descendants can milk it for centuries from now.
Yeah.
And that, I think, ends up being better for the people because it provides people with essentially a government that is incentive aligned, that has incentives aligned with them. Because the people the people want their children to be prosperous 100 years from now and their descendants. And the king also wants your children to be prosperous 100 years from now because he's planning on taking money from you in 100 years from now. He wants his descendants to be taxing your descendants. So you take care of it. It's a caretaker government that has a long-term vision, whereas in the democratic system, in political science, they call it the roving bandit versus the stationary bandit. If you're a stationary bandit, you have a long-term relationship with the people that you're farming effectively. And so you want them to be prosperous. You want the cows to get fat so you can get a lot of milk and beef out of them. Whereas if you're a roving bandit, you're just passing by a farm at some point and you are raping and pillaging as quickly as you can because you're going to move on to something else. And you don't care about what this one particular farm is going to look like in decades or centuries.
I mean, certainly the way you break that down and said the incentives are completely different. And as Munger would say, the incentives equal the outcome, right? So it makes sense. I would agree with you on the Democratic side. And unfortunately, when the voting populace, the majority of them can now vote to take money from the top. I mean, then we have this disincentive, as we said. And then you said, the politicians come in to offer more free things to the voting populace, and we continue to go down that route. I would just say quickly on the, whatever you want to call it, monarchy, but autocratic, dictatorship, whatever. I mean, plenty of more recent case studies in Africa and Middle East of that not being the case, where the people have enriched themselves to billions and billions and billions of dollars while most of the people in the country are poor. But let's just stick back to and those aren't, to your point, those aren't necessarily monarchies, but I do agree with you on the Democratic side. And so we have these problems in the developed world in the United States. But let me just ask the question again. If we could, and I agree we can't, but if we could get leaders who don't come in offering these things, is it, from an economic standpoint, is it this debt-based system? Have we built up so much leverage in the system? Has that debt continued to become more collateral where that has to continue mechanically regardless of politics? Or are you saying, no, it's 100% choice?
I mean, ultimately it is political. If you made me king of the world and I was perfectly long-term focused, and I really, really cared, and I was incorruptible. And I'm saying it's a big if. I'm not claiming to be all of those things, but if you got a radical Austrian hard money guy like me, and I was not tempted by power, and I was not tempted by money, and I was not tempted by the political process, I think you can kill inflation. Theoretically, you can do it. And I think the notion that the system needs to continue to produce more debt is it's a little bit like the alcoholic who tells you, no, you don't understand. I really need to take this drink right now because withdrawal will kill me. Yeah, well, of course, because you drank yesterday and you drank the day before and you drink every day. But, if you choose to snap out of it, you can snap out of it and you can stop. And yeah, it might suck a little bit, but then eventually you can just stop it. And so, you can just turn basically all the credit money out there, turn it into physical money. And I think that's the sort of simple way of doing it. Friedrich Hayek proposed something like this in the 1930s, which is take all of the money that is outstanding out there, which is essentially mostly credit obligations. So if you look at the money supply, it's just the majority of money is debt, only some of the money is physical form. But figure out what the total money supply is in terms of debt, and then print physical papers that match the entire supply of the money, and then break the printer. And then, look at the money supply today. What is it today? I think it's about 22 trillion M2 or whatever it is. And then just literally print 22 trillion, not in the figurative sense, but actually $22 trillion in the physical sense, and then give them to all the people that are holding all of that money. And then they have that money, and then just say, no more central bank, no more money printing. And if you want to try things like fractional reserve banking, you're on your own. You've got all of the dollars that you've produced so far as a bank, because when you're a bank, you're producing dollars every time you engage in lending. Mm-hmm. So you've got all the dollars that you produced under an inflationary monetary system, under an inflationary central bank. You've gotten them in physical form, and this isn't going to be inflationary because these dollars already exist.
Right.
And now, if you're going to try and you just converted them from digital dollars into physical dollars. But now, if you're going to be trying to engage in credit creation without physical dollars backing them, then you are going to end up one day with a liquidity crisis and without a central bank to bail you out because there's no more money printing. There are no printers. We broke the printers. Then you're going to run out of money, and eventually the money supply will contract and go back to the supply of the physical money that is there. Mm-hmm. So theoretically, it's possible. Politically, impossible.
Yeah. I never actually heard it walked through like that before, because I always think about like the transition. Like, okay, I mean, that's a perfect world, but like, how do you get from here to there? And like, how much pain is caused for getting from there? But I think sort of what you proposed, like I said, I never really heard it walk through like that. It sort of creates that buffer where it's like, okay, no, let's not crash anything. Here we are, but we're frozen in time now. And now let's see what we can do from here. But to your point, yeah, good job politically. Unfortunately, humans only act when there's enough pain, right? I believe in the chiropractor, but man, like I probably don't go unless I'm like, and my back's really hurting, for example, right? Now, when you talk about it like that, and you talked about the difference of gold and Bitcoin. By the way, you have the new book. I haven't read it yet. The Gold Standard. Go ahead and hold that up. We'll talk about that. But what I think was so amazing about the Bitcoin standard is you started with gold. I mean, and actually you went back even before gold, right? And so you really talked about what money is, all the different forms of money that we've had, leading into the gold standard, and then of course the gold standard to the Bitcoin standard. The gold standard, you talked about gold also being a good medium exchange. So let's talk about that for a minute, because as I was telling you before we started recording, every year I go speak at one of the largest gold conferences in North America. It's been like 5 years in a row. And every year I keep saying, if you would have listened to me a year ago, this year they had the last laugh. It was in January. And of course, gold was, I forget where it was at that point, but $5,000. Bitcoin, of course, is drawn down quite a bit. And so the gold people have their last laugh there. Talk us about
not the last laugh. There's still going to be a lot more laughing to come.
Certainly not the last. Certainly not the last. They had the laugh at the event.
The
latest, yeah. And of course, I pull out a chart and go, well, hang on. And actually, let me ask you this question, because the chart that I pulled up for them at the gold conference, it's doomers. It's all doomers. Everyone there they're selling gold because the dollar's going to die, the system's going to crash, we're going to go back to this barter system, and you better have gold. And like that's the whole sales pitch on gold. Where I think Bitcoin has a hopeful future, and it works with AI, and it works with AI agents, and like the world doesn't have to die for Bitcoin to succeed. And I think that's a big piece, and you can comment on that. But back to the point that I made, I said, so your whole thing is that inflation is going to rage, the dollar is going to die, and gold's going to protect you. Then how come from 2020 to 2024, and I showed the chart, when we had record inflation and record money printing, gold went nowhere for 4 years? And I showed the chart, right? And then 2024, the gold price started taking off after inflation's already come back down. I mean, what would you say to that? And we can get into the gold standard. Hey, do you know that instead of sending your tax money to the IRS, you could buy Bitcoin miners with it instead? Here's exactly how I do it. You see, mining hardware is 5-year property. And under bonus depreciation, which was dying, it was down to about 40% last year, and it was going to zero, the One Big Beautiful bill has reinstalled it back to 100% and made it permanent. So I can deduct the full cost of the machines in year 1. Now look, billionaires have run this play for over 40 years. They do it with real estate, oil and gas, rail cars, and it's the same provision in the code, but the only difference is what you own when it's done. So you see, I own the machines that produce the Bitcoin, but I don't have to do the work. Blockware does all that. Blockware sources the hardware, they secure the power, they run the sites, and my tax team, they structure it so the deduction actually works. You see, that's how I turn my taxes into Bitcoin. So if you want to try and do the same thing, check out Blockware today. To get started, just go to blockwaresolutions.com/market disruptors. Again, blockwaresolutions.com/market disruptors.
Yeah, and I think that's a great point. I think, it's interesting. For many years, decades now, gold bugs have been talking about $5,000 gold, $5,000 gold. We're going to get $5,000 gold. And when that happens, the whole world will be in a Mad Max situation, as they keep calling it. You need to stock up on golden bullets, and you need to stock up on canned foods because the dollar's going to fall apart. Everything's going to fall apart. And here we are with $5,000 on gold, and it seems to be as consequential as the price of copper or nickel going up. It's just another commodity, and its price has gone up. It has not brought about the monetary apocalypse that they have been fantasizing about for decades now. And I think that is quite telling. And it's very interesting because really, if you look at it, the gold's performed really well over the last couple of years, but, this is when gold bugs start sounding like shitcoiners looking at the short range charts.
Yeah.
Let's drag out the chart and zoom out and be big boys who are able to think in the long term. And in the long term, gold has basically barely kept up with inflation since 1971, since the world went off the gold standard. Gold's recent run has basically brought it back to keep up with the rate of growth in the money supply over the past 50, 55 years or so. So it went up in the 1970s, and then it had a bear market from 1980 to about 2000 and bottomed around 2000. And then it went up from 2000 to 2011 and then had a bull market of 10 years and then another bear market of 10 years, 10, 12 years. Or it was basically from 2011 to 2023, I think, until it reclaimed, or 2022, something like that. So really, it's barely caught up, and as an asset to hold, it's entirely reliant on when you bought. So you may have gotten lucky and bought in 2000 and started saving in gold in 2000, then it worked out up until 2010, and then it sucked up until 2020, 2023 or so, and then made up for it in 2024. So it's a little bit like a shitcoin pump and dump in that it's not really going up reliably, and you need to be able to time it, and you need to be able to, understand how the dev team is working and all of that. But I think this is really the issue that ultimately, as long as people cannot use gold as money, except with people that are within arm's reach, then you are just going to have a bad time trying to make this into the world's money. It's just not going to work as the world's money. This is the way that I see it, because people are going to stack up more gold. People will stock up more gold. They will buy more gold. But when they need money, they need to sell the gold and acquire money, because you're not dealing with gold day to day. And the fees on going in and out of gold are enormous, and you have to pay capital gains tax on gold. And if you want to pay gold to somebody abroad, you can't do it. There are no gold banks. It's illegal to set up a bank that runs on gold. And governments have done this since 1971, and the IMF ensures that you do that. So gold's monetary role is essentially neutered by governments. And
It's a
they
store of
succeed in
value
that
only, right? It can only be used as a store of value, you're saying?
Exactly. And
Yeah.
so therefore, you have to buy in and out of it every time, and there are fees and there are conversions, and this is just essentially kills its liquidity, kills its ability to be saleable. Its saleability is very low effectively. So you have to buy in and out for it. So it still has the fact that the supply doesn't grow much, but it can't be used as money, and it has the other it has the other major drawdown, which is that the supply is already enormous and the market capitalization is already enormous. People already have tons of gold. People already have literally thousands of tons of gold, and people already have trillions of dollars worth of gold in their pockets. And they can't have much more because they can't really easily hold large balances in gold because they need to continuously go in and out of gold.
Yeah.
And this is where I think the difference is with Bitcoin. And this is why I would say the Bitcoiner vision is more positive about this than the gold bug vision, because the Bitcoiner vision is powered by number go up. We've got number go up technology that means it's, first of all, it's attractive for you as an individual because it's got so much more room for growth. First, because again, you can use it as money because it travels very quickly and you don't have to rely on banks and central banks and government institutions in order for you to use it as money. But secondly, it's only about $1.5 trillion currently in market capitalization, or $1.2 trillion. So it's less than 5% of gold's market capitalization. And so it's got a long way to run, even if it becomes just half of gold, which I think I don't see as reasonable. I think it's a better money than gold objectively. But even if it becomes half of gold, that's still another 10x from here. There's still enough appreciation for it to go up 10%. So even if your case for thinking about Bitcoin is that it's half as good as gold and it's going to become half the money that gold is, that's still a 10x from here. It's not easy to imagine a 10x with gold. If there's a 10x in gold, that means we have to have the entire world run on a gold-based monetary system.
Or the money supply has to go up by 10x.
Yeah, well, when I say 10x, I mean in terms of purchasing power, not in terms of the dollar price. But in terms of purchasing power, if gold's purchasing power is going to go up 10x, it's going to have to eat all of the government currencies, all of government bonds, basically.
Yeah.
And that's just not going to easily happen because the governments are not going to let you use their banks. They're not going to let you use banks that use gold because they want to milk you with inflation. Whereas with Bitcoin, it can go up 10x and still be half of gold. So there's an incentive for people to buy in. And I think, as you said, in the Bitcoin Standard, I talk a lot about gold, and a lot of gold bugs love the book because it makes a very good case for gold. A lot of them tell me this is a case that is better than what the gold bugs make. And really, you listen to some of the gold bugs, they talk about it being shiny and about the nice noise that it makes when it falls on the ground. And I think, excuse the humble brag, but I think my case for gold is a lot more compelling because it's mathematical, historical, and still, I end the book by being essentially bearish gold and saying, if you understand why gold is good, that's why you would want to be in Bitcoin. And I think to go back to the point on why gold is different, I discussed this in the Fiat Standard, and this I think is something that not a lot of people talk about in terms of Bitcoin and how Bitcoin can continue to grow as money, which is that with gold, there's not much room for the value of gold to go up. So this means that as individuals, there's just not that much of an incentive to hold large balances in gold because you don't expect it to go up as much. But also, it means that it can't really replace the current existing fiat system effectively because it's already very big. Whereas with Bitcoin, essentially Bitcoin can continue to grow and it's monetizing as a hard asset. And the fact that it continues to grow essentially offers people a way out of the collapse of fiat and the decline in the value of fiat and the constant cycles of business, of boom and bust that fiat has. So essentially, as fiat continues to devalue, you could say that the fiat economy becomes less and less important. And in a world in which we only have fiat, that's a problem because you're constantly devaluing the fiat. But in a world in which we have in a world in which we have Bitcoin, well, people start building cash balances in Bitcoin, and these go up. And so as your fiat assets are declining, your Bitcoin assets are going up. But more importantly, most people don't have fiat assets. Most people don't hold fiat money. They hold fiat debt.
Right.
And as the fiat gets devalued, the debt is essentially devalued, and so the debt is wiped out. And so really it offers us a way out of this that is hopeful rather than the gold doomer scenario where all the governments are going to fall apart, all the banks are going to fall apart, we're all going to be scrapping over canned food, and then we'll have to rebuild civilization from scratch with a gold basis. Well, with Bitcoin, we don't have to do that. We're just building it as an alternative system, and we are going to continue to grow as the alternative system continues to become less and less. The Bitcoin system continues to become more and more valuable while the fiat system becomes less and less valuable and then shrinks into irrelevance without it having to collapse.
So let's talk about that transition. So you have the opportunity. Bitcoin's going to continue to grow. It's small. You can move into it today. You can exit the fiat system. But you talked about fiat debt. Most people aren't holding fiat assets. They're holding fiat debt. And we talked earlier that the governments, for whatever reason, the debt-based monetary system, but more probably politically, will continue to increase the money supply. And when you think about, you also said that they have to have inflation because they want to pay for all their things. The IMF and the BIS put out white papers in 2015 called the liquidation of government debt, where basically they do financial repression. So the amount they pay on the debt has to be less than the rate of inflation so they can liquidate that debt. And so I think about it like in this like macro loop where the governments are going to continue to run bigger and bigger deficits, which means they need more and more debt. In order to afford more and more debt, they have to push rates lower and lower and lower. Inflation is destroying that debt, right? So if I take a 30-year mortgage, in America we get those things. Warren Buffett calls it the best financial engineering piece that the government has given us. But my payment on a 30-year mortgage in 30 years from now is a fraction of it would be today, right? So the inflation is destroying the debt, which the government likes their debt being destroyed, right? So if they need more deficit spending to pay for their programs that they promise their voters, that means they have to take on more debt. They have to artificially push the rates down low to afford the debt. And then we have Bitcoin growing inside of there. So then it might make sense, instead of paying off my 30-year mortgage early, I'm buying Bitcoin instead and thereby performing a speculative attack on the currency. So I could borrow in the cheap dollars that the government gives us, knowing that they're going to continue to destroy the value of those dollars through inflation and keep rates low because they need them low, and then go into a stronger currency like Bitcoin and go up. It seems so simple. Obviously, there's volatility through that process. I see you sort of nod your head like, yeah, that makes sense. We know like Hugo Stinnes in Germany did that in Weimar Republic, and of course, it's been done a million times since. And it seems to be the strategy that, I guess, strategy is deploying. So you shake your head sort of in agreement. What do you think about that strategy just generally overall, using cheap debt that's guaranteed to be destroyed through inflation, locked at lower rates than inflation will be or debasement will be, and being able to get into a life raft like Bitcoin to go back up? A lot of Bitcoiners are against debt, though.
Yeah, well, I mean, it is essentially accelerating the process that I'm talking about. In a sense, it is accelerating it because it is devaluing the dollar more, because the more debt you take on, the more dollars are created, and therefore the dollar is devalued, and then you use that debt to buy Bitcoin, you're bidding up Bitcoin, and you're increasing the market value of Bitcoin. And this is what Michael Saylor is doing. This is what a lot of Bitcoiners are doing. But it's not guaranteed that this kind of scenario will continue. It may well be the case that at a certain point, governments will turn around and say, if you're taking out debt, you can't hold Bitcoin, or if you're holding Bitcoin, you can't take on debt, or you can't buy Bitcoin with debt. So this is a relatively straightforward thing to do because debt creation is all linked to central banks and it's highly regulated. You can't just go out there and create dollars and hand them out to people. So you could get, instead of a 6102 that confiscates people's Bitcoin, you just get a law that says you can't borrow to buy Bitcoin. If you hold Bitcoin, you can't borrow. And if you borrow, you can't hold Bitcoin. So that could slow it down. But I think ultimately the process just continues. They're going to continue to make more dollars. They're not going to make more Bitcoin. Nobody's going to make more Bitcoin. And so the mathematical inevitability is that the dollars are going to devalue and the dollar debt is going to devalue. And I think this is really the winning move here is to just, as you said, you want to be on the side of the people that are in power because they are rigging the system to their advantage. And, it's a common misconception to think that rich people have a lot of money. Rich people don't have a lot of money. They have a lot of debt. They have hard assets and debt. So, if you're a billionaire, you don't have $1 billion sitting in a bank account and you don't have $1 billion sitting in your basement. You've got maybe $5 million in a bunch of bank accounts here and there, $10 million, something like that, in liquid accounts. And then everything else is hard assets. And you borrow against those hard assets. So the biggest borrowers in the world are governments and big corporations and the richest people in the world. And that system works very well for them because the system devalues the value of their debt.
Okay, so I got to tell you what I've been doing with my money lately. I moved my cash over to River, and before you ask, yes, I still pay all my bills in dollars. Everything works the same, but here's the real difference. You see, River pays me 3.3% on my cash, and they pay it in Bitcoin. So my money that was just sitting there doing nothing at all in the bank, it's now stacking Bitcoin while I sleep. And I started thinking, like, my bank takes my deposits, they loan those deposits out, they make 12, 17, 24%, and they pay me 0.04%. I mean, honestly, that's kind of a shakedown when you think about it. Now, River's FDIC insured, they use full reserve, they charge no fees. So I don't know why I didn't do this sooner.
So click the link down below and get $100 in Bitcoin just for getting started.
So obviously putting the risk disclaimers on here, everything in life has risk because everything's a trade-off in life. And certainly going and swimming in the ocean where there's waves is dangerous because people drown out there every day when they're visiting from Indiana. But especially when the waves are big. Unfortunately, we just had these amazing waves. I live in Southern California. The waves last couple weeks from hurricanes were really, really big. And everyone travels here to go surf. And then unfortunately, some people drown because they came from Indiana and they don't know how to swim. So it's risky, but you could learn how to swim and you could learn how to surf and you can learn. And the financial markets are also risky. You give your money out, counterparty risk, you may not get it back. And then you add leverage on top of it, it adds more risk. But that being said, back to sort of this financial thing, if the Cantillon, I think about it like this, like in the Bitcoin circles, we talk a lot about the Cantillon effect. And those closest to the money supply have the first advantage, right? And then those at the bottom are disadvantaged because prices have already gone up by the time they get the money. But if we think about it, at the top, they're printing the money and they're buying assets. And where does the money get printed? At the bank, right? The commercial banks print it when they give a loan. So I could also just get the loan and buy hard assets. Why do I have to be the victim at the bottom of the Cantillon effect? Why can't I join them at the top and get the newly created money to buy hard assets like they do?
Because you can't get the low interest rates that they get. They can't get the terms that they get. You can't get the long-term payment facilities. You can't get the... I mean, this is why Michael Saylor can do this and you and I cannot. We can't
But I would disagree with that because Michael Saylor's paying 12% on Stretch right now, 12%. I can go into my
now
brokerage.
He is, but he got a lot of his debt at close to 0%.
Right, which has mostly been paid off. Well, he's paying some of it off. There's very minimal debt is at the 0%. Most of it's at the 12%. I could click a button in my brokerage account right now, like while I'm even on a podcast with you, and get 5% loan right now on my loan. Right, so he's paying 12. I can get it at 5. My mortgage is at 3 right now. Rates are about 6. Whatever you want. Either way, it's less than 12, right? So I don't know. And the numbers are, it's all about the spread anyway. So anyway, I'm just curious.
Yeah, but I mean, for most people, it's not, I mean, the bigger the corporation is, usually the better, the all else equal.
the lower the interest rates that they could get. And you can get you can do this with your home because you get favorable rates on your home. So that's why it makes sense for most people to get a mortgage. You can do this on you can get 0% interest on a credit card for 12 months, which really is a way to play mini Michael Saylor for the average Joe.
But that's dangerous with a short duration. Yeah.
Yeah, but it is a short duration. That's the thing. The thing that he gets is long durations and low rates. And you may be able to secure that with your mortgage. You may be able to get it with a couple of, I don't know how your brokerage accounts works, but I'm going to guess that overall, Michael Saylor, you have to understand also the numbers are skewed now because he's had a bit of a rough time in the credit markets over the last few months, so he's paying a little bit over the odds. But I would say overall, generally, I think the big corporations can do better than you.
Sure. Of course, I would agree with that. Of course they can, right? They're borrowing much closer to the Fed rate than you and I would have to pay a spread. But it's just the strategy just overall. Like I said, so many Bitcoiners are seemingly really against debt. And I think there's a lot of the Dave Ramsey out there, pay off your debt. Debt is evil. The Bible said you're servant to the lender, et cetera. But in a debt-based system, especially considering back to this strategy of this the government's going to keep liquidating debt. They're going to keep pushing inflation. If we can lock in low debt, we can buy assets. Anyway.
Yeah, well, I definitely get the moral case for it, and I should say, I'm explaining the rationale for it. I'm not saying you should go out there and borrow because, of course, there's the downside for it, which is that you miss a couple of checks, so you lose your collateral. You are in very big trouble. That's how a lot of people end up being homeless and their lives fall apart. So this is really the truly pernicious aspect of the fiat money system is, first of all, I mentioned earlier, you got to earn your money twice. You can't just save. You have to be a part-time hedge fund manager. But also, if you're not taking on debt, then you're essentially taxed through inflation. You're losing your wealth through inflation. And if you are taking on debt, you are taking a massive risk. And in fact, it's almost a baked-in risk. People are going to have to default. They issue so much debt because there's no real money behind it, that the defaults are baked into the system. There will have to be people that will default. There will have to be people that end up on the street. That's the cost of this system. And it's just, it's a Faustian bargain. What do? Do you suffer the inflation slowly while everybody else takes on the debt and dances that dance, or do you take on the debt and end up being part of the small percentage of people that gets wiped out and has their life ruined? And on the moral case for it, I'll say this: a lot of religious and moral arguments are made against getting into debt, but you could also make the counter argument, which is that if you live in a modern economy, you're using a currency that's generated from debt, so you are part of the debt system, whether you like it or not. And if you're not taking on debt, you're subsidizing others taking on debt. So you're still playing the game, but you're just guaranteeing that you're losing.
Yeah.
But then again, are you really losing because you don't have the risk of default? You don't have the risk of getting thrown out of your house.
It's a trade-off.
It's
a trade-off. It's a trade-off, right?
And it's a bad trade-off. And in a hard money system, the trade-off would be very different. The trade-off would be you have your savings, and your savings are appreciating over time. And then that means that, and because you don't have infinite credit creation, you don't have easy money, that means houses aren't being bid up by people all the time. You don't have investors buying into houses with cheap credit, bidding up the price of the house for people to live in them. Hard money buys houses, people save, and the value of their money goes up. So it's easy for them to just buy houses in cash. And so people have their homes, they have their savings, and then if they want to take a risk, they take a risk on an investment where after they've secured their home and their savings. And then if the investment doesn't pan out, you've still got savings and you've still got a home.
Yep.
And in the fiat system, it's just we're fragilizing ourselves by borrowing against all of that stuff and then making ourselves
Sure. I mean, you're coming out with college debt before you even start making any money. You're a debt slave from day one, right? So
I know.
All those things are true. I would just say they all require trade-offs, and of course there's risk and there's risk mitigation. I want to jump into one last topic. I know we're getting kind of short on time here. So you made the case about, gold being a good store of value, but not a medium of exchange. And the problem is, since gold isn't money, every time I go in and out of money, it costs me money. And I never actually really thought about it like that. But I mean, that's such a good point, because I was thinking, well, you could have a medium exchange and then you can have a store of value. And we store our value in lots of things, homes, as we're talking about right now, and obviously stocks, equities, we talked about that already. So there's lots of things that we store our value into. I'm remodeling my home right now. I'm renting another home while we're remodeling. And I was like, I kind of like the home I'm renting. I'm like, maybe I'm just going to sell my house and just buy this one. And I actually thought I was going to do it. And then I ran the numbers on the taxes I would have to pay to move my value from one house to another. And I'm like, whoa, there's no way I can do that. Because to your point, to move the store of value, I have to pay for it. And so Bitcoin being a store of value and a medium exchange, obviously it's more saleable, as you would call it in your book. I see the advantage. In order to do that, then I really then probably need self-custody. So I want to talk about self-custody for a second, or just custody in general. Let's just talk about custody in general. Value is created by solving problems. And maybe the oldest problem in the history of the world is, how do I keep my property from being stolen from me? And Bitcoin solved that, right? On a gold standard, what do I do? How do I protect my gold, right? But with Bitcoin, we can protect it very easily. And if I want to be able to send it censorship resistant, I need to have custody to another peer-to-peer person. In the Bitcoin community, we've been rocked over the last week with a massive hack on seemingly one of the best security devices, the cold card hardware wallet. So how do you think about self-custody, or just custody in general, having someone else custody it, or I custody it myself? Strategy as far as, from small denominations to big denominations. And what do you think about just that hack and what it does to the community and the self-custody aspect?
Okay, I want to take a second and give you a quick and important word from today's sponsor, which is Rumble Wallet. Now, it's a good reminder that the money in your bank, it's not your money, it's the bank's. They owe it to you, but you don't control it. The bank does. So you have permission to access your money until you don't. Now, if you ask anybody who's ever had an account frozen, I have, you'll find out the hard way. So if you want to hold assets that you can actually own and control, then check out the Rumble Wallet. It's non-custodial, which means that you have the keys to control it. They're yours, not a bank's, not a platform's, they're your keys. So go buy Bitcoin, hold dollar-backed stable coins. You can even have digital gold backed by real gold, and you can have it all in one single wallet that you control. Now, it's pretty quick. The setup takes minutes. You can fund it with a debit card. You can fund it with credit cards, a bank account. Right now, download the Rumble Wallet and enter my code MOS10, and you're gonna get $10 in US stablecoin just for signing up. You can even use it to support creators here on Rumble, like me. So go to wallet.rumble.com/moss or scan the QR code that's on the screen right here. Of course, it's a limited time offer. If you want to see the terms that apply here, go to rumble.com/promo official rules and check it out.
I think, from the time that I wrote the Bitcoin standard, which was 9 years ago, one of the main arguments about it, other than the monetary history and the monetary argument for Bitcoin, there was an analysis of the economics of Bitcoin and the analysis of the capacity for the Bitcoin blockchain to process transactions. And I made the case that, look, this thing does about 500,000 transactions a day. You may be able to stretch it to 1 million or 2 million or whatever. But on-chain capacity is never going to be anywhere near enough to onboard the people who want hard money. And I sort of made the case that the demand for hard money is infinitely larger than the demand for Bitcoin transactions for their censorship resistance, or just the capacity of the Bitcoin blockchain to handle transactions. These are just massive orders of magnitudes different. Everybody is going to want to hold the money that is least inflationary, because nobody wants to get poor. But not everybody has a need for a transaction that is seizure resistance and permissionless and so on. And that demand is much smaller. But either way, it won't fit on the blockchain. We can't have 8 billion people buying their groceries every day on the blockchain. We can't have 8 billion nodes around the world recording everybody else's grocery purchases in order to validate them. I don't want to validate your grocery shopping. I'm very happy for you to sort it out with your local supermarket without me being involved.
Yeah.
So
This was always the case, that it was never going to be feasible that everybody's going to have on-chain Bitcoin. And that's just the way it is. And, a lot of people get upset when I say that because they have this image of Bitcoin as being money that it's going to be completely decentralized, that we're going to all have the same kind of capacities. But for me, that's, would be nice maybe if we could make it in a way that is not expensive. It would be nice in the same way that, time travel would be nice, and teleportation would be nice. I'd much rather be teleported next time I cross the Atlantic rather than getting into an airplane.
Yeah.
But realistically, I'm still going to take an airplane because teleportation isn't here, and an 8 billion person blockchain is not here, and I don't think it's coming anytime soon. So that doesn't mean that everything else is bad. That doesn't mean that we just stick to fiat. And I think the key thing is to compare the capacity for final settlement that exists between fiat, gold, and Bitcoin. And that's when really Bitcoin shines. So we don't have to go to the world where everybody's using their own node on-chain for all transactions in order for us to kill inflation. And that's what matters for me. That's the big one. That's why I'm here. That's the jackpot. This is the holy grail. We need to kill inflation. We need to kill the ability of governments to finance themselves by robbing productive people. This is the fight. This is what it's about. And for that, we don't need everybody in the world to run their own node and hold their own keys and buy their coffee on chain. We need to make the Bitcoin blockchain much more decentralized than gold, so that we don't end up in a situation where every single country has one central bank that controls all of the clearance of payments between that country and the rest of the world. That was the natural, feasible solution to the problem of scaling gold with 19th century technology. You couldn't just have a person in France ship 3 gold coins to their supplier in the US every time he wanted to trade with them. You had all of the French people settle with their local central bank, and then the central bank of France settles with the US at the end of the day or week or month or year or whatever. And so this was just the natural solution for gold to scale. And it meant essentially very expensive and very small number of international settlement transactions, where for each settlement, thousands of smaller transactions were taking place. So when at the end of the month or year, the French central bank sends gold to the US central bank, it's settling thousands, maybe millions of transactions that have taken place over a year. Well, Bitcoin allows us to do far better than that. We can still do 500,000 or 1 million transactions a day, which is an enormous thing. And then, there are ways of making it a little bit more efficient. So you get millions, essentially, of final settlement transactions every day. And that on its own, I believe, is strong enough to allow us to have the entire world use Bitcoin. We can have hundreds of thousands of full nodes that perform final settlement with one another every day or every week, and it would be far more decentralized than the central banks that have to lug physical pieces of gold around. So that really is the value proposition. For me, it's not that everybody's going to have to buy everything on chain. It's that the chain is quick and large enough that it can have a far larger number of financial transactions carried out internationally for final settlement than the fiat and gold monetary system, which is why the subtitle of my book is The Decentralized Alternative to Central Banking. That's what the Bitcoin standard really is. It's a decentralized alternative to a system in which we have 200 central banks around the world, but really, ultimately, we only really have one central bank, which is the US central bank, and everything else is essentially a second layer solution. So gold and fiat have to centralize into one central bank at the end of the day. Bitcoin, I believe, will centralized to a system of tens of thousands, maybe hundreds of thousands of central banks. And none of these central banks will have the ability to stop you from using other central banks. And none of them will have the ability to print money. And that's it. That's the jackpot. If we're just able to stop central banks from increasing the money supply, then we are we are going to make the world an infinitely better place.
I agree. We're all pushing to get that world into existence as soon as possible. I want to wrap it up with that, but walk us through the books real quick, because as I said, the Bitcoin Standard, it's the #1 recommended book. It's the book that got Michael Saylor on track that he's on. But you have the Fiat Standard, the Gold Standard. Just give us like a brief synopsis of what they are and who should read those, or how they should think about them.
Yeah, so the Fiat Standard is the sequel to the Bitcoin Standard, which looks at the questions that I couldn't really answer in the Bitcoin Standard. The most common questions that people asked me after the Bitcoin Standard, what do you think of this? What do you think of that? And particularly it's centered around the topic of understanding the interaction of Bitcoin with fiat. And it's structured in a way where I follow the same approach that I used in the Bitcoin Standard to study Bitcoin. I use that to study fiat in the Fiat Standard. So it's almost like you're an alien coming in and discovering this new civilization, or you're a computer programmer trying to abstract how fiat money works and analyze it from first principles. Just look at how it actually works. And, having looked at Bitcoin and a whole bunch of shitcoins over the years, you develop this kind of idea where there are all the important metrics that you want to understand. And in other words, Bitcoin is like the MVP, the minimum viable product of money. It's the bare bones of the essentials for money, and it works as money. So it allows you to think conceptually of what it is that makes money, and then you can apply that to thinking about fiat and see how it operates as money. So what is the equivalent of mining? How is fiat created? When you think of that, then it really shines a lot of light onto how fiat works and how the world works, because the equivalent of mining in the fiat system is credit creation. And whereas in mining in Bitcoin, you have the difficulty adjustment that controls the amount of supply that gets created. In fiat, you don't have a difficulty adjustment, so credit is created at a much faster rate than Bitcoin is created. But you do have some sort of barbaric system of difficulty adjustment, which is that if too much credit is created, then you create credit cycles which cause a crash in the money supply, and it brings the money supply down. So there's an enormous amount of insight that you can get from looking at fiat without the romance, stripping away the propaganda and looking at how it actually works. And so then using that as a mechanism for understanding how Bitcoin and fiat can interact with one another and how you would expect Bitcoin to grow over time. Now, the Gold Standard is an entirely different story. The Gold Standard is a fictional book. It's an economic fiction book. So the first third of the book is a history book of the world leading up to World War I. And then the second third of the book is like a novel of trying to understand how an alternative history could have developed where fiat money dies in 1915, World War I ends, all the central banks go out of business because they're all broke because they can't print money anymore. And the world goes back on a gold standard, but it's a decentralized gold standard. So if you'll notice in the pictures there's an aircraft here. So gold goes from, the evolution of gold is from gold coins, gold central banks, and then we have an airplane clearance system where we are a decentralized monetary system based around gold. And so essentially airplane technology in the early 20th century advances far faster than it actually did. And that allows us to have a business model that is successful across Europe and the world for clearing gold internationally. And that means that when central banks start printing money, people can take their money out of the central bank, out of their local bank, and they don't have to turn in their gold, and they can just trade with one another using these airplanes. Essentially what I was referring to in terms of Bitcoin and how Bitcoin is an alternative to gold. I do that as a thought experiment. And, the jet is called BTC. The airplane is called BTC in order to just drive the point home. I'm not very good with subtlety. So, essentially it's saying what would have happened if we had something like Bitcoin in 1915. And it would have ended World War I, and it would have completely revolutionized and changed the way in which states function, the way in which money, banking function, and the way in which technology has evolved. And then the third section is almost like an economic history book where we're looking at how the economy of the world developed over the 20th century with this new technology. And my third book, the Gold Standard is the fourth one, is just published last year. But the third book was Principles of Economics, which is an economics textbook from the Austrian perspective. And that's maybe the most complete academic book of mine, which really goes through Austrian economics, summarizes all the most important ideas in Mises and Rothbard's work, and adds a little bit of my own twist on it.
Good, good. Well, we're going to link to all those down in the show notes down below. And with that, we'll wrap it up. Saif, thanks so much. Appreciate it. Your contribution to the Bitcoin space with that book, with all the books. And thanks for taking the time.
Thank you, sir. Appreciate you having me on. Always a pleasure chatting to you, Mike.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Ladies and gentlemen, Metaplanet has announced something very, very exciting this morning. They looked at Japan, and they decided that one capital market simply does not provide enough financial weaponry for its Bitcoin accumulation campaign. So they have crossed the Pacific. They have ended up in the United States of America. They found a tiny NASDAQ-listed gaming advertising company called Super League, and then they opened the hood to Super League Enterprise. They removed several years of corporate sadness. They are stuffing 2,100 Bitcoin into the engine compartment, and they have announced that this thing is going to be renamed Superplanet. Yes, Superplanet. And the ticker is going to be SUPA, S-U-P-A, not FUPA, SUPA. Now, this company is being designed as Metaplanet's American Bitcoin Treasury platform. Superplanet gets the NASDAQ, but Metaplanet keeps Tokyo. Suddenly, Simon Garovich now has two separate entrances into the global capital casino, and both elevators go directly to the Bitcoin floor. So this is a huge deal. The announcement is saying that they are seeding this company with 2,100 Bitcoin, and they want to issue perpetual preferred stock. Digital credit is the business plan. There are lots of exciting things about this. Specifically, another thing, management. Literally, Metaplanet is going to own 95 to 96% of the float of shares. This thing is going to be convex as absolute hell. So this is very exciting stuff. I wore my Metaplanet hat yesterday. I think I actually somehow preempted this spiritually. I foresaw this coming. But things are going to become beautifully, deeply deranged. I'm talking a return profile that is going to be rocket fuel once Bitcoin actually starts to move. There's lots to cover today, so let's get into it. If you guys could do me a huge favor, like the video on YouTube, subscribe to the channel as well. If you're not subscribed, what are you doing? Hit the thumbs up below and say thank you, Daddy, for the content. I love you. I want you to type that out in the comments below. And look, if you are listening to the Bitcoin Wizard, I'm going to go out on a limb and assume that you're bullish on Bitcoin over the next 5 years. Well, what if I told you that you have a chance to buy Bitcoin or MSTR if you want to be a proper degenerate like me? You can buy either of these with full principal protection before the bull run gets here. That's correct. What if you could get more than half of the upside with full principal protection? That is exactly what my friends at Sovana are building. Every single dollar of your investment being secured by a title insured recorded lien on U.S. real estate. You split the upside with the property owner whose home equity is backing your own investment. If you've been waiting for a way to buy Bitcoin or MSTR that allows you to sleep at night, this is it. And honestly, what better time to look at this when we're sitting near the 200-week moving average? Scan the QR code to get started today. Go to sovana.io/capital right now. Have fun, kids. And you guys know how excited I get about MSTR, Metaplanet, Bitcoin treasury companies, institutional adoption of the apex asset of Bitcoin. You cannot lose sight of the fact that the most important strategic reserve is your own. I'm talking Bitcoin in 100% self-custody. And my friends at the Bitcoin Way can help you be your own bank, be a sovereign Bitcoiner, and do it the safe way. My friends at the Bitcoin Way, they lost 0 client funds during this latest cold card hack fiasco nonsense. You can go to thebitcoinway.com/Adam right now, scan the QR code on the screen, and guess what? This gets you a 100% free introductory call. That's correct, 100% free. So what do you have to lose? Take your family's financial future seriously and schedule a call with the Bitcoin Way today. I'm not asking you, I am telling you. This is a command from Daddy Wizard, kids. So this is the announcement. Metaplanet, like I said, is contributing 2,100 Bitcoin to seed the company, also 2.5 million of cash, and they are assuming strategic control of this enterprise. In return, Metaplanet gets 44,859,400 common shares, preferred stock, and a metric ton of warrants. The common shares are being issued at $3 per share, which creates roughly $134.6 million of initial investment value based on the Bitcoin pricing methodology laid out in the agreement. So imagine trying to explain this to somebody in 2019. Yeah, there's this Japanese hotel company that turned itself into a Bitcoin treasury company. They decided to issue shares, and then they stacked 43,000 Bitcoin. Then they bought control of an American gaming media company, and then they renamed it Superplanet. The guy would have assumed that you suffered a traumatic head injury somewhere around Japanese hotel company, yet here we are. So Super League is already trading on the NASDAQ right now under the ticker SLE, but remember, it is becoming SUPA. Once the transaction closes, the ticker will become SUPA. The closing is expected in Q4 of 2026. What does that mean? From October, best case scenario, yeah, literally 2 months from now, to December, which would be a bit of a longer wait. But regardless, it seems imminent, kids, and Wall Street naturally has reacted with the emotional stability of a raccoon on amphetamines. And this is the good part. This already is an existing NASDAQ company. This isn't a SPAC reverse merger nonsense that we've seen with a lot of other Bitcoin treasury companies last year. They are explicitly describing this transaction as a strategic investment into an existing NASDAQ-listed operating company with cash flows. So the gaming media business is going to actually survive. The brands are going to get their advertising campaigns. The gamers are going to continue to stare at their screens, especially when GTA 6 comes out. And somewhere, a 14-year-old playing Roblox is remaining blissfully unaware that his advertising analytics provider has become part of a multinational Bitcoin treasury empire. The operating company in this company, Super League, now gets an entirely different Bitcoin financial purpose. The Bitcoin treasury is obviously going to become part of the primary driver of long-term shareholder value now. Not financial advice, this is financial entertainment. I just gotta say, they probably entered into this agreement with good reason. And this is the part that matters more than anything else in this announcement. Metaplanet will continue to raise capital in Japan, and MPJPY, it's still trading at 85% of the value of the Bitcoin. Right now, we're seeing Bitcoin touch $65,000 today. It seems like the bear market might be over, actually. And guess what? You can still get cheap Bitcoin in the form of the equity of Metaplanet at a big discount. So regardless, I don't think the market is pricing in what Metaplanet's going to do in the future. And then we are seeing these plans today. Now the stock is up 5%, but still that residual discount that I'm seeing to the Bitcoin holdings, man, MPJPY still seems extraordinarily cheap. But regardless, we have Metaplanet raising capital in Japan. You guys just saw my video about BitBonds, how bullish that is, issuing capital at a 4% cost of capital to buy Bitcoin and rolling those bonds over every few years. Are you kidding me? If Bitcoin goes to $1 million over 10 years, I broke down the math in that video, that's like raising equity at a 10x multiple. Yeah, that's the economic equivalent at $1 million Bitcoin. Go check the math on that. So you have Metaplanet Securities over here dominating in Japan, and then you have Superplanet raising capital in America. This is going to become greater than Pizza Planet. And you got to understand that both of them belong to the same consolidated group here. They have effectively created a listed Bitcoin capital markets engine operating in the two largest financial markets on Earth, Tokyo over here, NASDAQ over here, Bitcoin sitting in the middle like some enormous orange financial black hole, consuming whatever securities bankers are willing to manufacture around it. So when we look at the ownership, Metaplanet is going to own approximately 95.7% of Superplanet's common stock. So basically, Simon Garovich isn't showing up to a quarterly earnings call with a polite suggestion box. Metaplanet controls everything. The preferred shares also also provide important voting rights, including the ability to designate a majority of the board. 5 of the initial 9 directors are expected to be Metaplanet people. So when I describe Superplanet as Metaplanet's American Bitcoin Treasury platform, I mean that literally here. After the assuming outstanding pre-funded warrants, this is 93.6% ownership. So this is ultimate control of the company, and the public investors, they get access to the common stock. Metaplanet has the bridge from America to Japan right now, and guess what? That low of a float for you to invest in, they own 95.7% of the company. This thing is going to be convex as hell. So now let's get to the part here, because we gotta crunch some math. This is going to get a little bit complicated because of all the warrants, because of the launch treasury, the implied effective shares. This is my initial read. Double check everything with AI, do your due diligence, but this is my crunching the math here, because right now the thing is trading like crazy. It opened at $3 and then it went up to like $6, $8, then it went down to $5. It's trading with a lot of volatility. We want to answer the question, how much Bitcoin does each share actually own here? Well, Metaplanet, remember, they receive 44.85 million shares using the company's 93.6% ownership figure after the outstanding pre-funded warrants. That gives us an implied effective common denominator of roughly 47.9 million outstanding shares. And if Superplanet begins with 2,100 Bitcoin, and then if you just do that basic division problem, that means it's 4,380 sats per share of common equity Bitcoin exposure. That is $2.80 per share of BTC NAV at 64,000 Bitcoin. So this is the number that I am using to judge every future financing decision around it. Does Superplanet issue securities and increase sats per share? Wonderful. Does management raise capital in a way that destroys sats per share? Straight to financial jail. And that's all exciting, but we must get to the part of the announcement where somebody apparently spilled cocaine on the capitalization table. Metaplanet is receiving 10-year warrants for up to 381 million additional common shares. Yeah, 381 million, and Evil Fund is getting 10 million. So that is 391 million possible shares. That is the total new warrant stack here. This looks like dilution from hell. But remember, you need to read the next layer here. It's the same thing with Strive. They have the outstanding warrants that expire in October, but guess what, folks? If they are exercised, the company gets the money. The company gets operating capital. So instead of asking how many shares get created, if you are a long-term investor, you have to think how much value enters the company for each share created, and how much Bitcoin can Superplanet purchase with that capital. That distinction is everything, because a share that is issued for nothing, that destroys you. And yes, when there are shares being issued, the market has to absorb those new shares hitting the tape. There's no way around that. But depending on the Bitcoin price, if they issue shares, if Bitcoin is cheap, if Bitcoin's expensive, there are a lot of variables happening in the marketplace, but they could increase your common equity Bitcoin exposure, the NAV value backing each common share. And this is important. You have to remember that the bears out there, they always talk about these like they are dilution, but you cannot ignore the fact that they are literally a funding mechanism. And remember, Bitcoin is scarce. There's only 21 million of them. We are in a digital gold rush. It might seem like a good idea to exercise warrants for Bitcoin. Obviously, depending on when you exercise them, that is the big question. But CEBE, common equity Bitcoin exposure, it can rise even as the share count explodes. So you have to model this in to your investing decision. So imagine that Superplanet has 4,380 sats backing each share, but then somebody exercises a warrant and then they hand Superplanet enough money to purchase 5,000 sats for every new share created. Congratulations, the share count increased, Bitcoin increased even faster. Now, obviously, because the new shares can hit the tape and it does something to the float, that means that the price could come down, but remember, conviction in Bitcoin, at least for me, that's my backstop. I like to be directionally long amplified Bitcoin over long time horizons. So my common equity Bitcoin exposure, that matters a lot to me. That's why I'm still bullish on Metaplanet despite the hyper volatility. They are literally increasing the asset that I want per share that I own over time. Now, if I think Bitcoin is going to $1 million, I can crunch the math, and obviously the math works out well for me. I've only done that every single video on this channel, 400 plus videos of content. If you guys don't believe me, feel free to crunch the numbers yourself. So the warrants are this weird thing where they can be extraordinarily powerful, but at the same time, yes, the market does need to absorb that new share issuance. But if conviction in Bitcoin is your long-term thesis and you have more Bitcoin exposure per share, that's kind of the name of the game, isn't it? I'm not in this for a cool 2-month flip trade, and I'm not going to cry over spilt milk if the MNAV collapses from a 1.7 to a 1.2 and I have the time horizon of an ant. Bitcoin is the foundational monetary architecture of the new breakaway civilization, and that's why I'm buying Metaplanet and probably Superplanet stock. And this is where the elegance does become dangerous, because the lower the warrant strike, the less capital Superplanet receives for each new share. That means the low strike warrants, they need especially careful timing. Suppose each existing share owns around 4,380 sats. A $3 exercise would bring $3 of new capital into the company for a newly issued share. When Bitcoin is cheap enough, that $3 can purchase more than 4,380 sats. CEBE goes up. If you let Bitcoin rip dramatically higher before the exercise, suddenly that same $3 buys fewer sats. You have to take nuance when you are looking at this warrant package here. It is containing an embedded race between the Bitcoin appreciation and capital deployment. So that's very fascinating, but there is a lot of nuance here. You have to understand the entirety of the capital structure. So do your own research. This isn't financial advice. This is financial entertainment. This is fascinating because Metaplanet, obviously, they want Bitcoin to appreciate because they own a mountain of Bitcoin, 43,000. But the Superplanet shareholders, they also want Bitcoin to appreciate because Superplanet owns Bitcoin. Yet rapid Bitcoin appreciation can reduce the CEBE efficiency of the lower strike warrants that remain unexercised. So those later tranches of warrants could become truly explosive if Superplanet maintains a healthy equity premium and management converts that premium into Bitcoin intelligently. So there is that whole labyrinth of the warrants here. It's complicated. You guys got to game it out with AI. I'm telling you, don't just listen to me. But on top of the warrants, we also have digital credit and preferred stock. What if they come to the punch with daily dividends, and what if they're competing with SATA at a 13%? That's all I'm going to say. Remember, Metaplanet has a controlling stake of this company, so all of the value that accrues to Superplanet, it is under the umbrella of Metaplanet. What do you think this looks like for dividend coverage, for BTC rating? Metaplanet has close to double the Bitcoin that Strive does. Is the market gonna like the safety profile of a daily paying preferred stock issued by Superplanet? Perhaps more than Strive? I don't know. I'm not saying that it will. All I gotta say is that competition is good, and this is really pretty radical. Personally, I think there needs to be more digital credit issuers because Bitcoin is still in its infancy. Bitcoin will be built around for the new financial infrastructure, so I want more players play in this game. Their announcement literally explicitly discusses perpetual preferred stock as a way to raise permanent equity capital without directly increasing the common share count. Now remember, if you are a listener of my content, you understand that if you issue preferred stock that is senior to common, you raise $100 million of a perpetual preferred equity. You take that $100 million, you go buy Bitcoin with it. That doesn't immediately accrue to you, the common stockholder. You have to wait for Bitcoin to go up for it to outpace that fixed claim, that fixed senior claim above you in dollars, and then that value accrues to you, the residual after those senior claims are satisfied. And of course, the market does price that claim with MNAV fluctuations, so it's a complicated thing. But regardless, what's my point here? I want them to issue the preferred stock while Bitcoin is this cheap. I am really happy. I am really hoping that they can get this deal closed on by February. I am really happy. I am really hoping that they can get this deal closed, it's finalized, and they can start issuing prefs as soon as absolute possible, because Bitcoin is still really cheap right now. I do not want them to be doing it when Bitcoin is at 90 or 100,000. Now, regardless, even if they did do that, that would still be great. That's bullish because I think Bitcoin is going to $1 million. But as a holder of Metaplanet stock, I would want them to issue preps while Bitcoin is cheap, because that will increase the convexity, increase the returns of the common stock. You want to add amplification when Bitcoin is cheap. But it's really cool to see Metaplanet wanting to issue digital credit in the United States. Competition is good. Now, what's really cool is that Metaplanet now has something that Strive doesn't have, and they have something that Strategy doesn't have. They are the first global Bitcoin treasury company. And yes, Strategy did issue Stream on a Luxembourg stock exchange, but that's really low liquidity. That's not as big of a deal as this. Not even close. Metaplanet now has US capital markets access as soon as this thing is finalized, and they're also running the Bitcoin treasury strategy in the capital market that probably needs it the most, with the decaying Japanese yen, with the canary in the coal mine of the fiat system, the Japanese government, the Bank of Japan. Good heavens, what a disaster. The Japanese populace needs Metaplanet right now. And when you really look at the big picture of Metaplanet building out that new emerging Bitcoinized infrastructure in the capital market that needs it the most, and they have access to the US capital markets, how is this not the most bullish story in Bitcoin treasury companies today? America possesses the deepest capital markets in the world. You have preferred investors, institutional equity, convertible securities, warrants, credit, retail meme stock speculation, ETF infrastructure. Metaplanet is now playing the US game, children. And this is why I think focusing on that small 2100 Bitcoin as some exclusive part of the story, it's missing the forest for the trees, kids. The 2100 Bitcoin is the seed crystal. The real product is going to be the capital formation around that seed crystal. And with that low of a starting point, that small of a float, this thing is going to be convex as hell. The volatility is going to be insane, and the architecture itself is quite fascinating. So this is the takeaway. A Japanese Bitcoin treasury company has effectively taken control of an American gaming media company, filled it with Bitcoin, renamed it Superplanet, handed itself enough warrants to make a small country finance minister sweat, and then they built the foundation for a second Bitcoin capital markets flywheel, because apparently one wasn't enough. There are sober ways to describe this. I have rejected all of them because this situation by now is objectively hilarious. Remember, 16 years ago, Bitcoin started off as a 9-page white paper sent to a cryptography mailing list. And now 16 years later, Japanese corporations are acquiring NASDAQ gaming companies so they can issue perpetual preferred securities and warrants against an institutional multinational Bitcoin treasury company. Satoshi wanted peer-to-peer electronic cash, but capital markets have responded. The best I can do is a cross-border, dual-listed leveraged Bitcoin accumulation Voltron with 391 million warrants. Checkmate. And somehow I love it. I'm giga bullish on Metaplanet. How can you not be? I will be covering Superplanet because obviously this is a huge story. There's a lot to wrap my head around, but it's going to be very fun. I think it's going to be a very volatile common stock equity. My heavens, it's going to be a lot of unpacking, but I'm very excited for it. Metaplanet is the mothership, and now they have an underling that can likely acquire Bitcoin with digital credit issuance in the US. Like, obviously, this is complicating things, but good heavens, how can you not be bullish on Metaplanet, kids? My name is Adam Livingston. I am the Bitcoin Wizard. Thank you so much for tuning into today's transmission of the Orange Gospel. If you could do me a huge favor, like the video, subscribe to the channel on YouTube. That way you can support my mission of spreading the Orange Gospel of Bitcoin to the masses. Have a terrific day, everybody. Do not party too hard, my dearest little goblin rats. Class dismissed. If your business partner, spouse, or whoever controls the money isn't quite as bullish on Bitcoin or MSTR as you are because you have seen the math. That is okay. My friends at Sovana have you covered. Tell your board, your wife, your husband, whoever. With Sovana, you can now buy Bitcoin or MSTR with full principal protection. That is right. Discussion over. Time to buy Bitcoin and MSTR because the worst case scenario is your investment stays flat, while the best case scenario is the bullish moon math and asymmetric upside we all know is possible. Scan the QR code on the screen or go to sovana.io/capital to learn more. The Sovana team will be happy to answer your questions and walk you through how it works from start to finish. Win the debate once and for all by removing the downside completely. Thanks to Sovana, you can now buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself?
I would say the threat is less imminent than the headlines suggest, and work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more, quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Welcome to the most American financial story imaginable, kids. The government continues to borrow obscene amounts of money. The bond market is starting to charge adult prices, and Washington is getting visibly uncomfortable. The Treasury today is reaching for the plumbing tools that are necessary, and of course, Bitcoin immediately levitates like it just heard the words open bar. Bitcoin up 7% today. Yeah, MSTR up more than 14%. Somewhere, somebody with their 60-40 portfolio is hyperventilating. They're seeing Bitcoin at $68,000. And they are starting to freak out. Because today's story is a lot bigger than a green candle, kids. It is about the market discovering the approximate yield level where Washington starts to feel chest pain. The Treasury doubled the maximum size of the large and buyback operations, and Bitcoin moved before anything began to even function. The market is smelling the reaction function today, and Bitcoin is mooning. MSTR is taking that Bitcoin move and amplifying it. All of the Treasury companies dominating today. And the reality is that we are just being proven correct time and time again whenever Bitcoin goes up and to the right. This is the thesis playing out in real time. Bitcoin is going to the moon. So is MSTR. You guys are going to love today's video. We're going over everything. If you could do me a huge favor, like the video, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to to the masses. And look, if you are listening to the Bitcoin Wizard, I'm going to go out on a limb and guess that you think Bitcoin or MSTR has a chance to be the best performing asset over the next 5 years. Now, what if you could get more than half of that upside with full principal protection? That is exactly what my friends at Sovana are building. Every single dollar of your investment is being secured by a title-insured recorded lien on U.S. real estate. And you split the upside with the property owner whose home equity is backing your own investment. This is an amazing model. If you've been waiting for a way to buy Bitcoin or MSTR while being able to sleep at night, this is it. And honestly, what better time to lock in a 5-year position than when Bitcoin and MSTR are sitting in a bear market that's heating up faster than the money printer. Use the QR code today. Go to sovana.io/capital to get started on this amazing opportunity. And you guys know how excited I get about Bitcoin treasury companies and this ongoing institutional adoption of the Apex asset, but do not lose sight of the fact that the #1 strategic reserve is your own Bitcoin in 100% self-custody. Eliminate counterparties, run a node, become sovereign. You can secure your Bitcoin position with the Bitcoin way today. These guys lost 0 of their client funds during the latest cold card fiasco. If you want to be your own bank and become a sovereign Bitcoiner, my friends at the Bitcoin way are standing by to help. You can schedule a 100% free introductory call with the QR code right here, or go to thebitcoinway.com/Adam. Do not delay. So this is the headline that pretty much changed the tape today. Treasury unexpectedly increased its long end liquidity support buyback capacity immediately after the long bond had been testing multi-decade yield highs. They are increasing the long end liquidity support buybacks from a maximum of $2 billion per operation to at least $4 billion. Now, this is my favorite part of their phrasing. The beautiful phrase is "at least." At least is what your contractor tells you when he's working on your kitchen renovation. At least is what the Pentagon says before a printer catches fire. At least just turns a number into a lifestyle. So that's my favorite part of the government lingo, using the term "at least." Now, specifically, these enlarged operations that Treasury is announcing begin on September 9th and run through early November. So the larger purchases are still weeks away, yet the markets immediately reacted. This has been a very common theme on this channel. If you guys have been paying attention, you need to understand that Bitcoin is the asset with the most hypersensitivity to liquidity, to what the Fed's gonna do, to what the Treasury is gonna do. This is proven empirically. So Bessent and the Treasury, they're just watching the long duration government bonds just getting beaten to death behind a strip mall. They're looking at the 30-year yield that is north of 5%. And we've all been waiting for this. I think that all of us knew that some type of intervention was going to happen. And then today it did. And then, of course, Bitcoin reacted immediately. So essentially, we are at the time where Bitcoin is running out of sellers. If you're looking at all of the on-chain metrics that I have been posting on X, it really seems like we've seen a lot of seller exhaustion, and that is a lot of dry kindling. And a story like this is the match, because what happens is that Bitcoin sniffs this stuff out. It's always the first to react in size to news of this magnitude whenever it's relating to government spending or increased liquidity. Now, $4 billion, that sounds enormous because most human beings compare $4 billion to their mortgage. In Treasury market terms, though, $4 billion is different. The broader Treasury market is around $31 trillion. So the direct flow is tiny relative to that ocean of government paper. Yet you got to remember, the price is set at the margin and expectations always move before flows arrive. The market learned that when duration pressure gets ugly enough, the Treasury has tools and a willingness to use them more aggressively. So policy regimes are always revealing themselves through very tiny adjustments like this. The technical releases, the sentences that are just buried in debt management language written by people who regard exclamation points as a controlled substance. And then the dollar, the DXY, has been awful today. And then, of course, bonds rally, and then Bitcoin jumps 7%. Now, this is where we preserve our IQ points here, because a lot of people on social media are failing to make this very very simple distinction here. Treasury buybacks operate through debt management, okay? The Treasury cannot create bank reserves. Treasury retires selected older securities and finances government obligations through the rest of the issuance machine. So the useful lens here is this concept of duration, okay? Because the private market has been being asked to warehouse a gigantic quantity of long duration government risk. This is what's been happening. Now that inventory carries interest rate exposure. When buyers demand more compensation, that just means that the long yields rise, and those long yields, those bleed into mortgages and equities and real estate and every single CFO's blood pressure. So what they're doing is the Treasury is relieving some of that pressure by buying the less liquid long bonds, and then they're shifting their financing toward the paper that the market absorbs more easily. So think about this absurdity of modern finance. We have, number one, the United States about to cross $40 trillion in national debt, and the civilization is now depending partly on whether a money market fund in Connecticut prefers a 3-month bill over a 27-year bond issued when TikTok still had a different CEO. You see, duration is plumbing. Liquidity is the water pressure. Today, somebody is touching the valve here, and every single risk asset hears that. And now to explain it one more time, because people are asking, oh my gosh, why is Bitcoin going up? Well, it's going up forever because the government will just continue to print money hand over fist, because let's be honest, the politicians are never going to fix this problem any other way except through monetary repression and the devaluation of fiat currency. We all know this. But when you are seeing that long end with that stress right there, the 30-year yield pushing 5.3%, this is, the highest that yield has been in, 2 decades or something. The Treasury's going to respond, and then they're going to increase their buyback capacity by at least 2x. And then bonds rally, the yields fall, the USD softens, and of course, when the USD softens, Bitcoin goes up. That is the anti-fiat, short fiat, long Bitcoin trade that we all know and love. You see, Bitcoin trades 24 hours a day, free of all of the committee calendars, the investor relations choreography, and 40-page memos explaining why this thing happening directly in front of you is just transitory. Bitcoin just reprices. It is the feral macro asset. It lives behind the dumpster of the global monetary system and can smell policy food from 3 countries away. And yes, it sniffs it out because the operations begin September 9th, but Bitcoin moved on August 19th. The reaction is always forward-looking. Bitcoin is always the signal. And this candle is enormous. At a plus 6.9% move, today would rank as the second largest positive Bitcoin day in the last 12 months if of course this move holds in to the daily close here. And this is arriving after a period where Bitcoin volatility got compressed so hard, the chart really started to look sedated, like it was a tranquilized cow. You see, Bitcoin spends weeks convincing everybody it has become a municipal bond, and then it suddenly adds thousands of dollars in the blink of an eye. You see, confirmation always arrives through the windshield, kids. I can dive into this right now. I can show you that I actually called this last night. No, I'm not joking. So before we get to the volatility though, I do want to talk about the seller exhaustion because I did mention that earlier in the video. But the last time that holders were this underwater, Bitcoin was $16,700. This is using the print from June 30th, the local Bitcoin price bottom that just happened, 49 days ago. And actually, that's now 50 days ago because I remembered I calculated this last night. But it was very simple. I just took the long-term Bitcoin holder supply and loss, and then I found the cycle bottoms every single cycle, in 2015, 2019, 2022, and 2026, because the bottom was on June 30th when that metric specifically touched the floor. I moved 49 days into the future. Then I measured up some median returns, and the numbers are pretty crazy. A median path across all of 2015, 2019, 2022, when we have hit that exact same level, $105,000 Bitcoin in 6 months. It would imply in about a year and a half, $168,000, and in 24 months, almost $750,000. Now, I'm not saying that Bitcoin's going to be $747K 2 years from now, but that is what the median number is for 2-year returns throughout all of those other prior bottom cycles, with the long-term holder supply being at the same point that we're at today. What's crazy is that the floor across 3 cycles was a 4.3x, and that's the 2-year return. That's the floor. And that would imply, roughly $250,000 Bitcoin, the worst case 2-year scenario. This is what that chart looks like, and it's pretty ridiculous. So, you have a lot of these crypto trader bros that are saying that we're going to bottom in October. And I'm just looking throughout history and I'm like, well, you look at the long-term holders, that supply and profit and loss hit a low on June 30th of this year. And then I indexed the start to 1 for all of the cycles, 49 days past that cycle peak in the long-term holder supply and loss. This yellow line is the median. Now, obviously you do have this blue line here. That's the 2019 cycle. But regardless, you do see that all of them pretty much started going up and to the right immediately. So this seems like June 30th was the bottom, at least with this indicator it does. So then I woke up this morning and I wanted to check in on Bitcoin's volatility. Now, specifically, I looked at the volatility of Bitcoin's adjusted MVRV ratio. And if you guys want to know what that is, this is the description of this on-chain metric here. It removes the realized cap of old age cohorts measured in days, treated as lost coins, and then recomputes the MVRV using only the active supply. And the MVRV ratio itself basically explains Bitcoin's market cap to its realized cap, okay? How far the circulating supply is above the realized cost basis here, which is the aggregate on-chain cost basis of the entire network. It's the market cap divided by the realized cap. And so I wanted to know the volatility of the adjusted MVRV, adjusted for lost coins. And I found some pretty striking details. So you want to talk about bottom signals? Here we go. The volatility of Bitcoin's adjusted MVRV ratio collapsed to a 0.3 percentile reading since 2017. That means that 99.7% of Bitcoin's modern history was more volatile than this. But this is the important part when I look through at all of Bitcoin's price history. When does the volatility compress? And what does that mean for the forward returns from that point whenever things get this coiled, when things get boring in Bitcoin? So check this out. Look at November 2018. The reading was 1.27 to 1.45. So the 60-day volatility identical, and the adjusted MVRV was 0.02 off November 2018. Now you compare that to today, extremely similar readings. It is uncanny. These were Bitcoin's historical median forward returns from those 2 historical setups. Pretty crazy, small sample size, absolutely, but it's very easy when you look at Bitcoin's decreasing volatility. When it gets this compressed, history just says that the forward returns of Bitcoin always come when we are this compressed in the volatility here. 6 months, 82% return. A year, 83%. 18 months, 136%. 24 months, 246%. So whenever we've seen the spring being this compressed, things get boring, and that's when you need to be bullish. You have to reverse your psychology about being excited when everybody else thinks that it's bored. That's how the money is made. And I went ahead and plotted this on a chart that's really cool. On the y-axis, I do have the 60-day log volatility, and then on the x-axis, that adjusted MVRV. Now, of course, you are seeing those 3 prints here showing you the volatility versus valuation. And obviously we are an outlier on the data point right there. And these are just the forward returns from whenever we have matched that same exact reading. How can you not be bullish on Bitcoin after reading this? And then also on top of all this stuff, what's really cool is that we have just seen the tech stocks, the AI super cycle. It's been blowing Bitcoin away, especially when you measure it from the Bitcoin all-time high. But some good news, today's Bitcoin day is the second best day versus the QQQ since October 6, 2025. Very cool. And actually, it's the best day on a QQQ down day. So it's either 1 or 2, depending on which way that you look at it. But obviously, this is amazing to see because this breaks a trend that we've been seeing. 10 straight months of getting dragged behind the shed by the mega cap tech. Yeah, Bitcoin is ripping while the QQQ slipped 0.04%. Now, obviously, that relative outperformance is crazy. Only February 6th was bigger, and that was the snapback after the largest Bitcoin price correction in nominal terms in the history of the asset. Anyway, yeah, it's just super cool here to see a green candle of this magnitude because we have been getting beat up, like literally 2 good good days this year. I mean, look at this trend since the all-time high. Obviously, if you're going to measure from the all-time high, it's not going to look good in a bear market, but regardless, it's just really nice to get a win today. Now, I do want to talk about the MSTR bear clowns out there because a lot of these people, man, yesterday, I was telling some people this in a group chat, but I was like, today feels like the capitulation event for the MSTR shareholders. It like really did yesterday, because if you guys don't remember, I know that we all have short time horizons here, short memories, but MSTR was down like 5% yesterday when Bitcoin was roughly flat and people were losing their minds. Actually, Bitcoin might have been up 1% with MSTR down 5%. And of course, you had the flood of MSTR shareholders that are like, whoa, I'm getting diluted. I can't handle this. I had to emotionally handhold like 8 or 9 people yesterday, and I just got fed up with it. I'm fed up with the people staring at a 70+ volatility asset on the daily chart, wondering if the thesis is broken. And what poetic justice for today to happen after yesterday, which was probably the biggest emotional outburst I have seen from grown men in the history of me being in the MSTR trade. But I do want to illustrate something to you because this is really funny. We've been seeing all these Bitcoiners claiming that Bitcoin is going to outperform MSTR on the way up, and then MSTR, you know, casually has a plus 15% day, you know, just casually 2.5xing Bitcoin's returns on the second best Bitcoin day of the year. So let me pull up Strategy's dashboard because I'll actually break this down for you. It's very simple. So we're going to keep it easy. Just look at 2 numbers. Obviously, Strategy has a Bit reserve. Now that's pretty cool. They also have a USD reserve too. And the sum of their Bitcoin reserve and their USD reserve is $62.28 billion. That's pretty solid. Today, it's up 3.4 billion. Now, obviously, if you adjust for the outstanding debt and the preferred stock and the USD reserve, you account for everything. You know, I've talked a lot about CEBE on this channel. Strategy is using a net reserve metric, so you are accounting for everything. And you can see the definition right here. It includes everything, updates every 50 seconds. That's great. Now, if it's adjusting for everything, what do they mean by net? This is the residual reserve for MSTR shareholders. Now, what do you witness here between these 2 numbers? Can you actually tell me what you guys notice? I see plus $3.449 billion for both of the numbers, but I see a percentage difference there. That's weird. The reserve is up 5.84%, but the net reserve is up 9.29%. It's almost like MSTR is amplified Bitcoin and you get the spread between the fixed senior claims and the Bitcoin going up. And what's funny is that the MNAV like moved a little bit today. The MNAV is up 3%, but look at the net reserve. It's up 9.25%. This is literally proving that MSTR can outperform Bitcoin even if there is 0 MNAV expansion. If I have to explain this one more time to the moronic Bitcoiners who show me the chart of the MSTR share count going up and crying about dilution of a stock that, number one, they don't own and they don't understand, I think I might have a stroke. So anyway, these people are totally stupid. MSTR is greatly outperforming Bitcoin today. Shocker, surprise, I know, up only 12% as of filming. The net leverage is down to 3.4%. That's hilarious. The debt is not even an issue anymore. Well, it actually never was, to be clear, but you know, regardless, 3.4% net leverage is hilarious. And then you have ASST up 13.28% today. I mean, just dominating, firing on all cylinders. How do you not like this? SATA is 10 cents from par. Digital credit not dead. Bitcoin not dead. MSTR not dead. The bears are bloodied, lying out in the street waiting for death, and these people are just ridiculously stupid. I did say I will continue to take the most short fiat long Bitcoin positions I can possibly find. This is a fun little screenshot of my fun Robinhood side account, and man, all of those call options looking pretty damn good today. Bitcoin is the hurdle rate. I refuse to subject myself to the purity tests of the clowns out there. It's not that hard. The governments will continue to print money forever. Bitcoin is going to $1 million and beyond. Therefore, I want to take an amplified rocket ship on the journey there, kids. My name is Adam Livingston. I am the Bitcoin Wizard. If you guys could do me a huge favor, like the video, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Have a very terrific day, everybody. Do not party too hard. Class dismissed. If your business partner, spouse, or whoever controls the money isn't quite as bullish on Bitcoin or MSTR as you are because you have seen the math, That is okay. My friends at Sovana have you covered. Tell your board, your wife, your husband, whoever. With Sovana, you can now buy Bitcoin or MSTR with full principal protection. That is right. Discussion over. Time to buy Bitcoin and MSTR because the worst case scenario is your investment stays flat, while the best case scenario is the bullish moon math and asymmetric upside we all know is possible. Scan the QR code on the screen or go to sovana.io/capital to learn more. The Sovana team will be happy to answer your questions and walk you through how it works from start to finish. Win the debate once and for all by removing the downside completely. Thanks to Sovana, you can now buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
I think the fact that they're taking a second cut at this is a bit ill-advised. They've taken a different approach to it, which is to redefine what an operating asset is. The SEC and FASB have defined what an operating asset is for strategy, and Bitcoin certainly is that. They don't see Bitcoin as an operating asset, so I think they're sort of taking a position against general accepted accounting principles in the SEC. And so we'll go back and we'll respond to them and try to understand better why they're taking this approach that's antagonistic to Bitcoin and the asset class. And I think they will consider our responses and others and be constructive about this and hopefully not move forward with their latest proposal. But even if they do, right, I don't think it's that important to us in the end.
All right, everybody, welcome back to another week on BFC Live. Lots to talk about today. Today, I am joined by two very smart gentlemen. Every week, I get to talk to people about Bitcoin. They're a lot smarter than me. This week is no exception. I'm joined by Mason Foard, who is the director of Bitcoin strategy at Meluse and also a founding member of True North, and Allard Peng, our head of research and insights here at Bitcoin for Corporations. Gentlemen, thanks for joining me today.
Thanks for having us, Jake. Appreciate it.
Good to be here.
All right. Lots to talk about today. Bitcoin is getting a bid. Treasury companies and equities are getting a bid. Scott Bezant had some news to share that the market enjoyed. But I want to start with BIP 110 for a second, Allard. Quick question. What is a BIP 110 and what do I do about it?
Yeah, I mean, like from the corporate level, and I think it also translates over to just anyone that uses Bitcoin. So to begin with, it was a soft fork. The soft fork happened on August 8th, and then it didn't really get anywhere. And the supporters of it are, I think, a population of those supporters they're now thinking about like doing a hard fork. So I'll just go over some terminology. So soft fork is a restriction of the network rules. And in this case, like BIP 110 meant to restrict certain rules to do with the, like restricting the transactions that are within the op return. And this is meant to amend a change at the mempool policy level with Bitcoin Core V30. So like the short answer of it is like it's meant to be this movement that node runners could run this soft fork, and it would give them some kind of say over how the network should run. And what ended up happening is like the discourse got very much wrapped up in a lot of heated debates. I think a lot of it, like you could probably ascribe it to, just bear market makes everybody pretty angry about things and they feel like something needs to be done. Yeah, like in terms of what people need to do about it, like it's really just where you stand on what you think like is the best course of action for you as a node runner. So if you're a supporter for the soft fork, then you have that right to run the software on your node, and therefore start signaling BIP 110. Of course, we have gone past that activation window, so now you're at this point where that fork is now no longer really in play. But it was just an event where people could have participated if they wanted to, and if you didn't want to participate, then you can just not really do anything with your node. One of the luxuries of Bitcoin is that your default action can just be do nothing, and normally you end up being okay, right? So that's the main thing. Like the real action is just based on whether you supported it or not, and if you didn't support it, you didn't really have to do anything.
So ignore it, business as usual, back to building in the bear market.
Well, I think like I think there's definitely a longer conversation that could be said about it. In general, I think like the supporters of BIP 110, and I wouldn't call myself someone who was like anti-BIP 110. I was very much neutral. Like I didn't run it myself, but I just thought that the node runners have a right to do what they do on their node. But ultimately, I think like what I definitely disagree with is the hard fork discourse, like trying to advocate for a hard fork to brick the proof of work algorithm and replace it with something else. Like that part of it, I think that has crossed the line. But otherwise, like doing a soft fork or at least attempting one at the node level and then trying to get consensus for it, that there's like in principle nothing wrong with that. So yeah.
Okay, Thanks. I appreciate the explanation. Switching gears here, Mason, before we started the stream, you had mentioned that Scott Bessent came out with some news on capping the yield curve. Want to hear a little bit more about, like, functionally, what does that mean? Let's assume, like, what does a yield curve even mean? How does that affect Bitcoin? Bitcoin is obviously getting a bid right now. Yeah, I want to hear your thoughts.
Yeah, so this morning, Scott Bessent of the U.S. Treasury announced that it's going to be doubling the size of its long-term U.S. debt buybacks. And this has followed kind of a rapid surge in Treasury yields, particularly the 30-year, which I believe in the middle of June, it was around 4.8, and I think it reached as high as 5.3. So a really rapid surge in yields. And so they announced that initially there was a program of 2 billion will now be increased to at least 4 billion. And the wording that they use is the move is intended to provide liquidity support for bonds maturing in the 10 to 30-year range, and this is as the U.S. debt nears around 40 trillion. So essentially what they're doing is yield curve control, which the yields were rising, and on this news, the yields have, or the 30-year has dropped to around 5.19. So instantly it lowers because there is some buy pressure from the Treasury. Now, the Treasury has the ability to, and this is a simplification, they have the ability to essentially print money, right? And that is how the market is interpreting this, that the Treasury and will not allow the yields to go higher because it makes the interest payments and the debts that the U.S. governments owe particularly untenable. And as they get higher, the interest gets higher, and it can lead to a debt spiral. And this is really why we are seeing hard assets today. And let me check, so we're up to date. Gold is up 3.77% today, which is a huge move for gold. Yep. And Bitcoin is up 6.23%, which is also a significant move after Bitcoin has been ranging in the low 60s, high 50s for about 6 months now. And this looks like it's real first momentum, and a potentially a short squeeze. There was a lot of people who thought Bitcoin was going lower, and they get squeezed and they have to buy back at a higher price. And what's particularly interesting is equities like MSTR and ASST, which is Strategy and Strive, who are amplified Bitcoin, are also squeezing significantly today, with MSTR up over 14%, and Strive now at 15.5, which is really an incredible move. And I think that's also due to a short squeeze. But to sum it up, and I'm sure Allard will have some more insights here. The market is, or investors, macro participants are rushing into hard assets, things that represent the quote unquote debasement trade, because Bessent really sent a message today that similar to Lynn Nolan, that nothing stops this train of debasement, of continuing money printing and financing the debts of the U.S. Let's pass it over to Allard. Allard, anything else there?
I think you got the main points. Yeah, and at least for Bitcoin, right, there's definitely a capital rotation angle over here. We're kind of closing in on that 1-year mark for the bear market, and there might be let's just call it like a jitteriness in the market to try to, front run that event of the bottoming. So that might be some element of what we're seeing today. I think like just within the spectrum of macro assets, Bitcoin has been extremely oversold, and it's by far the worst performing one in the last 18 months. So you have, you have like basically any capital rotation from here, Bitcoin becomes probably the core possible and potential benefactor of a capital rotation. And I think these kinds of macro events, they could very well become catalysts that trigger that kind of thing. So I think that's another part of what we're seeing.
I'm curious. So is this move from the Treasury, you mentioned Lynn Alden's famous quote, "Nothing stops this train." Is this move from the Treasury, was it inevitable? Or are there other options that the Treasury and the wider federal government have in light of where we're at with rising debt?
Yeah, that's a complex question. I would say beyond austerity, something like Doge trying to reduce the spending of the government, which we've seen kind of fail spectacularly because there's very little political support. I think realistically the mechanics of what they can do, they have a whole tool bag of things that they can do, whether it's QE, yield curve control, helicopter money, like we saw in COVID, swap lines, loosening regulations, etc. There's many things that they can do to quote unquote support liquidity, but at the end of the day, there's just going to be different acronyms or different mechanisms for creating more monetary units and perpetuating the debt-based fiat system that we currently are in, and that needs ever constant expansion. And if you understand this at a very high macro level, that's why people are so into things like Bitcoin and gold, because they protect you, as gold's inflation rate is very low, around 1 to 1.5%, and then Bitcoin is trending towards zero over time, and I think currently has a lower inflation rate than gold. So yeah, I mean, in my mind, this was always inevitable, right? Nothing stops this train. And it's a mix of just understanding kind of human behavior, incentives, and game theory. The government has the option to print money. They will never default on that debt. And I don't think that they are going to be able to bring in the revenues or the receipts that they need to diminish it significantly, or the debt to GDP. So yeah, I think printing is kind of the end result here, no matter what they do or no matter how long it takes.
I'm curious, Allard, you said Bitcoin, you said that might be the core benefactor. Mason kind of touched on that, but I want to hear a little bit about why you think Bitcoin, maybe gold, might be the core benefactors of this new like money printing and all these different measures that the federal government's taking.
Yeah, sure. So to be clear, when I said core benefactor, I meant like, it's the most oversold of all the macro assets. This one's the worst performing. So as soon as you have a capital rotation, like where is the money going to go? They're going to, like, the smart money is going to be like, okay, I want to buy low, right, and sell high. So, well, in terms of relative lowness, it's Bitcoin that's the most low, right? So that's why I say it would be a core benefactor of any kind of capital rotation along that logic. But for your broader question, is like inside this kind of long-term macro events, you're kind of at the tail end of a long-term debt cycle, and There's probably going to be some kind of restructuring of the US dollar. Like these kinds of restructurings happen every 40 to 70 years or so, right? And we're kind of closing in on that timeline. Like if you look at United States history, that's been how it is. And if you look at how long-term debt cycles last, that's usually how long they tend to last. And debt usually is a main catalyst for these kinds of big threshold events in history. So in those moments, right, you normally see that hard assets do benefit. Hard assets that are not beholden to, you know, any kind of country or any kind of like corporate balance sheet or anything like that. Like hard assets that are truly neutral and truly scarce, quite frankly. So of everything in the world, like Bitcoin basically fits that bill the best, right? Because at the end of the day, we're entering, well, we have already entered into a digital age, and this is a scarce digital asset. This is like the only digital asset that is, you know, provably credible and scarce and all of those things. So that's why I think, like, just in light of the macro, Bitcoin could definitely stand to benefit the most from that. Yeah, and then just overall, you have the adoption that has popped up at the corporate, institutional, and soon we'll probably see like more nation states, right? So all of those are potential tailwinds that really bode well for Bitcoin.
So for the Bitcoin operating companies, whether they're a treasury, infrastructure provider, whatever it is, if we're in this regime where there's now tailwinds, I'm curious, what's the view on, you know, we'll say, we'll think in cycles. What's the view in the next couple years for the companies that are holding Bitcoin on the balance sheet, like Milieus, like Strategy, Strive? I'm curious, Mason, you're a director of Bitcoin strategy. So like, what's your view as you guys hold Bitcoin on the balance sheet?
Yeah, I mean, I think we think of it as a long-term capital asset that helps us save energy into the future. And of course, Bitcoin, as you said, it's very cyclical and volatile. And if we are following a cycle model, which I don't totally buy, but it does seem that way, right? Kind of the psychology of the market might make it so it is a cycle potentially, which is it kind of self-reinforces itself. But yeah, then the next few years are presumably incredibly bullish because we're nearing kind of the 1 year mark of the start of the bear market, which was I think October 10th. And right now it's August 19th. And I think Allard made an astute observation that there might be many people who are trying to front run the quote unquote bottom. And I really think if you look at the first major low that we had was in February, and we retested it again this summer. But we've really been consolidating for the past 6 months in this 60 to 64 or 58 to 64 range. And I think that's a significant number because that was really the top of the last bull cycle in 2021. It seems like we've come back and we're sort of retesting it. We're also at the 200-week moving average right now. We're bumping up against it, riding it. And historically, that's been a really consistent, beautiful place to buy Bitcoin and hold it for a few years. I don't think there's been a time where if you've bought it at the 200-week moving average that you haven't been up at least 100% in the next few years. So yeah, I think we are incredibly bullish, and having an operating company, we've been able to really dynamically ride this bear market out, and our equity has since October has really consistently outperformed Bitcoin because of the fact that we have an operating business and we're able to buy back shares. And in October 2025, we announced that we were going to start buying back shares, around 10% of the free float. And we just announced 2 weeks ago in our Q2 2026 earnings call that we had completed that buyback and that we were going to continue another buyback. And we're doing that for a few reasons. As the Bitcoin market is weakening, we think that we do have an operating business, and our operating business in October was severely undervalued. It was valued around about 10 million real, and that's an operating business that had spit out around 40 million real in the past 12 months, right? So it was severely undervalued. So just from a valuation standpoint, we thought that it was a better opportunity as Bitcoin was beginning to kind of go into a bear market to buy back our own equity than rather try to catch Bitcoin while it's falling and buy back our operating business at a really cheap discount. And we've seen that in kind of our equity outperformance. Since October, we're up around 13%, while Bitcoin is down around, I guess, 40-ish% now. And that's kind of like a 50-point delta between what Bitcoin has done and a operating business stacking Bitcoin and also increasing Bitcoin per share by reducing the share count. So we're just one example, and there's many different models, right? Like Strategy and Strive, their equity is designed to be amplified Bitcoin on both the upside and the downside, and we've seen that. Frankly, they both had kind of brutal drawdowns, but I think most investors understand that amplification works both ways. In a bull market, if you're bullish on Bitcoin, you will, in my mind, likely outperform because of the amplification embedded via the preferred equities.
Yeah.
And that is a model that we really haven't seen in a bull market. We saw a little bit towards the end with Strategy announcing, Strike, Strife, and Stretch, and I believe Stride before the last top, but I don't think it wasn't as nearly a robust strategy, and kind of the clarity and kind of the operational scrutiny that they have now is they're just in a very different place, and I would argue much stronger. But Allard, I saw that you posted a kind of report yesterday on MSTR, and I was able to read a little bit of it, but I would love if you went over it again.
Okay. I mean, Jake, do you want to go through that, or like?
Yeah, I want to hit
know.
that. We're gonna hit that for sure, but I've got some follow-up questions here.
Okay.
So, okay, Mason, you mentioned the front running that's happening in the market, or perceived front running.
Mm-hmm.
It seems like, help me understand, and maybe help the average Bitcoiner understand that what's actually happening in markets, because it seems like Michael Saylor sells $15 a Bitcoin and then it drops 30%. He buys $500 million and the price doesn't move. So, like, I'm curious, who's front running the market right now? Who's actually buying Bitcoin? Is it a bunch of retail like cramming in? Is it institutions? And like, what's actually moving the price here? Yeah, who are these participants that are front running right now?
Yeah, I mean, I think today's the first indication of any front running. I think if you look at the past 6 months, what it's really been is a consolidation period, and it's not necessarily who's buying Bitcoin. It's the sellers and the buyers kind of meeting at a fair value price. And I think what people all consider the buyer's point of view, I don't think they often consider the seller's point of view, which is if you're a seller of Bitcoin, you want the highest price possible, right? Like I think that makes the most sense. And I think if you're a seller of Bitcoin, at this point, you might say, hey, I don't think we're going to go much lower here. And in fact, I think we might go higher. And so they might start raising the price that they want to sell at. And of course, it's a market, so there is a dynamic, but I think there's really been a negotiation the past 6 months. And I think maybe the sellers are looking at percent and the buyers as well and saying, hey, the buyers are like, hey, I need hard assets. And the sellers might be, hey, maybe I want to hold on to my hard assets. And that's how, the price goes up. And it could also be, trading momentum, leverage. It's so multifaceted and dynamic. It's really hard to pin down. But I think if we're looking at it kind of from a broad, big picture view, it is always a dynamic of a buyer and a seller and a negotiation.
Allard, Mason also mentioned the prefs, and this is a question that I asked you about previously, but I want to ask it again so our listeners can hear you kind of unpack it. This is going to be the first time in like a real bull cycle we have these digital credit products. And you spoke to me about the reflexivity and how this affects, what the price that Bitcoin's trading at. Tell me like your view. How do these digital credit products fuel the bull market, and how do you think they'll perform, especially given the pressure that's been on Stretch lately?
Yeah, sure. Yeah, we could probably talk a while about that. I guess the bottom line up front is like all of the pieces are being set into place, and that's really how I would frame things. Like every digital credit instrument out there, every way for other pools of capital in the capital markets to go into Bitcoin, that's all like a piece of like infrastructure, if you will, to just ultimately pipe more money into Bitcoin. So in a bull market scenario, those pipelines that allow money to flow through into Bitcoin will probably run hotter than normal, right? It's just because people feel good about the asset, and people feel good about all of the derivatives that are on that asset. So digital credit would obviously be included within that category. So people just feel good about buying these things, and then now the issuers can run those ATMs, and they're able to raise more money, pile that money into Bitcoin. Okay, so does that actually have an impact on the Bitcoin price? I would say that at this moment and at these volumes and at these buy rates per week, definitely not. Okay, like definitely not. It's not enough money to really move the price, because ultimately, like Bitcoin has a huge amount of volume, and if you look at how much, so Strategy's biggest buy week ever was like Q4 of 2024. It was right after the Trump got inaugurated. No, not inaugurated, like elected. And you had that huge run up, and they were able to buy like 55,000 Bitcoins in a single week, right? That was their biggest buy week ever. Not necessarily like in dollar terms, but like just in Bitcoin terms, right? But maybe in dollar terms too. I'm not completely sure, but in Bitcoin terms for sure, it was their biggest week. And if you look at the Bitcoin volumes, trading volumes for that week, just on exchanges, so not even counting like all the OTC stuff, Just on exchanges, it was a very small percentage of total trading volumes. So that right there tells you that like it frankly is not enough capital to really be driving the price. Same thing with them selling. When they sell like 30 Bitcoin or 3,000 Bitcoin, or if they sold 30,000 Bitcoin, that isn't something that would move the price, just given like how much their volume occupies over how much like total volume occurred over that week. So that's, I want to caveat things by saying that, right? But that being said, right, like, could we imagine a scenario where these instruments are at a level of growth and maturity that eventually they in fact do become reflexive? And I would say the answer to that is probably yes, because at some point, with all of this financial engineering and with all of this like structured credit and with all of these instruments that are just built on top of Bitcoin, eventually you can reach this state where Bitcoin just becomes this default go-to place that people want to park their capital, right? And this can be a very natural progression of like how things be. Like right now, it starts with a few companies that put it on their balance sheets, and then it starts with them issuing digital credit, and then it starts with people building on top of digital credit, and then it starts with banks issuing like high amounts of loans against that Bitcoin that they have custody within the banks. So you can see like this, it's a step-by-step progression. And when we get to, there will come a time when we get to a point where the volume of capital that moves into it actually does impact the price, like materially. So that is where I would say the reflexivity comes to be. On a more micro level, like the reflexivity can definitely materialize within the equities of any of these companies that have Bitcoin on the balance sheet, right? So I'll take MSTR for instance, right? Can reflexivity happen on just the equity, like to be localized to equity? Absolutely. And the way it happens is like if Bitcoin goes up, MSTR tends to go up quite a bit more, right? It's like a convex version of Bitcoin. And then from there, you're going to have options markets that are on that MSTR equity. And there's going to be like these second order Greeks that start moving into crazy parameters. And at that point, it forces other market participants to have to buy. And I'm, of course, referring to just options market makers, like their default behavior when they have to like hedge out the risk that they're dealing when they trade these contracts. So when you have a huge amount of call demand, right, a lot of directional options traders want to buy calls, for example, well, that actually creates this impact wherein the dealers, the market makers, have to hedge in the spot market, and then they will be buying shares. So these kinds of things definitely happen, and the chance of them happening and the magnitude of a move becomes much higher during those kinds of isolated instances. So, and that's another form of reflexivity. Like certainly when we're talking about a short squeeze or a gamma squeeze or anything like that, like that is definitely by definition reflexivity, right? So that's kind of how I would answer that. Like I wouldn't say reflexivity on the Bitcoin side is something big right now. It's certainly possible in the future within much smaller assets like MSTR. Obviously, MSTR is much smaller than Bitcoin, right? Yeah. So within smaller assets like MSTR or maybe ASST, like that totally can happen.
I want to talk a little bit more about strategy, well, particularly MSCI. Real quick, Marshall, Allard, could you talk a bit about what MSCI is, what the recent decision they made is, and kind of go back to how BFC engaged MSCI earlier this year, and why we're even having a chat with them in the first place? Allard.
Oh, that was for me. Okay.
Yeah.
Okay. Yeah, like I guess with MSCI, it started off with like this was around end of last year where they were saying like, hey, we have a consultation on digital assets. And at the time, they specifically called out digital assets and companies that were holding digital assets on their balance sheet. And I mean, at BFC, like what we did were we basically gathered together a coalition of entities, like including corporations, like DATs, institutions, and like individual retail investors. Right, we had a huge like signature sheet and everything, and we really petitioned against that, and ultimately we won. Like they decided to like withdraw that consultation, and basically digital asset treasuries were not affected by that consultation at the end of that conclusion. What's happened?
Real quick, explain for someone listening that doesn't know anything about MSCI, just real quickly, what MSCI is, and then what decision they made and how they kind of course corrected after we, along with Strategy and a lot of the other partners, petitioned with them against that decision rather.
Sure. MSCI, it's like what Morgan Stanley Capital International. They are a pretty big, like they're like very central to financial services, and especially within the context of financial markets. So one big function that they have is creating these indices for tracking the aggregated performance of different assets, right? So they'll make equities indices, for example, and within an equity index, you obviously have a bunch of equities from different companies. And one thing that they were thinking about doing, which is the topic of this discussion, is they were thinking about like having a clause within their index construction that would cause companies that hold digital assets on their balance sheets to be immediately removed from index inclusion. Now, there's obviously some thresholds within there, so I'm not going to go into the details of that. I don't completely remember the details from like last year. But at the end of the day, like what we did is we basically gathered together the folks in the industry that would be affected by something like this, and we were able to push back against that, right? So we made an argument based on, well, first off, the main argument we rolled with was just like, okay, it doesn't really make sense to just single out digital assets because you have certainly other assets that can be on the balance sheet and other assets that are not being singled out by this type of consultation. So like that was the main thing, right? Like not singling out companies just based on the composition of their balance sheet, which has never been done before. Like it's frankly never been done ever. And also they basically, through that consultation, if it had gone through, they would have effectively created a new classification of companies. Let's just call that classification DATs, okay, digital asset treasuries. And this classification would have been unique because if you look at how finance and capital markets has always been done, companies have always been classified based on how they generated their revenues. They've never, ever been classified based on like what they have on their balance sheet. It's never happened, right? So you might have heard of like GICS, right? Now GICS is basically the sector classification of a business. And there's like traditionally 11 sectors in the economy, right? So you have like financial services, you have technology, you have industrials, materials, real estate, like those are sectors, right? And all those sectors are based on, okay, this is the core business someone does, and this is how they generate money, right? So that's revenues. So you're always classified based on your revenues. You're not classified based on what you have on your balance sheet. So by them trying to do something like that, they would have created this brand new classification, and it just doesn't make any sense because it's never really happened like that before. And then, of course, the final thing is, hey, if these companies are legally corporations, like legally C corporations. Like, why are you trying to why are you trying to basically go against the law and say, oh, they're not actually C corps, they're actually investment funds, when they're not legally investment funds. So those were kind of the structure and rundown of our arguments, and I think they were very strong arguments and very sensible arguments, and so that we ended up winning for that one.
Mason, so for companies like Melius that have, you know, an underlying core business that, you know, functionally operates outside of the Bitcoin space, but then you also have this treasury strategy. I'm curious, what are your thoughts on, you know, MSCI and how they view, you know, what they call DATs? You know, do you think it's short term? Does this hurt, you know, the Bitcoin operating business space? Or is it a long-term view? It's like, doesn't really matter. We're going to keep building and keep, you know, focus on, you know, what we set out to do with Bitcoin.
Yeah, I think the latter is true. I think long term it doesn't matter, but it is a kind of arbitrary attack on Bitcoin and companies who want to store their value in Bitcoin. And I think, you know, a lot of the companies that they pointed out actually, and I think a lot of their reasoning was they don't have operating businesses, and that's just fundamentally untrue. And you can't classify what is and is not a operating business. Like Melius, we have a cashback service in Brazil for e-commerce, and we have 54 million users. Strategy has a ginormous software business, ginormous relative to, you know, every other software business in the world. Maybe not Microsoft, but still it's a multi-million-dollar, if not billion-dollar software business. And then a company like Strive, sorry guys, there's an ambulance or something going by. A company like Strive, they are selling, and now Strategy, of course, they are selling a financial product, and that is their preferred equity. And it's not a typical product, but it is a structured finance company in the same way that an insurance company is selling you a contract. The preferreds are a different type of model, but they are still an operating company. They are raising capital and have liabilities and have obligations and shareholders, etc. And then they also have a asset management business. So no matter how you slice it, there is still some like fundamental operating business, but it is also kind of a maybe a little bit hard to comprehend at first what these new models are. And sure, there are some actually I think a lot of the other Bitcoin treasuries, and there's now kind of a sea of them, do have some kind of business attached. Like Nakamoto or Naka has UTXO and the conference, I guess that's BTC Inc. and BFC, which we are currently hosted on. And so I think a lot of these tax are incredibly arbitrary. And honestly, I think any rational participant, outside observer, is going to side with the quote unquote DATs every single time. But again, I think long term, this is not a big deal. It's just kind of a growing pain of trying to be understood by the market and maybe having some enemies for whatever reason. They maybe just don't like Bitcoin or crypto broadly. And that's okay. But I think we will win, and history will look upon them as kind of we'll look at them poorly as kind of anti-innovation.
Yeah. So is this just a misunderstanding of what, well, is just them not understanding what Bitcoin is? I mean, Allard, you had these direct conversations. Do they get Bitcoin? Do they understand? And I guess the follow-up question is, does the broader finance, institutional, traditional finance understand Bitcoin?
Yeah, I mean, okay, so when I talked to them, right, like, frankly, it was a good conversation. They really just wanted to hear us out. I did not sense any kind of antagonization against Bitcoin or anything like that. I didn't even sense any like sense of like snobberiness, like they're looking down at Bitcoin or any contempt whatsoever, right? Like, so I just want to be fair over there, right? And yeah, like I thought it was a good conversation. And the other thing is this, like I don't think the framing of saying like, hey, do these institutions understand Bitcoin? Yes or no? Like who really, okay, this is gonna sound weird, but like who really understands Bitcoin, right? That's a quite complicated thing.
You guys do. That's why you're on the show. That's why we brought you guys on the show. You're supposed to understand this stuff.
Oh yeah, I mean, like I think I understand many aspects of it. I wouldn't call myself a Bitcoin expert or anything, right? So like, what do we mean by like, do they understand it? I think at the end of the day, what benefits Bitcoin is more people recognize that this is a place that they can put their money for the long term. It's a long duration store of value asset. And also with the optionality of using it as a medium of exchange. I think that's also extremely important. And as long as like those two things are fine, yeah, then as more people recognize it, then that's good for Bitcoin. For a fund, right, for an institution, they don't have to understand it. Like they just have to like feel like this is something that they need to hold. If they feel that way, then we're good. You know, like we don't need to say anything else after that. Like I think then like we've already met the goal that we set out to do. When it comes to MSCI and why they would put out a policy like the ones that they've suggested, I think it really comes like I don't want to automatically jump to assuming malice. I think it could definitely be that there probably is like, let's call them enemies of Bitcoin that have a lot of pull and sway over things, right? But ultimately, like those aren't the only incentives that are present. I would say most of it is just out of a genuine concern to properly execute their duties as fiduciaries of some sense, right? Like if you're going to create an index and a lot of capital is going to follow your index, you better make sure your construction methodology is sound and at the very least agreeable to the average institution that's going to be referencing your index. Because if it's not agreeable, then, well, they're your customers. You have to keep your customers happy, right? So that's kind of where the incentives truly sit. And I think at the end of the day, it's not even that much of an education thing. It's like when some consultations might cross the line in terms of being unfair, which it did like last year when they first rolled it out because they were singling out digital assets. Then the industry, like we can push back on that, right? But if it's something more like, now, I think like now where the most recent consultation, like digital assets was not even mentioned in their deck. Like, I don't know if like anyone watching this, like if they go and actually read the deck, you won't find the word digital assets in there for that consultation. I'm talking about the second one, right? The most recent one. You won't find digital assets, you won't find crypto, you won't find Bitcoin. It's just not in the deck. Like, it's not meant to really call out one asset. And frankly, even though strategy and Metaplanet will be thrown out of the index, it's not just companies with Bitcoin on their balance sheets. Like they're also going to throw out one that has uranium on their balance sheet, right? So it's certainly not singling out something this time. So I think this time around, they're not doing anything that's clearly unfair, and so it becomes much tougher to argue. But that being said, right, like we still have like really good catalysts going on the Bitcoin side, and I do agree with what like Strategy put out, that ultimately we don't really need MSCI. You should just look at the numbers, how much of their shares is actually like tracked within MSCI tracking indexes. Like, it's not that much of the float anyway. So yeah, like that's where I stand on that.
Okay, I want to talk about, at the top of the show, we played a video about Metaplanet forming Superplanet. And so they seeded 2,100 Bitcoin into an American company. And so now they have two engines running, Metaplanet in Japan, Superplanet in the United States. I'm curious, Mason, what does this signal for Metaplanet, Superplanet? What are they trying to accomplish here by investing their Bitcoin in an American company?
Yeah. Well, I've heard Dylan speak before about the differences of the capital markets of Japan and the US, and he often points out, and I think it's broadly true, that the US is the best capital markets in the world, and it has the best regulation, and is one of the more efficient capital markets. And I think what this points to is that they view, I think the plan here is to create a preferred using this new entity, and that's why they seeded it with the Bitcoin, and create another type of perpetual, preferred or digital credit in the US to compete with Stretch and Strive. And I think it's great. I think it's great for the kind of broader ecosystem. And it also might point to some of the kind of regulatory challenges that they are having in Japan. I don't think it's quite necessarily that, but I think they are going to try to do both, operate in the US and Japan. And frankly, I think if they are able to do it, I think it's a great idea. I think we need more digital credit issuers, in the same way that there are thousands of banks, there's thousands of insurers, there's thousands of financial institutions. I think we need more providers of digital credit in the US. And I think Dylan and Simon obviously are great executors, and more than anything, they know what they're talking about. So I mean, Dylan's a machine. He knows more than 99.9% of people about this space, even people who are in the space. So yeah, I think it's really exciting news, and I think their timing is perfect. Hopefully they'll be able to get a preferred up in the next year or so, and hopefully that coincides with a bull market. And who knows, they might do something creative, try to differentiate themselves from Strategy and Strive. And what does that ultimately look like? I don't know, but I'm sure they're thinking about it deeply.
Okay. Allard, thoughts on recent moves from Metaplanet to form Superplanet here in the United States?
Yeah, I mean, I like it. I think what they're doing is great. I do think like a lot of the details here matter. I've been looking into it, and so it seems like they have. So I mean, they've seeded the U.S. entity with 2,100 Bitcoin, and then if they're going to issue digital credit from that entity, like the collateral base, I shouldn't call it collateral, but let's just say asset base, it will be only the assets within that entity, right? So it's not going to be Metaplanet's entire 43,000 Bitcoin stack. So that's one detail that matters. Like, to what extent do they actually back it up, right? So those things, those things we'll have to see the filings, and then we'll have to go through them, and we'll know, right? I think it's interesting that they got the warrants. So they have warrants to continuously inject more capital into it, and that's a good point of optionality that they have, and I think that was a good move overall. The idea of like, okay, so here's something that I kind of wonder. So this is something I do wonder about beyond those other things. This is going to be a USC Corp. So anytime you get money into a USC Corp, you can't really get it back out really easily. Now, of course, the argument is like this would just be permanent capital, and Metaplanet, the Japanese entity, holds 95% of like SLE's shares, right? So like they are 95% owner. And I guess over time, you can exercise the warrants and buy more shares. And of course, that would also offset the dilutionary effect from the common equity offerings that they're probably going to set up, right? So all of those things match up quite well. I wonder if, I expect that the angle is probably to just keep it there as permanent capital. And now Metaplanet just has another company on their balance sheet as well as the Bitcoin on their Japanese side. Certainly, if you were to liquidate, like let's say this SLE thing, this SUPA thing gets like really, really big, right? You couldn't then liquidate it and like bring the Bitcoin back to Japan without taking a huge like tax cut from like trying to move it out of the C Corp and like liquidating it. So I think that's one. It's basically saying like whatever Bitcoin or capital that Metaplanet commits to this thing, it's permanently staying in the US now. Like that's like something that I find to be quite interesting. Theoretically, the model is like, if you had enough Bitcoin, you could probably pull up anywhere and seed a mini MSTR, right? Like I think that's really what's going on at the end of the day. They're just seeding a mini MSTR. So now Metaplanet is basically like, not a one-to-one example, but Metaplanet is now like a Michael Saylor, and then they own a good amount of the shares, and then now like the Superplanet in the US that is going to start growing, raise more capital, and your wealth, at least on Metaplanet's balance sheet, that expands by virtue of the fact that Superplanet just gets bigger from its capital markets activities. So yeah, I think there's a lot of details to iron out there, but overall, it's definitely a very positive development, I'd say.
Well, we're at the top of the hour, Mason. Real quick, let's fast forward a year from now. How does Bitcoin look? How does it look for these Bitcoin operating companies? And what are we all driving Lambos in a year from now?
I think I said earlier, I think it's really hard to be bearish at the 200-week moving average. Yeah. I think historically that's been a great place to buy. And I think there's a lot of opportunities in the market for those who are paying attention. And is this time different? Potentially there can always be a black swan or something that's happened, but I think Bitcoin's been pretty beat up, and there's been signs that this is the bottom, with Saylor selling, the cold card attack, kind of a lot of infighting among the Bitcoin community around BIP 110, and then just general price capitulation, and then time. It's kind of the classic signs of a bear market. And one thing about Bitcoin is the bear markets are relatively short. I don't think we'll see a 10-year bear market. So yeah, I'm feeling bullish.
Where can our listeners hear more from you? Where can they learn a little bit more about Meluse and
Yeah.
how do they connect?
Yeah, if you just go to my X account at Mason Foard, Foard, you will see my page, and then you could click on the Meluse account. It's in my bio, and check out the website, read our earnings report, look at our deck. I think we provide a unique option to the market when it comes to an operating company, a public operating company, buying Bitcoin. It's a different risk reward than maybe some of the other treasury companies, but I'm really proud of what we're doing, and I think we're setting an example for not only the world but specifically Latin America, which more than most has dealt with severe currency debasement and a long history of it. So yeah, we're excited. We're going to continue to keep building, and really the thesis has not changed at all.
Allard, what about you? Where can our listeners learn more? Where can we read your reports and our articles?
Yeah, just go to bitcoinforcorporations.com. Also publishing on Bitcoin Magazine as well, and follow the Bitcoin for Corporations Twitter page. Like that's, I'm gonna put out more content through that. Yeah.
All right. Well, gentlemen, thank you for joining me today. Appreciate the conversation, and yeah, I hope you guys have a great rest of the week.
Thanks, Jake.
Yep, you got it.
Bye, guys.
It does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential.
And to kick us off, I first wanted to start with the question of, there's kind of three different pieces here. There's the asset manager, there's the investment bank, there's the custody provider. And for the past, I don't know how many years, I think ever since I've been in Bitcoin, people have been saying the institutions are coming, the institutions are coming. And it feels like the three of you represent the institutional stack of Bitcoin. So my first question would be, what are the institutions waiting on at this point in time in order to enter our market and our industry?
I'll go first. So I'm Chen. I'm the Chief Revenue Officer at BitGo. We are one of the world's largest infra companies for everything digital assets related. Been with the company for about 6.5 years, so seeing a lot. In terms of answering your question, I think it hinges a lot on the passing of Clarity. Clarity Act needs to go through. We have midterms coming up in November. Who knows what's going to happen after November? So we have only a few months between now and then before Congress goes into recess, and that thing needs to be passed. We are obviously in conversations with many, many banks all around the world, here in the US, and most areas around the world. And here in the US specifically, there's a number of banks that has a bunch of folks queued up. They have a plan ready to go, do a lot of tokenization work on chain. It hinges on Clarity. Around the world, what's interesting is the regulators, especially in the larger tier 1 countries, they look up to the US for guidance. Whatever we do here in the US will get propagated around the world. And if we're able to get Clarity through before the midterms, it's going to unlock a lot of business around the world as well. The last thing I have to say is Brian Armstrong, man, like it was going to go through a couple months back. It's all public information. And the guy and his army of lobbyists in Washington, D.C. did not like the couple of lines that they had in that version of the act, and pulled the strings and pulled it off. So I'm very disappointed at what happened a few months back. Hopefully we can regroup and get this thing through as soon as possible.
So maybe I'll jump in here. Definitely agree with those comments. I would say from our side in investment banking and bringing new product to market, new issue, it's certainly supply. Like we need more supply. We need more people in the good parts of the environment being innovative and hitting the scale that's required for those institutions to be able to buy into that, both on the common equity side as well as digital credit. The easiest way to play that, if you didn't have scale previously, were converts. And we've seen a lot of people do that, including yourselves, right? But I think that the superior product is certainly digital credit and the perpetual preferred product, because it's better asset liability matching. It just has the carry trade that's affiliated with it. It makes sense, right? And it's defensible in terms of your balance sheet over time. There's a lot of debate about that right now, and certainly strategy, having a mixed balance sheet is clouding the dialogue around that specific situation. I would say if you think about, okay, well, what's holding institutions back besides availability of investable issuers, right? Which is a real, there's not enough, right? Strategy, we did 5 prefs in 1 year effectively for them. And a lot of institutions got excited about it. Institutions were there and looked at the first one, maybe turned it down, came into the second one because it was so successful. And we kind of built on that success over time leading up to stretch. There's still fundamental constraints, though, that exist, like lack of ratings. Lack of ratings takes a ton of institutions off the table. People talk about like huge pockets of capital in insurance and asset managers. Well, they're still antiquated with respect to how they look at their investment thresholds. And if you can be put into buckets that mean love it, understand it, but can't do it because you don't have a rating. And we tried to work with Saylor and team and everyone else to break down that wall back in 2005, but it was just not possible. So I think there's some structural constraints that still exist within these asset managers, both in terms of accepting Bitcoin as an asset class, as true collateral. There are things like ratings and other areas where we're working hard. The regulators, I mean, that's the one thing that's moved in our favor, absolutely. So that's been extremely helpful.
Yeah, great comments. I would just add, and I think it's really interesting that we got grouped by the first letter of our company names, because I actually think that introduces like a nice little mix of perspectives to the dialogue. But obviously, BlackRock's a large asset manager. We manage $0 of digital assets for clients as recently as 2-3 years ago, and now we manage 130. Maybe it's lower. Got to check the screens. Right, but the largest product that we have is, of course, the iShares Bitcoin Trust IBIT, which was launched in early 2024. When it was launched, the rough demand was roughly 80% retail and 20% institutional. And over time, if you think about it, come into today, it's become roughly 50-50. So I would say the institutional adoption has actually been increasing. It's great progress. Obviously, we're in the early top of the first inning. There's a lot more work to do. And some of that is a combination of regulatory clarity as well as infrastructure build out. And they're kind of hand in hand, right? To echo Chen's comments, I think more regulatory clarity is going to be what drives the progress from linear to exponential. Even with a delay to that, which would not be good, I think the adoption rate and the growth continues, just at a more linear-like rate. Because a lot of things need to be built in terms of custody, in terms of wallets, right? A lot of people use IBIT because the ETF wrapper is actually easier and more familiar and more plug and play. But all the folks that we speak with in the ecosystem, whether they're crypto native or TradFi, are increasingly building for this future. So it does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential.
So I want to start with the first question for you, Will. You just launched a new ETF. Congratulations on that. There is some level of competition between, let's say, the role that Treasury companies and DATs play in the capital markets ecosystem, and what their options chains play, and et cetera, and the products that you are launching. How do you think about the interplay between launching new wrappers and competing with the Treasury companies that are out there in the ecosystem versus working cooperatively with them?
Yeah, absolutely. Thank you for bringing that up. So we launched our BitA ETF, which is a Bitcoin covered rates option ETF last week. anything that BlackRock launches, we do because of client feedback. We're a very client-centric, client-led firm. And one of the things that clients have articulated is, I am interested in Bitcoin, but I sure would love some way to generate income, and I would like some sort of downside protection. And we can wrap it into one for me, that would be great, right? So I would say completely different product and completely different lanes than what a lot of the DATs have been issuing. Also, BitA, I think we have seen a lot of success in its first week. We're sitting at $30 million of AUM, right? So if we can ever even get close to some of the other credit products, we'll be very proud of that. But again, I think it's just an evolution in the market structure for Bitcoin, right? From the very early days where it had no derivatives to then obviously the early days of perps, and then cleared options, and then the perps really adopting, and then all the ETPs launching in early 24, and then the options, and now having these other maturing things are just ways where that market structure gets more mature and gives you more options, right, for others to come in and build different types of product. Volatility on Bitcoin used to be habitually above 100% realized. And today it's kind of down to this kind of 40 to 60, hovering around 50% range. And I see that as progress, right? I see that as a sign that the ecosystem is maturing and allowing the traditional institutions to come and say, okay, this is an asset that we can work with and create more products and create more creative ways to give clients what they want.
So I want to come back to that topic in a minute, but Lee, I wanted to talk to you about STRC, and I think that that's like the topic du jour of the moment. You worked with Strategy to help design that product. We had a discussion last night about it. Now that we're getting into what I would call the edge cases of the product, like the product in the non-normal circumstances, how would you conceptualize or think about the key mechanics of that product and what matters to the market? And what would be your advice to treasury companies, several of whom are here that I know are working on pref products, whether or not they've been announced, on how to navigate the uncertainty of the current moment?
Thanks for the easy question.
Yeah, it's a softball.
Okay, so I've got my own opinions. Listen, I do think it's a groundbreaking product. It is an iPhone moment. I've talked about it before. I know Saylor is passionate about the product, but as with all new products, you just don't know what to expect as the product matures. And that is not a mature product. Let's be totally clear. I mean, it's, maturity in financial markets takes time. And you need to go through these events. You need to be tested. I would tell you that we do stay in very close communication with them and Strive. We also help with SETA. We felt really good coming out of the Iran conflict that both of those securities did exactly what we would hope them to do. They were a safe haven, they were yield, they went to par above the ATMs issuing, et cetera. And the yields made sense, I think, just still given the early nature of the issuers, less so Strategy, obviously. But, I think that Strive is a good example because you can look at the leverage and amplification on a smaller company like that and still see it hold in nicely. That's working. So it was working. What we've seen here is there are other structural factors that are playing into why it's trading down below 80. I mean, look, in the mid 80s, we IPO'd these things at 80, 85, 90, whatever it might be. So could it go back down to the original IPO price? Of course. I mean, IPOs do that all the time. We're seeing SpaceX broke, right? So there are factors that could lead you down. But I think, unfortunately, we've hit so many people so quickly had put leverage on the instruments, or you got retail buying it on margin. And I don't think retail fully understands the product. So we've got some other issues that are forcing us to go below 80. And it's it's unfortunate, but it's a learning experience from my standpoint. And I do think that, we're all hopeful that Michael and his team will come out pretty soon. They'll have an AK on Monday with a very strong message about, confidence. I mean, this is not a credit problem. And we talked about this last night. This is not a credit problem. And by the way, taking the yield to 15% or 16% also is not going to get it to trade to par. This is just a structural trade-off and test the security. And everyone needs to take a deep breath and sit down, and Michael needs to come up and say, listen, this is not a credit problem. We have a fortress balance sheet, right? Sure, the converts are coming due, but I'm here to tell you as Barclays, we can refinance those converts tomorrow. I mean, our hedge fund clients that technically price converts would love to come in at $85 on the stock price right now and restrike a convert. That's not a problem. The put, all that kind of stuff's not an issue. You can refi all the convert debt, and Michael can come out and say all of this. He could choose to do other things too, right? I mean, he's raising cash. You saw in the last 8K last week that he actually sold equity. He could, who knows what he's doing? We'll find out on Monday. He could be selling cash. He could be doing other things, right? And he could raise cash. And they could also, look, the concept of a buyback is a very common concept in all other areas and products. It's just for perpetual stock, because it's such a novel new product, has not been rolled out. And so, a buyback is also a very logical way to support a security like this. By the way, it's not a bad financial trade to be buying it back at 75 when you issued it at 100 and then reissue it at 100 3 months from now, right? But I think specifically, I don't think it's buybacks that way as opportunistic and financial engineering. I just think you're supporting a new security that's out there and it's going to experience some bumps in the road. And you need to know as a Treasury, when is it moving in a zone where we could hit a leverage trigger? Don't want to go there. We went there. So I think that we should take this experience and say, this is not a problem. There's structural dynamics at play. And I think the learning experience going forward is, do you have other tools in your toolkit as the issuer, Strive or Strategy or future issuers, that will allow you to structurally support that security in these periods of uncertainty?
If there's one great thing you can count on from the crypto market, is that if you design any product and you draw a line of do not cross this line, guarantee that
we're going to cross it.
Right.
We're going to definitely cross it.
So Chen, I want to ask you in a different direction. Y'all have been custodying Bitcoin for a long time. Y'all are dealing not only with the wrappers of Bitcoin like Blackrock or different ETFs, but you're dealing directly with the corporate treasury teams that are holding Bitcoin directly with you. What has had more success in terms of corporate adoption, going through wrappers or holding it directly? And what's the biggest hurdle you see with getting someone to actually squeeze the trigger and put 2, 3, 5% of their treasury into Bitcoin?
We have a very diverse set of clients. We do work with a lot of DATs. We do work with ETFs, and we do work with a number of OG Bitcoin hodlers. We're talking like 2010, 2011, 2012 folks that have kept Bitcoin with us for a very, very long time. There's also this cohort of people, the wealthiest family offices in a lot of the major countries around the world. They're waking up to this asset class and they're looking at options. I have to say, one of our competitors actually is iBit. There's a number of folks thinking about, what they can do with the Bitcoin they currently have at BitGo. And to be very frank, we had some customers go the other way, meaning they're taking it out of BitGo, they're moving it over into his product, and it's unfortunately going to Coinbase, I believe, underneath. The thing I want to stress about this entire thing is fundamentally, Bitcoin is a bearer asset. You lose the keys, you're done. And maybe I shouldn't say this on stage, but having Coinbase have, 60, 70, 80% of all the Bitcoin floating around in the traditional financial space, it's frankly dangerous and not responsible. So you should look at other custodians. There's plenty of other custodians floating around, and diversify where all the Bitcoin is currently being held. If Coinbase messes up, we're done. And we cannot have that fundamentally.
We're all friends.
A powerful statement. I mean, to BitGo's kudos. I don't know of another custodian that's been around as long as y'all and Coinbase that has the track record y'all have. So, well, I want to kind of end on this question, which is probably the number one question I get as a non-capital markets person. I'm a Bitcoiner, putting on a costume of a suit to go to an institutional finance event. But the everyday Bitcoiner tells me Blackrock, Barclays, maybe less so BitGo, but these are the firms that Bitcoin, was created to destroy. We don't want these, traditional financial firms entering into the Bitcoin market. They are domesticating Bitcoin. What would be your response to that?
Yeah, I'll just say a few things, right? I think number one, we repeat this with every opportunity we get, just to set the record straight that we don't own the Bitcoins, right? We are a provider of a wrapper so that folks who, frankly can't even open like OpenAI or adopt any of this new technology can have exposure to something that they have been educated on and are excited to participate in. So we kind of see our role as being able to bring more people into the philosophy, the belief, the asset, the growth of Bitcoin, right? Now, the fact that they're all concentrated into a single wrapper is one question. But again, if you look at the number of holders on IBIT, there's more than 1,300 that report on the 13F, right? And for many of them, they represent thousands of other individual holders. When a retirement or a pension or a foundation holds IBIT, they're holding that exposure on behalf of a lot of people. So we kind of view it as an opportunity to allow more people to come into the ecosystem, and we don't view our role as someone that's kind of trying to centralize what that represents, right? I do think there are certain instances where if you look, for example, at the quantum risk, right, which a lot of people talk about today, there's an educational process that we can be a part of, right? We're not going to be influencing or controlling whatever the outcome is. But there are ways to coordinate and to help other people see how we can kind of come together and solve that problem. So there are ways to work together. I think at the end of the day, we're all on the same team, right? We want to see this asset thrive. We want to see it become more important and more relevant in the world as it has been for the last 15 years. And we're part of that journey.
I have heard some cool stories about Larry Fink and his journey into Bitcoin, and I've been impressed by how y'all have done it so far.
I think we all know that he used to call it pirate money, but I think the mental flexibility to look at the facts and come around is something that we should all applaud and commend.
100%. Lee, what's your take on that question?
Yeah, I'm not going to answer it directly as asked. I'm going to ask it in terms of what Barclays, as an investment bank, is doing in the context of that question. And at our heart, we are trying to continue the mission of Bitcoiners, right? In the corporate sense. We are helping new and existing issuers that want to go acquire Bitcoin have access to the institutional bid and bridge that gap, because there's a language barrier in many cases, okay?
Huge language barrier.
Yeah. And so we're believers and we're on your side. And what we're trying to do is we're trying to crystallize the bid in a way that works for everybody, right? And so that's effectively what we're doing. And I'll just to put it in perspective, because there was a panel a couple before this, and someone was like, well, Stretch is 80% retail and 20% institutional. Actually, no. Every single one of these IPOs is 80% institutional and 20% retail. Why? Because retail needs the validation, particularly of these new products, but they need the validation of the management team, that we've done the diligence and everything else. And then retail will come over the top, just like it's a SpaceX IPO, right? And smother that instrument and take it to where it needs to go. But the institutions are the starter fluid and the validation factor. So they're super important in that regard, because their due diligence and their structuring and their one-on-ones that we do, we don't just roll the product out to the public. We wall cross Blackrock. We wall cross 10 to 15 of our top accounts, okay? And have very deep conversations around what you want as the issuer. We've already got it all written on paper, like this is what we really want, okay? But we know there's going to be some level of concession. Maybe the cash reserve. That came out of one-on-ones with Strive. Cash reserve was not on the table in the beginning. Didn't want to give it up, not interested. You know what? At the end of the day, it was the right thing for both people. And look at it now. Strategy put the cash reserve in after their Stretch IPO. And it's one of the main factors of supporting that security today. But that came out of the institutional due diligence and the banker and the issuer all coming together in the beginning, and then retail, and then further adoption and success and everything else. And that's pretty much how the model works from our perspective. Yeah.
Shone?
I'll be quick. I mined my first Satoshi December of 2012. I was part of one of the Seattle Bitcoin communities way back when. We met at a coffee shop every weekend to talk about Bitcoin. Those were the good old days. And when I first showed up, I worked at Microsoft. I had a tucked in collar shirt, and all the libertarians in the room were looking at me funny. It's like, who are you? Oh, big corporate is here. We've come a long way from those days. And I would say you have to pass the institutional hurdle for this to be truly adopted by the world. I would also say, on top of the institutional demand, there is demand from actual governments around the world. We're talking about the US Strategic Bitcoin Reserve. We're talking about basically the El Salvador playbook smeared across as many countries as possible. BitGo, we do a bunch of hardcore technology for securing Bitcoin. We're working with a number of these countries right as we speak to help them set up what effectively is their own version of a digital Fort Knox. The infrastructure needs to be there, both at the institutional level and at the government level, for us to truly take this to the next level. It's been many, many years since '09. We have many, many decades to go to get this propagated around the world.
Not to answer my own question, but I always take the view that Bitcoin's the same Bitcoin before any of the people up here bought it.
That's right.
It'll be the same Bitcoin tomorrow. But I think Blackrock after buying Bitcoin or Barclays after buying Bitcoin is a little bit different of an organization than they were beforehand. So it's like unleashed capitalism. So anyway, I thank you everyone for being on this panel. Give them a round of applause.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin Corporation, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Most people know, don't save in dollars. I think Saylor, there was that meme that he said, we have a word for them. We call them poor, I think he said. So people don't know that. So then it becomes okay, then what do I put my money into to hold that purchasing power for me? So then is it sort of then we have to look for the next best thing? And so then is it gold? So you mentioned gold's been that store of value for all time. Of course, obviously Bitcoin, you wrote the Bitcoin standard. So is it then we need to find something that then holds that purchasing power, but it's really all about a means to a potential end and not the end itself? Meaning a lot of people today make it seem like Bitcoin is the end, but is Bitcoin just one of the means to the end?
Yeah, I mean, money is a medium of exchange. The whole point of money is that you exchange it for other things. That's why everybody wants money, because of the things that you can exchange the money for. But the point is that you want your money to be good at this job of exchanging, and in order to be good at it, it has to hold on to its value over time. And the problem is that wherever else you take your wealth away from the money, it's still going to suffer from the same problem that the money has, which is that there's going to be somebody out there who's going to figure out a way to make more of it. So historically, people move away from gold, and then the next thing they get into was the saving account. Well, you put your money into the saving account, you beat inflation because the interest rate that you get is higher than the inflation. But that stopped working because, well, you know, the whole point of inflation is to finance government. So if everybody can beat inflation, that defeats the purpose. You can't have everybody beat the inflation game, just like you can't have everybody win at the casino. If everybody wins at the casino goes out of business. They can't keep running it as a charity. And I guess that's a good way of thinking about your central bank. It's not out there to make you rich. It has to, the purpose is to take your purchasing power and give it to the government so that the government can murder foreigners and enrich cronies and do all kinds of crazy things that they do.
Yeah.
So if everybody finds a way out of this, if everybody can beat it, then whatever it is that they beat, whatever it is that they used to beat, that is going to be provided in an increased quantity eventually until it stops working. So that happens with savings accounts. Interest rates then go down on saving accounts, and then you can't beat inflation anymore. So then people move to government bonds, and that also same thing happens. People move to government bonds, and it's like moving into an easy money. It's like people moving into copper or moving into something that's easy to make. If everybody tomorrow decides that they wanted to use copper as money, it's just going to mean that copper miners are going to make enormous quantities of copper and dump them on the market and bring the price of copper down. And the same thing happens to the government bonds. When everybody uses government bonds to save, that gives governments far more credit than their fiscal and monetary situation should entitle them to get. And then that, of course, is the mother of all malinvestments. The governments end up spending tons of money on all kinds of stupid and crazy and criminal things. And they eventually, one way or the other, they're going to destroy the value of the wealth that's stored in the bonds, either because the value of the money in which they repay the bonds goes down, or because they default, or both. So it stops working with government bonds. And, you know, now we're in a kind of golden period for stocks, particularly stock indices. They seem to be working fine as a way out of this. But that one, too, I would say is kind of risky, because if everybody in the world can just buy Apple and Nvidia stock or buy the NASDAQ or an S&P, then again, that's going to mean that the inflation game doesn't work. And how do you keep the thing going? So at some point, I think there may be a crash in the market, because monetary policy can't continue to be accommodating, because if it continues to be accommodating, it just leads to more and more bubbles, and it leads to more and more inflation to essentially beat these, more and more inflation to finance government and to allow government to finance itself. So I think what you want is something that cannot be inflated, whose supply cannot be increased. And that just gives us two candidates, really, realistically: gold and Bitcoin. And gold has a supply that grows roughly at around 1.5% to 2% per year, and has always been like that, just because of the chemistry of gold. Gold doesn't ruin, so we're constantly accumulating all of our gold supply over the years and decades. And that then results in the fact that even as we get better at making gold, we're just piling on to an ever-increasing pile. And so our production goes up every year because we get better, roughly. A little, more or less, it goes up every year. And the stockpiles that we have are also growing. So the rate of the new production to the existing stockpiles, or the stock-to-flow ratio, the rate of production stays constant, or the stock-to-flow ratio also stays constant. So, but it stays around 1.5% to 2%. And I think the problem with gold is that ultimately the world has already got a lot of gold. And so everybody, well, not everybody, but I mean, there's about $25-30 trillion of gold held around the world by people in the form of jewelry or in the form of monetary gold. And that just means that it's already highly monetized, but it can't truly function as a form of money because it doesn't have a banking system. And in a modern world, you need money to travel quickly. You need to be able to spend your money as fast as your goods travel. And so this became a problem for gold in the 19th century because of trains and ships and cars moving things around quickly. And it meant you couldn't just keep moving gold back and forth between partners. So you had to rely on bank credit, and bank credit effectively became the money. And that led to the growth of the banking malinvestment boom of the last century and the central banking malinvestment boom of the last century. But Bitcoin really is the solution as far as I'm concerned, and I continue to stick to it, no matter what happens and after every crash. I still think Bitcoin is the one that really delivers on this because Bitcoin, A, has a lower supply growth rate than gold, so it grows at a lower rate than gold supply. And 2, which might even be more important, you can actually have clearance of Bitcoin internationally very quickly without having to go through government institutions and without having to go through highly centralized central banks. And so Bitcoin is far faster than gold. And therefore you can continue to have a free market and you can continue to use gold as money, even as its value grows and even as the demand for it grows. You still don't need to have one central bank to manage all the clearance, as was the case with gold.
Michael, since your May 5th earnings call comments, odds that Strategy sells some Bitcoin by year end have spiked from around 30% to 84%, and odds of a sell by June 30th are at 66%. Critics say stretched dividends and a narrowed MNAV premium are forcing your hand. How wrong is the market?
I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. We'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those 4 instruments. Any model that we put together that's limited only to equity or only to credit or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. And what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now? And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions. And we do it in a very thoughtful, programmatic fashion where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin Corporation, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
He helped break the Bank of England for $1 billion. He made another $1 billion shorting the yen. Now he runs the US Treasury. And the yen is his to save, but he can't. That's your problem too, because Japan is the largest foreign holder of US Treasuries. And when the biggest bidder steps back, then somebody has to replace him. And the price of a new buyer is a higher yield. And that's your mortgage. That's your 401k. Now, last month, $87 billion was spent in just 2 days, the largest currency defense ever recorded. And it only bought 5 trading sessions. And then all it took was one jobs report that cost no dollars, and it undid almost all of it in a single morning. Now, Scott Bessent made 2 fortunes proving governments don't lose these fights when the vault runs dry. They lose when the defense costs more than it's worth. Now, Japan just hit that price. There's one number that tells you when this breaks wide open. Right now, it's reading 0. But in this video, I'm gonna break it all down. I wanna show you the choice that Japan can't afford to make. What's actually in America's war chest, because it's nowhere near the number you've been told. And we're gonna look at the Thursday number to watch, so you see it all break open before the market does. You ready? Let's go. All right, now before we jump into this video, let me just tell you why I think this video is not just important, but it's interesting. Now, first of all, we have Scott Bessent, who's made $1 billion multiple times from shorting currencies, now trying to save a currency, and he's using the same playbook. Now, I don't think I'm gonna make $1 billion, but I wanna understand the playbook so I can get on the same side as him, number one. Number two, because we're talking about defending currencies. So in order to defend a currency, it takes money flows. I have to sell certain assets and buy certain assets. And if I understand what assets are being sold, what assets are being bought, and then I can understand the playbook that Scott Bessent made to make $1 billion twice in a row, then hopefully I can get at least a part of that trade, and hopefully you can too. Okay, let's break this down. Currency defense, it's been happening over 5 days. Now, what we're seeing right now is the weakest yen since 1986. It's been about 40 years. Now, a lot of you are like, why do we even care about the yen? Well, there's a lot of reasons we care about the yen, which we're gonna break through in this video, and it all matters. So why the weakest yen? Well, like I said, it's 40 years it's been, or it's the weakest it's been in 40 years. Now, there's a couple times in history where we've seen some massive intervention, not just with Tokyo and the yen, but with the United States. Just look at this chart real quick. Here we go all the way back to 1987. So from 87, we saw the yen getting stronger. It was sold back down. It was pretty weak through here. It got really strong. And right about here is where we're going to pick up this story. And we can see that it's been cascading ever since, obviously bouncing around a little bit. So we can see that the yen, it's been strong, it's been weak, and it's the weakest it's been in over 40 years. But we saw all of a sudden both Tokyo and the United States coming together to try to save the currency. Japan's been doing it on their own. Now the United States is coming. So on 7/30, July 30th, Tokyo started to intervene in the markets, trying to keep that currency propped up. The next day, the United States started joining in. Now, it's important to point out that this is the first time that the United States has gotten involved trying to prop up the Japanese currency, the yen, since June of 1998. All right, so it's a big deal. It's been a long time since the US has done this, and it's interesting to think about why this might have happened. Now we can just see, here's a chart that we made. This is the US dollar against the Japanese yen. And we can see this is just going back to July 20th, and we can see it's been sort of trading in this alone here. But we can see here back to July 30th is when Tokyo alone was trying to intervene in the markets, and you can see it dropping. Here we have the US starts joining in right around here, and they started bringing it back up just a little slowly. And unfortunately, we got this August 7th, the jobs report, and started smashed it again. So we're really trying to get this propped up. And as you can see it's been struggling to get ahead. Now look at this. This is the biggest one-day defense on record. What are we talking about defense? Well, we have to either buy or sell the currency, right? Supply and demand. There's more buyers than sellers, et cetera, right? And so the defense of the yen is to buy it to make it strong. If I sell it, it makes it weak, right? So this is the biggest one-day defense on record. Here we have October 21, 2022, 5.6 trillion yen. 2024, this is 5.9 trillion. 2026, April of this year, 6.2 trillion. And now just July 2026, about almost 8.5 trillion yen. Now this is about 60 billion US dollars. But notice this is just all in the last 4 years. So the biggest defense numbers on the yen in history have all been happening in the last 4 years. And if you notice, they're starting to happen more frequently and more frequently and more frequently, which means that the yen is continuing to get weaker and weaker and weaker. 87 billion, the largest defense on records. And with all of that work being done to prop it up, like I said, it just took one jobs report to smash that back down. So we are $87 billion was spent here. And then the jobs report cost zero. There was no defense needed. That was just reality. It's the reality of the economy. And no matter what the intervention is doing, it's smashing it back down. Now, it all comes down, as I said, to one number. We're gonna come back to it then, but we're talking about this Fed report, H41. I'm gonna show you what that Fed report is and why you should be watching it like I am. We're gonna come back to that. Okay, now let's just jump back to the man himself for a second. I'm talking about Scott Bessent. Scott Bessent isn't just the US Treasury Secretary, which he is. He's the man that's in charge of selling US debt to the world, the largest, deepest, most important financial asset in the world, the bedrock of the global financial system. But Scott Bessent has been playing this game long before he got to be the Secretary of the Treasury. Scott Bessent has been around some of the biggest circles. As I said in the intro, he's made $1 billion twice. All right, what are we talking about? Let's go back to September 1992. This is when George Soros got famous for making $1 billion in a single day by breaking the Bank of England. He broke a bank. How? By fighting against the currency. This was known as Black Wednesday. Look it up. The big day, Black Wednesday, they broke the bank. Now, this was George Soros under their London fund, okay? Now, a couple other names that I've talked about on this channel quite regularly. So George Soros Fund, the London Fund, Stanley Druckenmiller, or Druck, we call him the GOAT. He's the greatest of all time, the best track record, no losing years, all those things. And Scott Bessent, he was 29 years old at the time. So George Soros, now, George Soros politically, there's a lot of reasons why we should not like him. But financially, he's made a lot of money. And so we want to understand those things. But Stanley Druckenmiller is the GOAT. And Scott Bessent, young, 29, executing this trade, again, made $1 billion in a day. Now, what they were doing is they were watching Britain's and they were watching the Bank of England's reserves. They're looking at how much money they had to defend their position. But Bessent, Scott Bessent, he was doing something different. He was watching something completely different, a different number. What he was watching specifically was Britain's variable rate mortgages. See, in the United States, we have 30-year fixed mortgages, but the rest of the world, they don't have that. And so Britain had variable rate mortgages. And what was happening is, as the Bank of England was trying to protect their pound, they kept raising prices. So at 9 a.m., the rates were at 10%. By 11 a.m., just 2 hours later, they had to raise to 12%, trying to protect that peg. Here we are by 2:15 p.m., they got to 15%. And then before it even got implemented, they canceled it and it round tripped all the way back down. Why? Well, the reason why is because while it was trying to protect their markets, they were crushing the consumers. So the rule, all governments are always going to be forced to abide by this rule, is they're always going to have to make a choice. It's always going to be sacrifice one to save the other, right? And so in this instance, back in the Bank of England, they either had to sacrifice the pound, save the currency, or they had to sacrifice the homeowners, the households, the consumers. So they voted to let the currency die, the currency loses. What does that mean when the currency dies, the currency loses? That means it gets devalued. That means they have to print so much of it that all the existing currency buys you less and less and less. So it looks like price is going up, but it's just because they printed so much. The currency loses out in order to save the households in that instance. Okay, well, let's just look at one more playbook, because Bessent didn't just do this once. He's the mastermind architect of all kinds of foreign currency games. He made a lot of money. We're just talking about two of them, the billion-dollar ones. And here we are in 2013. Now, this was in Japan with the yen. Surprise, surprise. And this was in an era that was kind of kicked off called Abenomics. And basically, they wanted to bring the yen down. They would need to devalue the yen. And so what Scott Bessent did is he said, hey, we'll short it down, but we'll do it with you. So we're not attacking it. With the Bank of England, they were attacking the peg, they broke the peg. But here, they wanted to do it with them. We're gonna go ahead and short that with you and bring that down. Now, if you look at this, remember I said we'd come back to this chart. So you can see right here, about 2013-ish, right here, is when, hey, we need to get this down, and they did. So Scott Bessent shorted this move with Japan and made $1 billion. How did Scott Bessent know to make this move? Well, he knows that, again, like I said, the rule, when a country is faced with a fork, should we either save the currency or do we save the bond market? We can't do both. So which ones do we do? He knows that it's always going to be the currency that's sacrificed. And so which side of the fork is going to be sacrificed? And then he trades it with them. If you can't beat him, join him. He understands the dilemma that they're in. He understands the choice that they're going to make, and he positions himself to trade with that. So they could either, Japan was forced in this era to either save the currency, but the problem is they had debt, the bond market, the government owed debt, 236% debt to
Federal officer, in addition to leading the agency's innovation task force. I officially call the meeting to order. The caliber of people joining us in the room reflects Chairman Selig's commitment to bringing the very best minds to the table. And we are grateful for the viewpoints each of you will bring to the meeting today. We are also fortunate to have a committee chair who brings a unique perspective to the position, previously as acting chair of this agency and continuing to serve our nation's markets at the highest level. With that, it is my pleasure to introduce Chairman of the Innovation Advisory Committee, Walt Lucan, for his opening remarks.
Well, thank you, Michael. I have to admit, it feels pretty good to be at the front dais of the CFTC again after all these years. So this is a pleasure. And I recognize Scott O'Malley, a former commissioner as well, in the audience. But thank you, Michael, and welcome to the inaugural meeting of the Innovation Advisory Committee. And thank you to Chairman Selig for entrusting me with this role, as well as I commend him for his leadership in advancing the innovation agenda of our industry. And obviously, thank you to Michael and the CFTC staff for putting all of this together. Now, looking around the room, it's clear that the innovation agenda of our industry is alive and well, whether it's traditional derivatives markets or new asset classes like prediction markets and crypto. I think when it comes to innovation, we can all agree that we must stop distinguishing between traditional and new market types. Everyone in this room fiercely competes and innovates. And it's this entrepreneurial DNA that has driven growth and progress in our industry for over 50 years and will continue to drive innovation in the years ahead. Now, we're in a period of extraordinary growth and expansion in our industry. In 2003, there were 16 designated contract markets regulated by the CFTC. Today, there are 30 designated contract markets with 17 pending approval. In 2023, there were 2,100 traded contracts regulated by the CFTC. Today, there are 6,700, triple the number. Now, I believe that the Commodity Exchange Act, the operating system of our industry, is one of the main reasons for this burst of activity. Since the enactment of the Commodity Futures Modernization Act of 2000, Congress has charged this agency with promoting responsible innovation and fair competition. Lawmakers provided the CFTC with flexible tools to effectuate this mandate, from principles-based regulation to self-certification to exemptive authority. Importantly, Congress included the terms fair and responsible in the CFTC's mission to ensure these public goals did not come at the expense of the safety and soundness of the markets or the protection of customers. Now, we are here today not to advocate for one technology, business model, or market participant. We're here to provide practical advice to the Commission that is rooted in real-world experiences. Good policy is informed policy. And informed policy comes from listening to the people who operate, use, and build these markets every day. Now, that's all of you. So my job as chair is to keep us on time and on topic. And I apologize in advance if in that role it requires me to cut off participants. I only take a small amount of pleasure in doing so. So I commend Chairman Selig for hosting this timely and relevant gathering, and I'll turn it over to him for his opening remarks.
Thank you, Walt, and good afternoon, everyone, and welcome to the inaugural meeting of the Innovation Advisory Committee. Just following our fantastic meeting yesterday at the White House with the president, he kicked us off, and we're all so grateful for his leadership. You know, he took us back to the Oval after the meeting, and he asked me, which is the more powerful agency? Is it the SEC or the CFTC? And I don't know, looking around at you all in this room and everything that you've built and our very broad definition of commodity, you know, I told him it might be the CFTC these days, but no, I'm just kidding. But we're really glad to get to work with Chairman Atkins, of course, at the SEC, and I think combined, our strength is really quite voluminous. So we've assembled some of the world's greatest builders, thinkers, and entrepreneurs here in our nation's capital to engage in a series of conversations about where our financial markets are headed and what role America, in particular, this agency, the Commodity Futures Trading Commission, or CFTC, will play in shaping that future. And before we get started, I'd like to take a step back and discuss why American leadership on this new frontier of finance is so important. But before I do, I must provide the standard disclaimer that the views I express today are my own as chairman and don't necessarily reflect those of the commission. For more than half a century, the CFTC has stood at the center of innovation in America's financial markets, helping ensure that innovation can flourish while markets remain fair and resilient. When President Gerald Ford signed the Commodity Futures Trading Commission Act into law in 1974, America's derivatives markets were being transformed by an explosion of interest in a wide range of novel instruments, from contracts on currencies to petroleum allocations to Ginnie Mae certificates. Despite federally regulated commodity exchanges having existed since the 20s, prior law only covered contracts on enumerated commodities like wheat, corn, cotton, and rice. The balance of contracts were subject to the same patchwork of state laws that had prompted Congress to institute federal commodity laws in the first place. As a result, America was falling behind. The history of America's earliest commodity exchange, the Chicago Board of Trade, has been described as the saga of, quote, fending off countless politicians on both the state and national level, all of which seemed intent on shutting the board down, end quote. In 1848, a group of merchants established the board above a flour store to enforce a set of codes and rules for buying, weighing, and grading commodities and to arbitrate disputes among traders. By 1859, a convention emerged whereby parties who had committed to buy or sell a commodity could make or receive a payment to or from the other party based on the change in price of the commodity, instead of making or taking physical delivery. They standardized a promise, a measure of grain, a price, a date, so that a farmer hundreds of miles away could lock in her season before the first frost, and so that a miller could plan his year without relying solely on hope to make ends meet. These arrangements came to be known as futures contracts. The response to this innovation in the markets was remarkably similar to what we've seen today with some of the innovation in our markets. As these early markets began to take shape, state lawmakers across the country moved to subject these exchanges to a wide range of state anti-gaming and anti-bucket shop laws. One lawmaker urged federal action, exclaiming that, quote, "The grain gamblers have made the exchange building in Chicago the world's greatest gambling house." Karl Marx himself called exchanges, quote, "gambling parlors where little fish are swallowed by the sharks," end quote. The same rhetoric has been used to delegitimize and undermine our markets for more than a century. But when lawmakers considered legislation to amend the Commodity Exchange Act, or the CEA, and codify once and for all a comprehensive federal regulatory framework for commodity exchanges, they recognized then what we know to be true today. Regulation and innovation must go hand in hand. Without clear rules of the road, builders, visionaries, and entrepreneurs always leave for brighter shores. So Congress established a federal system of market regulation designed to be future-proof and created a new federal agency, the CFTC, and provided it with exclusive jurisdiction over commodity derivatives markets. Lawmakers also included a statutory mandate that the agency promote responsible innovation, recognizing that virtually anything, tangible or intangible, might serve as the underlying for a derivative contract. Lawmakers defined the term commodity to include all goods and articles and services, rights, and interests that may be the subject of a derivatives contract. This included events, contingencies, and incidents that take place which are beyond the control of the contracting parties. Within an essentially unbounded field of potential commodities, exchanges were free to innovate and offer a wide range of novel financial instruments under a single regulatory framework. The breadth of the definition of commodity makes clear that lawmakers intentionally chose not to fragment regulatory authority over commodity derivatives markets based on the underlying commodity. They reasoned that, quote, "the nature of the underlying commodity is not an adequate basis to divide regulatory authority." Instead, lawmakers opted for simplicity and ease of administration, explaining that the fact that a futures contract market does not fit into the traditional mold, where there are both hedging and price discovery functions, should not be the determining factor in whether a contract is regulated by the CFTC. These contracts were now required to trade on CFTC-registered exchanges, known as designated contract markets, or DCMs. DCMs would be overseen by the CFTC, but also operate as self-regulatory organizations that would serve as the first line of defense in policing rules to protect market integrity. This patchwork of state laws that once undermined the ability of exchanges to operate around the country would no longer apply to these federally regulated exchanges. With clear rules of the road, pioneering exchange operators set out into the vast frontier of finance and designed many of the contracts that are popularly traded today, like weather, interest rate, and equity derivatives. After observing the evolution of these markets under the CFTC's supervision for some decades, Congress made additional modifications to the CEA to further future-proof the framework with the Commodity Futures Modernization Act of 2000, or the CFMA. We're pleased to have with us today former Acting Chairman Walt Lucan, who was heavily involved in the development of the legislation as an advisor to then Senate Agriculture Committee Chairman Richard Lugar. The CFMA replaced the CEA's legacy system of prescriptive regulation with a principles-based regulatory framework. The regime afforded market participants the flexibility to operate within core principles so that their ability to innovate was not constrained by hard rules. More recently, Congress again amended the CEA under the Dodd-Frank Act to expand the agency's authority to more comprehensively cover the universe of swaps. Lawmakers also chose to include within the CFTC's jurisdiction offerings of commodity transactions on a margined, leveraged, or financed basis to retail participants, which must trade as a DCM as futures. The results of these developments are reflected by the sheer size and depth of our derivatives market. At the time the Commodity Futures Trading Act was signed into law in 1974, the U.S. derivatives market was valued in the low hundreds of billions of dollars notional. Today, the CFTC regulates approximately half of the 1.2 quadrillion notional derivatives market globally. This is not an accident. It's the result of American regulation keeping pace with American innovation. But unfortunately, our history reflects that at times we've lost our way. Commodity options were prohibited in the US until 1974 due to concerns that the contracts were instrumental in manipulation and destabilizing speculation. And there's been a lot of debate about Congress's decision to ban onion contracts in the Onion Futures Act of 1958, as well as the movie box office revenue contract prohibition that found its way into the 2008 financial crisis reforms. Today, we're once again at an inflection point. Another moment when the choices we make will shape the markets and opportunities of the decades ahead. We've crossed the Rubicon and are standing at a new frontier of finance. It's not a question of whether the innovations like blockchain, artificial intelligence, and prediction markets will transform our markets. It's a question of where this innovation will take place and who will write the rules. America can either accelerate and continue the regulatory tradition that made our markets the greatest on earth, or it can decelerate and let other countries take the lead. We can be optimistic about the future, or we can fear it. In this administration, we're choosing to lead. Under President Trump's leadership, America will not simply participate in the new frontier of finance, we will shape it. Today, I'll preview our innovation agenda, or what I refer to as the roadmap for the new frontier of finance. During the prior administration, the American crypto industry weathered a perfect storm of anti-crypto armies, debanking, regulation by enforcement, and offshore exchange failures. After taking the oath of office on January 20th, 2025, President Trump quickly followed through on his commitment to fire Gary Gensler and make the United States the crypto capital of the world. Under the prior regime of regulation by enforcement, businesses couldn't know in advance whether their actions were legal or illegal, whether they were guilty or innocent, because there were no clear rules on the books. Many of you in this room today were victims of persecution we see in banana republics. It's completely unacceptable here in the United States. That's why I partnered with Chairman Atkins at the Securities and Exchange Commission on Project Crypto to codify a clear taxonomy for crypto assets to provide certainty to the marketplace as to which types of crypto assets are securities and which are not. I remain hopeful that Congress will deliver to the President's desk bipartisan crypto asset market structure legislation that codifies this jurisdictional line and establishes statutory core principles for crypto asset spot markets. While we have the tools in the box, if the bill doesn't pass, I want to be crystal clear. The most important step towards future-proofing this industry is passing this bipartisan bill. Passing clarity is the surest way that we can prevent another Gary Gensler from running a rogue campaign of lawfare against the individuals and companies in this room today. I'd urge you all to continue engaging with Capitol Hill to ensure that this bill gets across the finish line, and we stand ready to begin immediately implementing the bill if passed. If clarity continues to stall because of Democrat obstruction, the CFTC will utilize its existing authorities to begin establishing a regime for crypto asset markets. We owe it to the American people to do so. President Trump's promised to deliver a crypto asset market structure, and we will help him deliver on that promise. We will heed President Trump's call to codify a future-proof digital asset market structure that cannot be undone by the crypto haters. To achieve this, I've directed the CFTC staff to begin exploring rules to codify a CFTC market structure for crypto assets using the agency's existing authorities. This could enable current registrants as well as non-registrant crypto exchanges to be designated by the CFTC as a type of DCM known as a crypto asset market and offer crypto asset trading on a leveraged or margin basis subject to purpose-fit rules under the CFTC's regulatory oversight. I've also directed staff to engage with developers of on-chain finance protocols to establish ways in which developers can offer their protocols in a legal and compliant manner in the United States, future-proofing developer protections once and for all. We're going to give clarity its breathing room for a vote. But if the Democrats cannot support a bipartisan work product which reflects compromises from both sides of the aisle and ultimately send a fair version of the bill to the President's desk, then rest assured, I will direct CFTC staff to move swiftly to propose these rules for the industry. Now, as President Trump has said, America is the country that started the AI race, and America is going to win it. Access to advanced GPU clusters and compute capacity increasingly determines who can compete and who can innovate, and ultimately who can lead. As demand for compute grows, so too does the need for markets capable of efficiently allocating scarce resources and managing risk. If the lessons of history are any guide, well-functioning spot, forward, and derivatives markets emerge in conjunction with demand for scarce and economically significant commodities. Compute is proving to be no different. Transparent markets can transform compute from a costly and unpredictable input into a commodity with reliable price discovery and effective hedging, which will strengthen America's capacity to lead the AI revolution. America's AI Action Plan calls upon the federal agencies to ensure access to large-scale compute for startups and academics by improving the financial market for this ever-critical digital commodity. And we're partnering with the Department of Commerce to get this done. Our first step was to issue a request for comment on compute markets, which we released earlier this week. From there, we'll take stakeholder feedback into consideration and develop a gold standard regulatory framework for these new commodities. Just as American markets helped establish the gold standard for the trading of commodities that power the industrial economy, we will do the same for the commodity that will power the intelligence economy. Today, prediction markets find themselves enduring the same type of assault that state and national politicians plagued the Chicago Board of Trade with for much of its early existence. Although Congress gave the CFTC the exclusive authority to regulate DCMs that offer trading and derivatives, many states seek to nullify federal law and apply state anti-gaming law to DCMs. These state actors are sadly suffering from what the late CFTC chairman Philip McBride Johnson called NFS, or name fixation syndrome. NFS, he explained, quote, is an intellectual malady that causes the listener to hear only the first part of a phrase, such as Treasury bond futures, soybean futures, oil futures, sports futures, etc. Without treatment, this can lead the patient to think that the futures should be regulated by the same agency that supervises the name. The consequences, of course, are preposterous, end quote. I'm happy to report that we at the CFTC are not afflicted with NFS. That's why we'll continue to promote responsible innovation and lawful derivatives and defend our exclusive jurisdiction in court. As President Trump said, other countries are after this new form of financial market, and we want to remain at the top. But we'll not only defend our jurisdiction, we'll also exercise it by establishing clear rules of the road for these markets. Despite what some diagnosed with NFS may have you believe, prediction markets aren't new. Our statute expressly classifies as commodities events, contingencies, or incidents that take place which are beyond the control of the contracting parties. Derivatives on these commodities are known as event contracts, and they've traded in our markets for decades. Yet the CFTC never instituted a comprehensive regulatory framework to address the unique policy considerations associated with these products. Instead, prior administrations put their heads in the sand, thinking that the markets would go away, and when they failed, tried to outlaw the products entirely. We witnessed the same story that we did with commodity options and crypto assets unfold with event contracts. Regulators tried to ban them and drove the innovation offshore to places like the Bahamas, and we all know how that story ends. We're not going to take that approach anymore at the CFTC. Here's our roadmap for prediction markets. First, we recently proposed amendments to CFTC Rule 40.11. While every event contract must satisfy the core principles and not be readily susceptible to manipulation, Congress recognized that certain types of event contracts, specifically those involving war, terrorism, assassination, gaming, and illegal activities, raise additional public policy considerations. The CFTC has the discretion to prohibit any such contract when doing so is in the public interest. However, our statute does not define key terms like gaming or involve or establish public interest criteria for us to consider. As a result, contracts are at the risk of rejection based on arbitrary whims of political biases, and DCMs have been left operating in the dark. The prior administration attempted to prohibit event contracts on politics, sports, and cultural events in the name of the public interest, without ever defining what's in the public interest. Under this approach, the public is not the judge of its interests, but instead whoever's in control of the commission. Our proposed amendments to CFTC Rule 40.11 are intended to address these issues by defining key terms and enumerating public interest criteria for commission consideration. Second, we proposed a rule to modernize the reporting framework for fully collateralized event contracts. The proposal would establish a durable regulatory framework that provides the Commission with the information it needs to oversee these markets while eliminating unnecessary complexity and regulatory burden. Finally, I expect the Commission will soon propose a series of amendments to Parts 38 and 40 of the CFTC's regulations to modernize the core principles and listing rules governing DCMs that list event contracts and institute consumer protection requirements. We've heard the concerns of the public loud and clear regarding the inadequacy of our existing consumer protection requirements for retail. These amendments would also establish clear expectations for product governance, market design, and incentive programs. We have a lot of work ahead of us at the CFTC, but we're energized by the innovation that's happening in our markets, due in large part to all of you in the room today. You've withstood anti-crypto armies, doomerism, and a whole lot of subpoenas, but you continue to build here in the United States, and that's why you're here today. We're so happy to have you all involved in the Innovation Advisory Committee. We've brought together the people building and innovating here in the United States and ensuring that the new frontier of finance is built right here on American soil. Thank you all for your service, and I'm really looking forward to today's discussions.
Thank you, Chairman Seelig, for your opening remarks. Hopefully the committee is just as enthusiastic as I am concerning the roadmap you laid out. Before diving into session one, I just need to mention a few logistical items. First, for meeting participants attending in person, if you would like to be recognized during a discussion, please change the position of your place card so that it sits vertically on the table, or raise your hand. Please ensure your microphone is on when you speak. The meeting is being simultaneously webcast, and it is important that your microphone is on so that the webcast audience can hear you. If you are attending virtually and you would like to be recognized during a discussion, please use the raise hand feature. When the IAC chair recognizes you, please identify yourself before speaking and signal when you are done speaking. Please unmute your video and microphone before you speak, and remember to mute both your camera and microphone after you speak. If you are disconnected from the meeting for any reason, please close your browser and try opening the link again for today's meeting. If you require further technical assistance, please message me within the chat. Now I'll turn it back to our IAC chair, Walt Lucan, to kick off today's discussion.
All right. Well, thank you, Michael, and thank you, Chairman, for really setting the table for today's discussion. As the Chairman mentioned, we want to start out with the evolving regulatory framework around crypto markets as our first session. We have roughly 50 minutes to do that. That's not a lot of time for all the things we may cover. So as Michael mentioned, be sure to raise your placard if you want to be called on. I'll do that. And make sure your mic is on. And also, if you wouldn't mind, for our folks watching online, if you wouldn't mind introducing yourself, your name, and your organization. Obviously, we all know who you are, but for those online, it may be helpful to know what organization you're talking from. So with that, crypto has emerged as an emerging technology into a meaningful part of our financial system globally. However, here in the U.S., as was outlined by the chairman, it's largely been done without a federal regulatory framework at the agency. So the innovators around this room have had to navigate overlapping state requirements, uncertain jurisdictional boundaries, evolving legal interpretations, and regulation by enforcement. Today, we want to talk a bit about that legal uncertainty and how that has caused problems with the development of your business. But also, this is an advisory committee. It's meant to give advice to the commission. And so we really want to try to get real-world experiences of where the commission can act that will help your businesses. So let's start with an easy question, which is, how has that fragmented legal uncertainty that you've been facing really impacted the development of your business in the United States? And what advice would you give the commission in trying to clarify the legal certainty in this area? I'll open it up to the floor. Vlad?
I'll kick this off. Thank you, by the way, Chairman Seelig, Mr. Lutkin, Mr. Pasalacqua, for convening this. I think we can all agree that it's a big change in tone from 3 years ago, and also having a a regulator taking opinionated stances and actually clarifying where they stand has been super helpful, because in the industry we're tackling all sorts of challenges, and fence sitting from the regulator is not helpful. But you've been just incredibly strong, and I think that gives us confidence to go and grow our businesses and actually help our customers. I think as your question, one of our beliefs is that all Americans should have equal opportunity to generate wealth and to own crypto assets. It's been a challenge navigating the patchwork of state-by-state regulations because, most direct way, not all of our products are available to all of our customers. Take staking, for example. If you're in my home state, the great state of California, which gets a lot of things right, you can't stake your crypto assets. They're very difficult about that. And practically what that means is if you're an individual in the state of California and you want to participate in crypto, you're just economically disadvantaged relative to people in other states. So, if you'll actually, and of course, understand there's risks and protections and all of these things, but by and large, you'll just be worse off economically. And not only that, if you move states, things get a little bit tricky and cause all sorts of headaches, not just for the individual, but also operational burdens for the firms that shouldn't have to deal with that. So, 4 US states actually don't allow customers to stake their crypto assets, participate in the network, earn a return, and they very clearly want that. Stable coins, such as USDC, are available everywhere but Texas. Of course, if it's a payment network and certain states aren't accepted, it just becomes less effective. USDG, the stable coin we partner with Paxos and a few other companies here on, aren't live in New York, and Robinhood Connect, which is a really low-cost on-ramp that we have some partners here in the room using, is not live in New York either. So I think just a federal framework, aside from providing us certainty and durability and not, having our customers worry about rules changing every 4 to 8 years, or whether an asset they're going to hold is going to have to be delisted one way or another, preventing their access to it, which I think just puts a cloud of uncertainty over everything, will directly make it so that we don't have to deal with multi-state access issues where some of our products are available in certain states. And I think the customer, unfortunately, ends up suffering here more than the broker or the crypto firm in most cases. So I'll pause there, but really want to thank you guys for the yeoman's work that you've been putting to clarify all this stuff.
So exclusive jurisdiction of the agency would solve that, that the chairman outlined. That's an attractive feature to businesses like yours. Brian, I saw you had your placard up before you dropped it.
Before it flew off, yes. Yeah, so we were one of the companies affected by the prior environment, certainly, and to put it mildly, I think it was a disgrace for America, right? You had an industry that was doing its best to follow what laws existed. We couldn't hear any clear feedback from those regulators about point somewhere in the law that you feel like what this is, what we're doing is not allowed. Yet we continually received threats and direction from them to stop and cease certain activity. And when I would go in to meet with them and ask them, can you help us understand where your theory of the law here? They would say, I'm not going to give you legal advice. Talk to your lawyers. And by the way, their head of enforcement would kind of be sitting right there writing down notes in this meeting where we were lured in to say, come in to register. And then it turned out I would get a Wells notice a few weeks later. So yeah, that kind of environment is just not conducive. And it really, a couple of results things happen from that. I mean, one is that roughly 80% of crypto trading went offshore. I heard someone remark one time that nobody has done more for the economic development of the UAE and the Bahamas than Gary Gensler. So, unintended consequences. There was also, some folks are here from the venture capital space, like Chris Dixon, and he's made the point to me very, very clearly that they just saw a real dearth of new entrepreneurs coming in to build things and to pitch them, because if you're 22 years old and you have an idea and a dream and you want to co-found some company with your friend, you're much less likely to do it if you think you're going to be sued by the federal government within weeks of launching, and you have to go tell your parents about that, which is not fun. And not to mention, the average venture capitalist doesn't want to write a $5 million check into a startup that they know 4.5 million of that is just going to go to legal bills in the impending lawsuit. So that's why I think it's so important, the approach that this agency and the new regulators, the chair here, has taken. I liked what you said in your opening comments about optimism. I mean, yeah, in America, we should have optimism about the future, and every new change can be viewed as a threat or an opportunity. And I think that's what's made America great, is being optimistic about the future, seeing these things as opportunities to go work through. So thank you for your leadership on that. So yeah, clarity would be an incredible step to getting clear federal oversight, including from the CFTC on this spot market authority. And the 50-state regime really has been that patchwork quilt, so that would struggle. Now, if for some reason, I think clarity has a great chance of passing. It seems like people got 90% of what they want on both sides, and it's good for everyone. But if for some reason it doesn't pass, I commend Chair Seelig and Chair Atkins for just pushing forward with clear rules regardless. And I think that's going to be very important. So there's especially, I'll mention one final thing, which is, especially in the past, it was challenging to get the two agencies to work together. And there are certain products which sit at the intersection of the CFTC and the SEC, things like equity perps or KPI event contracts, like on the earnings of a company or something like that. And it's so great to see the two agencies collaborating now. This whole debate in the US about, is this a commodity or is it security? We operate in other countries like Singapore and the UK and places where there's just one federal regulator, and this question never comes up. And so that territorial nature that happened in the prior administration has completely evaporated. And the collaboration is just a breath of fresh air. So thank you.
Tyler, did you have a comment?
Yeah, I did. Thank you for having us all. Oh, I did. Oh, there we go. Tyler Winklevoss with Gemini. Thank you, Chairman Seelig and Mr. Lucan, for convening this council. It's a great cathartic moment after so many years of lawfare and not being able to actually have a conversation and engage with regulators. I totally agree with what Brian and Vlad have said, and it rings very true to our experience. Having to go to 50 different states for MTLs to get licenses. And if you've seen one state, you've seen one. They're all different. Some say we regulate this. Some say, what are you talking about? We don't regulate it. And some say we only regulate the marketplace and not the custody part. And of course, the custody part is where things can go really wrong. And so, and even engaging a law firm to help you navigate this morass of licensing, it's actually a specialty at law firms. It's so complicated that law firms have to have their own specific practice regarding MTLs. And so it is true that in some states you can stake on Gemini and some you cannot. And every state is different versus the rest of the world is much more unified. And when people talk about crypto trading or Bitcoin trading and the volume in it, the volume in Asia is so big versus the volume in America. Most of that volume is perpetual swaps or perpetual futures rather. And we haven't been able to bring them into America. And so we've been competing in the US. When you do the right thing, you're competing with folks around the globe that are allowed to move at the speed of innovation, offer products that we can't offer here. And it feels like you're running with lead shoes on and a parachute. So it's incredible to finally be able to have a conversation of how we can bring in these amazing products into the US and offer this innovation and this competition and all this value to customers here. I think that's great for America, that's great for consumers, and that's great for American businesses. So it's just great to finally be able to be playing on a level playing field. And just quickly, so much of the innovation has been stifled. Why would you come into crypto just to get sued when you can go to these exciting other industries like AI? We know historically the best companies in America came out of garages and dorm rooms. They didn't come out of the conference rooms of law firms. And so we need to change that. And we're finally doing that. And I think that we need to be committed to helping pass clarity. But if that can't happen, we can't delay forever. We need to pass rules and rulemaking. That's going to happen anyway. You need rulemaking. If you pass clarity, you're going to have rules if you don't pass clarity. And the question is, are we going to write rules now during this administration with these chairs, Chairman Selig and Chairman Atkins, or are we going to let these rules be written by someone else, potentially a Gary Gensler 2.0? And so it's important that we get going. Chairman Atkins showed us the way with reg crypto assets just the other day and helping projects raise capital with the proper disclosures. And all of a sudden, we just may see a Cambrian explosion of innovation when it is clear to an engineer in a college dorm room how they can actually raise money for their project. Right now, it's not clear, but what is clear is you have to hire a lot of lawyers, spend a lot of money. Why would you bother with that brain damage that we all lived for the last decade when you can just go to AI or some other industry? So thanks again for having us.
All right, well, we have, thank you, Tyler, and we have a few placards up, so I'm gonna go with Raghu first, and then I think Mike, Brad, Don, and Arjun, so I'll go in that order. Oh.
Sounds good. This is Raghu Yarlagadda from Falcon X. First of all, thanks so much for hosting. It is really refreshing to see innovation coming from crypto being recognized by this forum. For years, we've been ducking behind rocks, so it is, I'm very thankful that the innovation is being recognized. Now, specific to the fragmentation when it comes to regulation, I'll start with a little bit of a context on where my question or suggestion is coming from. I'm an engineer, so what I chase is, what is the use case, what are customers asking, and how can I build for that very fast? The world fundamentally changed in the last 12 months. Q4, the entire world was after gold. Q1, the entire world was after oil. And Q2, the entire world seems to be behind equities. And you see that explosion within real world assets on chain. Now, as an engineer trying to build for that, we were the first digital asset CFTC swap dealer. And it was an incredible experience working with CFTC over the last 3 years, refining and providing swaps to the US market and making it safer in the context of digital assets. Now, when I'm trying to build a platform that has every single asset, not just crypto, not just commodities, but securities, prediction markets, and everything in one single fabric, at the federal level, while we made tremendous amount of progress over the last 1 year in terms of bringing both agencies together, I think we could perhaps do more. If I have a CFTC swap dealer that enables me to basically serve swaps to my commodity swaps to my customers, can we build harmonization and reciprocity with SEC so that I don't have to again go and apply for a security swap dealer? Because it takes 2-3 years, millions of dollars, and the army of lawyers to again apply for a new regulation, new licensing completely. So if the forum can actually think through that and consider how to bring some of the fragmentation at the federal level, that could be very powerful for the builders behind the scenes. And again, I really appreciate you guys creating the forum. It means a lot to everyone building in the space.
I would love to explore that topic a little more, the SEC, CFTC harmonization. So if you have thoughts on that, you mentioned Phil McBride Johnson, who was the Shad Johnson Accord, the first harmonization effort between the agencies. Maybe there'll be a Atkins-Selig arrangement soon. I don't know. But anyway, Mike, let's go to you. And I see Hayden's online too. We're gonna. I didn't see him earlier, but we'll go after Mike to Hayden online.
All right. Hello, Mike Belshi, BitGo. First off, like everybody else, thank you for having this. It is a delightful change from the previous administration that wanted to do the opposite. In terms of what's happened, I mean, I think we've all seen when we talk about MTLs state by state, all of these things are hurdles. It really comes down to a more fundamental problem, which is just speed. Business moves at speed. It has to move at speed. AI is going to make it move at even more speed, which unfortunately probably makes this entire discussion even harder as we think about what comes in the coming years. We've heard a little bit about regulation by enforcement. And what is that? That's where you tried something and then instead of having a regulator say like, all right, that didn't work, we don't like it, we'd like you to change it this way or guide, instead you get slapped with something criminal or something severe civil penalties or whatnot. So I think the most important thing is how do you facilitate speed, making decisions. I think I speak certainly for everybody here, we are perfectly happy to work with the regulators on whatever it is we have to work through. We just don't want the regulation by enforcement. It holds everything back. So quick decision making, I think, is probably really an underpinning to this. And then I also heard in the opening remarks, principle-based regulation, CFTC has a bit of this. I think it's such a better model. As we look forward, trying to define rules today for whatever is going to come tomorrow is going to be tricky. So continuing on the principle-based, I think, is a stronger path.
And Hayden, if you could unmute.
Hi, can you hear me?
We can.
All right, thank you. So I'm Hayden. I'm the founder of Uniswap. We pioneered automated market making, which improves market efficiency and lowers the barrier to creating and participating in markets. I really want to start by thanking Chair Selig and the CFTC leadership. As a builder in the crypto space, the difference for us with this innovation approach is really night and day. And that's what I most wanted to speak to here is, what crypto startups in the US went through. And, from the beginning, we always aim to be a good actor and follow all laws and regulations where no proactive guidance was given. And, for that, I'd say that we had, me and my company and multiple of my employees were debanked. The company received a Wells notice from the SEC after a 4-year investigation. We had a CFTC investigation resulting in a no admit, no deny settlement. We had state regulators pile on to federal investigations and kind of bring, copy pastes of those lawsuits or investigate, or at least investigate. We had the regulatory vacuum that was created also led to, class action lawsuits that were basically, recreations of the same SEC claims. On top of that, I want to kind of, throughout all of this, we were a 100-person startup. And so I think most startups cannot survive that. So we survived that, but I think that we're more likely an exception to the rule. And it was because of just like the massive adoption and usage of Uniswap and some of the resources that gave us. But for us, it like really held us back. And I have, many personal friends who shut down their companies during that same period of time because their companies could not weather it. I also had many personal friends who were crypto founders leave the United States to build their companies outside of the US as US citizens because they didn't want to go through what we were going through. And I will say that the ones that left the US also were the ones that didn't get sued, and they were able to build faster and not have the same concerns. We were able to kind of survive, but our competitors were able to move faster, were able to build things that we were not. They were able to kind of, be a lot more aggressive in terms of their growth. I stayed in the US throughout it, despite, very frequently being recommended to leave the US because I believe in kind of the promise of this country. I believe in the value of what we're doing and, that it can be good for that what we're building is good for the world, and that ultimately, working through this within the country that I live is the right way to approach it. But I will say that that was against a lot of recommendation. And I think that a lot of people that left the US also didn't regret it and had a lot less legal issues to deal with. I think that how do we go from here? I think that we've all been saying that we really appreciate this new approach, and it is night and day for us. I think that what we have to think about now is how to kind of retain these benefits into the future, right? Which is, the current the political kind of tides can shift and turn very quickly, as we've seen in this very positive way. And so, what we have to think about is, if like, we really hope that clarity passes, obviously, and that's kind of, really important for builders in the US. And if it doesn't pass, then I think that the next best approach is kind of working with regulators to create as much proactive guidance during this pro-innovation period as we can, to kind of help create a longer term certainty and clarity there. So, that's mostly what I wanted to speak to. Happy to kind of speak to anything else, but really just, we need clarity. If we don't get clarity, we need, proactive regulations. I'll also kind of mention that, like, even in this kind of window of very minimal regulations, we did our best to interpret and kind of do the job that ultimately was meant to be regulators, but that process itself is very expensive. You have to hire lawyers to kind of redefine from first principles how to approach every single product that you build. And so we really hope to, be a partner in creating proactive rules that can help, have others not have to go through what we went through. So thank you.
Yeah. Well, thank you, Hayden. One of the promises of crypto is not just the asset class that sits on top of the blockchain, but the technology that underlies it. And blockchain and tokenization, that we're seeing a lot of the institutions that have long been in our markets utilizing that technology. I do want to bring them into the conversation a bit more too, because in many ways, that's the most exciting part of the market structure dialogue. Not necessarily the new asset class, which is exciting, but the technology that's going to revolutionize how markets work across the board. So, Brad, I want to go to you next, and then I think we have Don after that.
Oh, there it goes. Sorry. Well, I was going back to the first question. Thank you, by the way, for hosting all of us. It's an honor to be here. I'm Brad Garlinghouse, the CEO of Ripple. As many of you know, Ripple had the unfortunate reality of being at the center of the bullseye of the SEC's lawfare and the previous administration. And suffice it to say, my headline for today is "What a Difference Leadership Makes." I think it's profound, as you've heard from several people here, how significant that shift has been. You asked for some examples. I think it was Brian that referenced that you didn't want to invest $5 million and have $4 million go to legal bills. Ripple spent $150 million on outside legal counsel during our 4-year battle with the SEC. Most companies would not have, and frankly, other companies were bullied into submission prior to the lawsuit with Ripple. Suffice it to say, from my point of view, and I think everyone here would probably agree, the status quo is not good enough for consumers or for innovation. I think it's absolutely imperative we have these clear rules of the road, both to protect users, but also hold companies accountable and give responsible businesses the certainty to build here in America. You asked for examples. 80% of Ripple's hiring for those 4 years was non-US. Even today, our second largest office is London, because of that legacy that has shifted under the leadership of this president and this administration, the CFTC and SEC. I think we all can agree that the technologies represented at the tables here can make moving money faster, more efficient, and more accessible, but we have to have clarity to unlock that potential responsibly. So thank you for your leadership, and thank you everyone for being here today to help achieve that.
Thank you, Brad. Don.
Chairman Selig, thank you very much for putting this together. This is very exciting. I'm Don Wilson, the founder and CEO of DRW, and also our crypto arm, Cumberland. I'm pretty sure I can say that I have the honor to be the only one who was sued by Gary Gensler twice, once when he was running the CFTC and once when he was running the SEC. Much better environment now, so thank you. I wanted to follow up on a comment that Tyler made about perpetual futures contracts. My view is that perpetual futures contracts are a very useful risk management tool. And I think that, for instance, ETFs like USO would benefit from using perpetual futures contracts in addition to quarterly futures contracts in their, as part of their investing vehicle. Just because it is a perpetual futures contract does not mean it needs to have 100 times leverage, does not mean it needs to have auto deleveraging. Those are all features that were put in place on offshore platforms. I don't think that we should adopt those. I've been quite clear about that. And Kalshi has, launched Bitcoin futures. I think they have like a, 5-to-1 leverage or something. It's entirely reasonable. I also think it's important that we regulate these. To your NFS comment, we regulate perpetual futures contracts as futures contracts and not as swaps. If we categorize them as swaps, they're just going to remain offshore. We will not be able to benefit from the risk management tools that these can serve if we bring them onshore into a safe and regulated environment. So I encourage you to do that, and I encourage you to approve perpetual futures contracts on a wide range of products, including single name equity, et cetera. I think that there's a lot of benefit to that. On the underlying technology of blockchains and what they bring to the table, we're very excited about that innovation that's taking place there. We've been working closely with the DTCC and their progression towards launching in October on top of Besu and Canton. But we do need some additional regulatory clarity that's probably not going to be covered in clarity. It is more of a just clarity from the commission. For instance, we're moving to 24/7 trading. We obviously need to facilitate 24/7 collateral movement. Forcing market participants to over-collateralize for weekends is not beneficial. I think that the CFTC has an opportunity to encourage harmonized margin cycles during weekends. It's also important that FCMs have clarity on whether they can self-custody customer seg funds in tokenized forms, and if so, are they subject to any constraints? These are real concerns that people have, that need to be clarified, not 6 months from now, but kind of now, because we're already racing down this path. So, but yeah, again, thank you for putting this together, and great to be here.
Thank you, Don. We support a lot of that technology movements too on trying to get 24/7 movement on collateral. So that's a great idea. Arjun.
Well, thank you for having us here and bringing us from sunny California to Washington, D.C. The weather is much better here. I think everyone will say enforcement is bad, clarity is good, but I don't think anyone would really argue with that. So I think you'll hear that as a recurring thing. But I think it's worth pricing it in terms of what we did and how we structured our business alongside other people's stories. So in 2021, we paid $30 million to the SEC. So and we basically shut down staking for about 2 years. We had it outside the United States. We also grew outside the United States, and we essentially, continue to invest outside the United States. 2/3 of our team for Kraken today is outside the United States. Then we ended up to come onshore. We spent roughly $2 billion to acquire licenses. Don't make fun of us, but we have 2 DCMs, 1 DCO, and 2 FCMs. If you think about like market access premium of what we pay here in the United States versus anywhere else in the world, is roughly 50 times larger. versus what the build cost looks like. So that is just a huge disparity on what you see any innovator, any entrepreneur, any engineer building outside the United States. We're almost as cool as like the healthcare industry. And so I think that's, it's a little bit of an embarrassment. The other one I think is like I laugh when I read Twitter, of course, because I think of it as a source of truth many times, is that we are the last of the G20 members without a market structure framework. Russia passed it a couple weeks ago. So we are comparing ourselves to every other country in the world where they've moved forward. MiCA passed in 2023, and it's already fully live, and it is a basic framework that has worked out pretty well for what I call good actors. The thing that I think people won't name here is that a lot of innovation is outside the United States, but it's also harmful to US customers because you can get access to some of these products in an unregulated way. So, without naming the names of these exchanges, they still act in a nefarious way. They have leverage. They have ADL, processes and systems that hurt not just US customers, but customers worldwide. I think, and Tyler mentioned this as well, I don't think that legislation and rulemaking, it has to be one versus the other. We can do both. And so my sincere advice and suggestion would be to just do it. I mean, you have a lot of recommendations here on what that looks like. Clarity is the framework, right? The perimeter of what we're trying to do. Rulemaking and guidance is gonna come from the CFTC and the SEC, and there's no reason to wait. And the longer we wait, it's more likely than not we won't see anything in the future. We'll kind of be back here again. And my hope is that companies like ours aren't spending another $2, $3, $4, $5 billion just in the licensing stack. Similar to Brad's comment about Ripple, we spend today over $150 million a year just in legal fees. I love lawyers; they're my friends. I've known them for a long time. But at some point, I'm not looking to enrich them.
Thank you, Arjun. Well, we have about 10 minutes left in the session and about 10 placards up. So I'm trying to do this in order. So I see everybody's placards that are up, but I think I had Peter first, Joe, and then Frank. But if we can just try to keep it concise so we can try to get as many comments in as possible, we may go a little bit long. Yeah.
Thank you, Peter Smith, blockchain.com. So I've been doing crypto for like 13 years and definitely really appreciate being here. Sort of the chance to speak openly with the commission and help shape the future of US policy. I always thought of Gary Gensler as like the best salesperson and BD guy for the legal industry, less than the Bahamas, but everybody has it a little different. One of the things that I wanted to bring up, very kind of short point, is we do most of our business outside the United States, and our largest office is in London. So we've been really at the forefront of the MiCA rollout, as well as how MiCA was written. And one of the things that we've learned from that is that harmonization is great, particularly for large companies like ourselves and many of this in the room. It can also be very bad for startups. And even though this is kind of against our own interests, one of the things that we tell regulators globally is that you don't want to make some of the mistakes that we made in Europe with MiCA, which is that it made it very hard for small companies and startups to compete. So as MiCA has come into full force this year, you've seen thousands of digital asset companies unable to be regulated and basically have to wind up business. And so one of the things that I push for a lot in meetings with regulators is sandboxes, so that small players can continue to be part of the market, so that we can have startups, so that we can have innovation. And that brings me to my second point, which is, as Mike said, we need to move at the speed that companies and business can now move, which with LLM tools and AI is incredibly fast. So I think a lot of activity needs to have some kind of safe harbor limit based on the amount of, business metrics, so that you can move faster as a business and remain competitive globally. And with that, I'll just say thank you again.
Thanks, Joe. I'm sorry. Thanks, Peter. We go turning to Joe.
Thank you. So I wanted to go on record just supporting a bunch of the stories of my colleagues who, like us, spent millions of dollars and were thwarted in our attempts to innovate for a number of years. It really drained a lot of the energy out of the American aspects of our ecosystem. And so I wanted to thank Project Crypto, CFTC, SEC for your open dialogue approach, your approach to clear rulemaking versus the previous administrations. It has been incredibly invigorating for our company. We are energetically innovating, and we're shipping code incredibly quickly, faster than we ever have. The collaborative approach between the two agencies is, I think, going to be extremely important, and collaboration with innovators. Programmable money, programmable finance is a new kind of construct, new kinds of primitives. And DeFi is going to have some sort of uncertainty principles behind it, where you look at it a certain way, it's a security, look at it another way, it's a commodity, and we're going to have to figure out collaboratively this sort of blurry, at times, new set of primitives in finance. And there are cracks in our ecosystem between protocols, and those cracks present dangers. Those are dangers where security issues can emerge, and so we're going to have to take a very holistic approach to understanding and regulating decentralized finance. Harmonization may be necessary to address new kinds of constructs. Vaults in particular are going to be a very interesting topic for us all to look at together. I anticipate that vaults, which are essentially smart contracts that can serve as containers and mechanism around different kinds of financial instruments, they'll have securities characteristics, they'll have commodities and derivatives characteristics, and I think we're going to need a first principles approach because securities laws were designed to protect consumers and other holders of financial instruments against the people who might not be fully aligned with the best interests of the investor. Smart contracts, on the other hand, are going to be very transparent. You're going to be able to explicitly, programmatically disclose the strategy that is being followed, and you're going to be able to set things up so that the custody remains with the investor even while the capital is deployed in a strategy. So once again, thank you so much for your work.
Thank you, Joe. Just to throw another thing into the mix here too, part of our obsession at trade associations is also operational resilience and cybersecurity. If any of you might want to address, whether the crypto technological revolution is going to help with that operational resilience. I know there's a lot of discussions around Mythos and what that might mean for our industry, but we'd love any advice on whether the CFTC needs additional guidance in that area would also be helpful. But let me turn to Frank from DTCC, who's been doing a lot of work on tokenization.
Thank you. Thanks. Yes, I'm Frank Lasalle, CEO of the Depository Trust and Clearing Corporation. Mr. Chairman, thank you for having us. It's really great. I think this was a fantastic idea. Walt, thank you for volunteering to be the parental supervision in the room. Keep us all in check. You're doing a good job so far. Nice work. So, Mr. Chairman, what I wanted to say is, and I'm going to come at this from a slightly different perspective. I think all of us could attest to the fact that whether it's AI or blockchain, crypto, financial markets are transforming at a rate that none of us could have imagined not too long ago. And I think I've heard around this table, it's going to move with us or it's going to move around us. So having something like this is really important. One of the things that strikes me as I listen to what everybody said and I look around the room is you've got an incredible ability to bring people together. Like this idea of just bringing teams like this together. We got a taste of it when you were at the SEC and you brought together the crypto task force. And what that allowed firms like ours to do, it gave us an open lane to have a dialogue. And even though we had lack of regulatory clarity, it gave us enough confidence to move ahead with things that we knew needed to be done to stay ahead or at least stay with the innovation that was coming in front of us. That's incredible. This ability to convene, I would not underestimate. I look around this room, you clearly have that power to convene. So as we walk through this path of not knowing what legislation is going to come at us, what might come, what bits might fall off, I think I would encourage you to continue to convene, maybe not in large groups like this, but open up those lanes, because when we as an industry have that interaction with staff and getting a sense of where the chairman is on things, that gives us a lot more confidence to move ahead that we otherwise wouldn't. So if I could leave you with any piece of advice, that would be it. I would also commend you on the work you are doing. We've heard about modernization a little bit. I would also really compliment you and Chair Atkins on what you did in harmonization. That allowed us to be able to do cross-margining with cash and futures. We've delivered a tremendous amount of value to the industry as soon as we got that clarity. So those are the things that I think excite me, and if we continue down that path, I think we could stay ahead of this innovation, and we can transform the U.S. capital markets into a place that I don't think any of us could imagine. So I'd encourage you to do that. Thank you again.
Adina, I saw your placard up earlier.
Yep, great. Thank you very much, Walt. I'm Adina Fried, I'm the CEO of NASDAQ. And I want to thank you very much for bringing us all together. And I don't want to reiterate every comment people have made, but it is really a very different environment for us to be able to have dialogue and understand each other and look at this collaboration across the agencies. We have been really focused on that issue of collaboration and understanding what the benefits are going to be and how we can turn that spirit into action. And one area that we've been focused on is how do we continue to expand into the crypto world with our options business. And we've been able to leverage our equities markets to have ETF listings of crypto assets and then have the ETF options listed on our options markets that's regulated by the SEC. But as we continue to take another step forward in listing an index, a Bitcoin index options product, that's where we've been in regulatory limbo now for a year and a half. So we'd like to understand how we can leverage the great collaboration across the agencies to say, okay, how can we get through this issue where you've got a product that really is it's a cross-agency product. It's one where the two agencies have to agree on how to manage the regulatory oversight. We are an SEC registered entity. We're not a CFTC registered entity in our options business, but we want to be able to offer more choice to our clients and also, frankly, to have a better competitive standing as we continue to look at the new world of finance that's developing. So we would encourage the CFTC and the SEC to continue to find paths forward to turn this great spirit into tangible progress. And then in other areas, which we'll talk later in the prediction space, I think there's a different orientation to trying to define very clear standards of which agency has jurisdiction and where there isn't clear jurisdiction. So again, we find that collaborative path forward. So thank you.
Great. Shane, good to see you.
Hey, what's up? I'm Shane. I'm CEO of Polymarket. I know time is of the essence, so thank you for having me. Chair Seelig and Amir, Michael, Walt, you guys have been incredible. It's, I come from a point of view, right, where you have these moments where there's new technological innovations. And it's moments like that where, you're 21 and you're a tech nerd and you're entrepreneurial and you're enterprising and, you want some sort of upward mobility. And it's kind of those fringe technologies that have a lot of legs where you have a chance to build something that's on the frontier that maybe a lot of the more experienced people here may think is too small to begin with, and go and make something meaningful. So I've been, humbled and grateful as an American to be able to build something from scratch that has been impactful and make meaning, and by no means perfect. And I'm my first go around at this, learning along the way. I've learned a lot from many people in this room. So, one thing that I wanted to mention, which I think is just an important distinction, is like, I look back at our arc from starting right at the beginning of the pandemic. And I know, in 2021 was the first time we went to the CFTC with a DeFi legalization proposal, which, was how to do it in the US, et cetera. And I started Polymarket with no money as a solo founder. And the idea of lawyers, I didn't even know. There's no ChatGPT. Like, you're kind of, I know, forgive me for being so naive back then, but, I kind of went into it, was like, hey, anything's better than running out of money for rent. And so, I think the main parting, like, as you guys are sitting here and trying to, ask entrepreneurs and founders and executives of these companies, the thing I would say is like, from our point of view, we've always been like, hey, we'll do anything to go and figure this out, right? And, we bought the DCM DCO. We didn't know if they were going to be a lot more approved, so I think we paid a lot for it. And I think that the most important guiding principle is that, it can be very tedious. It can be a very difficult process, but there has to be a way to do it in America. There is capital. You can raise capital. You can hire excellent operators. You can go and get scale that way. You can get the best lawyers. So I'm sure, all of us have. But, if something's impossible to do, and there's really no way, it's extremely difficult. It's an extremely difficult position for someone who wants to go build like, an honest functioning business and grow it as an American. So what I would say about, the current state of affairs is like, I feel as an entrepreneur, as someone trying to innovate and be inventive, I'm just extremely grateful for the commission, for the chairman, for President Trump going and kind of giving everyone like the cover to be able to say, hey, we're going to go and adopt innovation. We're going to go and embrace all the people who are at the cutting edge of these new tech spaces, in this case, finance, and all facets, and like see what they want to build and figure out how they can do it responsibly. Because the most important thing, and the thing I think people maybe like conflict the most, is like, you have to distinguish between the technology and like an innovative technology and the actual like financial primitive. And, there's some times where you'll end up in a place where, hey, the financial primitive can be kosher, it can be legal, it can be something you can regulate, and the technology is different. And it's moments like that where, the competence and the commercial instinct and like the willingness to engage of the public sector, of the commission in this case, is such a multiplier on the ability to innovate domestically. So anyway, I'm extremely grateful. Thank you for having me, and just really excited about what's ahead.
Thank you, Shane. Looks like we have about 4 people who haven't spoken yet before our break. So I have it in order: Carla, Scott, I think I have Sergey, and then Vladimir, and then we'll take a short break. But Carla?
Hi, thanks. I'm Professor Carla Reyes, and I want to thank you for the opportunity to be here. When I listened to the roadmap earlier, I was particularly pleased to hear that part of the roadmap is providing rules of the road for developers of financial protocols, because I do view the last administration's like largest misstep, perhaps from the CFTC perspective, to be the trio, that set of 3 consent decrees along the lines of Open, DAREDX, and 0x, which left developers of financial protocols in a bit of a bind, frankly, in terms of understanding precedent and how it applies to their ability to build things that are regulated under the CFTC's jurisdiction. So I do hope that remains the focus of the roadmap, and I hope that it remains the focus of the roadmap whether or not Clarity advances, because although BRCA is included in Clarity in most drafts anyway, and although BRCA is quite good and important, it is quite narrow in the protections that it provides developers, and it would not actually address the issues raised by those 3 consent decrees under the prior CFTC. Secondarily, I would encourage in the writing of the rules under the roadmap a functional approach, which from a regulatory theory perspective does share some attributes with principles-based regulation, but from an execution approach takes a slightly different tact. In part, it would keep you away from words like taxonomies, frankly, which I detest, because taxonomies very quickly become out of date, and instead would guide you to look at the difference between, as was just said by a colleague the room between the technology itself and the financial primitive as separate entities, and really understanding what the heck is going on so that you can regulate from a functional approach. But broadly speaking, I just wanted to turn the attention of the discussion to those developer protections, because I do think it's a core piece of the roadmap that you laid out, and I hope that it does not go overlooked, whether clarity is advanced or not.
Thank you, Carla. Scott.
Let me extend my thanks as well to the Chairman and the CFTC for holding this event. It's encouraging to hear that we have a kind of two-pronged attack. Clarity provides some important reforms around federal preemption, which you've heard here today is an important thing. Regulatory clarity, very important that the CFTC and the SEC work together on products and in infrastructure solutions, working through that cross-margining that Frank mentioned. You have an important role to develop conflict of interest rules to make sure that both existing and new infrastructures are working off a level playing field and a clear playing field. Cross-product margining is critically important. There's a provision in Clarity requiring rules around that, and clarifying broad participation to provide liquidity, including bringing banks and their customers in, both as liquidity providers and offering their customers access to these important products. Separately, you have a big role in this building alone to address, and it's encouraging to hear that you're working with staff. Things around, as Don mentioned, custody and segregation. Rule 1.44 needs to be addressed to address wallets. Rule 0.149 to address eligible depository rules and what a depository could or should be if we're going to add new ones to that. Margin around haircuts. We believe it should look at the underlying product, not the delivery mechanism, i.e. tokenization. Think about making sure that these are all risk appropriate and making sure that we coordinate on capital regulation. Margin haircut methodology and cross-border regulation. Rules have been written, it was noted earlier. We have MiCA, we have rules all over the world. Bringing your leadership together, coordinating that internationally is also important. And then there's the importance of legal certainty and netting, making sure that that works, thinking about how we have the opportunity with tokenization to move assets quicker, to settle them quicker, to clear them quicker, but we can't forget about the efficiency offered by netting. And I think Frank has mentioned there's not enough capital in the world, cash in the world to settle growth. So we want to make sure that we think about this in a most efficient way. On the 24/7 risk management, coordinating an ecosystem-wide transition, i.e. making sure that clearing and risk management keeps up with trading, we think is critically important. Making sure that we have the funding and clearing rules very well established around margin treatment and delivery. Good sound risk management default mechanisms around some of the new infrastructures, whether it's going to be auto liquidation, how retail versus institutional is treated. And then, of course, maintaining AML and KYC rules that we have today that are applied broadly. Those have to be adhered to as well. So a lot to do. Greatly appreciate your enthusiasm and interest in solving these problems. Thank you.
Great. Let's turn to Sergey.
Great, thank you. Firstly, I'd like to thank you for creating clarity and fairness in the financial markets. I think that's a cornerstone of America's success and one of the reasons so many people build so many great applications in the American financial system. I think we shouldn't lose sight of that. That your two agencies, the SEC and the CFTC, are finally working together productively rather than fighting with each other publicly, I think is in and of itself a massive improvement, both for the reputation of the US, the trust in the markets, and obviously all the outcomes that you come together with a single unified vision instead of 16 different regulations over here and 25 over there that all conflict. And then that American innovation thing doesn't happen, which none of us want because we all live here, right? Now, we at Chainlink power thousands of applications. We power the majority of DeFi. And I've seen hundreds of people decide not to build applications in the US. So for every Hayden or Shane who have the strength and the will to stay in the US and build innovative, high quality applications in the US system and for the US consumer, there's thousands for each one of them that left, closed it down. And I know that personally because I'm their infrastructure provider for data, cross-chain, everything else beyond and in between. So that's a very serious cost in my opinion, and I've personally been living that cost with those founders for now well over 7 years. And a lot of them, they're just not here to speak today because they're not doing this anymore, right? And they're not benefiting the financial system or the American consumer. It's a very, very serious issue, and I'm very thrilled that we're addressing it. Now, the thing that I think is going to happen next is extremely clear. The tokenization of equities is going to create a lot of on-chain value. And historically, how this industry works is when value appears, the corresponding markets and financial products appear around that value. Now, the US equities market are the majority of the global financial system's equity, value and flow right now. And if the global financial system moves on chain, well, then you would want the US financial system to move on chain at the same speed or ideally faster if you want to retain that 60% approximate market share, right? So this is really, I think, what we're discussing, and it's very important because it determines America's global position in the global financial system. And just to point out, two key things that we've been discussing here, collateral management is massively improved. On a very basic level, you go from 21/5 to 24/7, and you reduce risk massively because there's much more transparency about what's going on with that collateral. It's a no-brainer. Anyone can do the math there, 21/5 to 24/7, right? That's already valuable. That's huge amounts of value. And then to the point that was raised from the CFTC about security, that is a massively improved aspect of private key security, blockchains, smart contracts. That is, I think, going to be increasingly valuable as AI decides to attack financial markets and to try to manipulate financial markets. And I think blockchains and smart contracts and oracles are going to be uniquely capable in withstanding those cyber risk threats, which I'm more than happy to speak with you and any market participants about. So thank you very much, and I think we'll all make a great new financial system together. Thank you.
Thank you, Sergey. Vladimir, let's go. It's the face,
Thanks so much. I'm Vlad Nowakowski, founder and CEO of Lighter. We've been building in the US from day one, and so it's been great to contribute to American innovation as part of this group here. We really appreciate the chairman's leadership in putting this group together and doing that. So I guess the point I want to make is, as builders in DeFi, I think there's been for a long time kind of a misconception about DeFi, and from our perspective, DeFi is not a regulator's enemy. In fact, it should be a regulator's friend. Having transactions on a ledger in a verifiable way, it actually makes it a lot easier to do the kinds of tasks that a regulator needs to do in terms of transparency, in terms of consumer protection, in terms of fairness. And so we've been very encouraged by the leadership and the staff at CFTC to really understand DeFi and understand how it's consistent with the CFTC core principles. I'll give you an example, like what's been the most robust payment system invented? It's probably Bitcoin, right? And why is that? Because it's verifiable, because it's open source. If there's a problem with it, anyone in the world, the good guys will find that problem before the bad guys, and things will get patched up. And so with that said, I think as we think about the technology going forward, the financial infrastructure of the US in the future, I think decentralized verifiable finance is a big part of that as it relates to cybersecurity and operational resilience as well. Having more and more technology evolve to an open source verifiable stack will be important. And even I think a couple of folks raised the question of ADL. We would argue that even that functionality, as long as it's done in a way that's fair, transparent, verifiable, can be consistent with core principles and protect the consumer. So anyway, great to be part of this discussion. I know everyone is waiting for the break, but I'll leave it with that. Thank you.
Well, thank you, Vladimir, for wrapping that up. This does conclude our discussion on the evolution of the regulatory framework for crypto. We're going to take a 10-minute break. Please be prompt in coming back, and we'll dive into our AI and prediction market discussion. Thank you.
cracked. I want to get into that. And potentially hundreds of millions of dollars were taken. It's a big deal. It sort of shook the Bitcoin community. I think it shook the crypto community because, I mean, we have these hardware wallets that are supposed to be cryptographically secure, and it was hacked. You are a physicist. You spent many, many years in the last several years of your career focusing on Bitcoin security. So let's walk through, first of all, what happened? How big of an exploit was this?
Sure. Yeah. I mean, let's start, I suppose, at the beginning,
Yeah.
right? And more and more research comes out about this all the time. People are actively investigating the origin of this incident, as you may imagine. But what appears to be true is sometime around 5 years ago, there was a commit put into the cold card firmware, so the software that runs on the physical device. And that commit introduced a bug, which made the random number generators that the device has built into it kind of ignored. And instead, a weak random number generator was used instead. And this is very important for cryptography because cryptography relies upon really big random numbers. So if your 256-digit random number is just 256 zeros, it's sort of random, but it's not really random. And it's weak, and it can be used to break some of the assumptions around cryptography. Right? Cryptography, especially the way that it's used in Bitcoin, typically has a concept of a public key and a private key. A public key is something you can share with somebody else. A private key is that secret random number. I'm simplifying a little bit here,
Yeah.
but private key is that secret random number that you must not share with anybody. And the general assumption of the crypto system is if someone knows your public key, there's no way they can use just that information to get back to your private key. That's a one-way direction. You can compute your public keys from your private key. They cannot compute your private key from your public keys. But if the entropy that was used to create your private keys is weak, then there's not really that many private keys a given public key could correspond to. And computers are very powerful, and it's hard to get an intuition for the numbers here. Typically, we say something like we want a 256-bit private key. So you can imagine a random number with 256 binary digits that define it. And that doesn't seem like it's a huge number, or it doesn't seem like there's a huge number of possibilities there, but it really is tremendous. There's lots of analogies people make about atoms in the universe and so forth, but essentially it's a number that's so fantastically large that we don't ever worry about hardware being able to break it. There are other ways it might break, but we can come back to some of those ideas later. But with this weak entropy, right, the space of all possible private keys was actually quite a small number. That instead of having 256 bits, which is what's recommended, it only had 32 bits. And again, intuitively, that doesn't seem that bad, right? That seems like a factor of like 8 or so different. How could that make a difference? But it's not really a factor of 8, right? There's an exponential aspect to that, and the total number of keys that fit into 32 digits is actually very small, and something that you can, again, try to attack on a computer and have some success in it. It only takes a couple of days on a GPU. So I want to emphasize that this bug is particularly scary because it has really ultimately nothing to do with the cold card as a signing device, right? Like it has everything to do with the cold card as a private key generating device. And so even people, for example, who had maybe years ago generated their private key on a cold card, but had then moved to a Trezor or a Ledger or any other system, those people are still affected by this bug, right? Even nothing to do with cold card anymore because their key many years ago was generated on this using this faulty logic. Unfortunately, I said earlier that 2 to the 32 is a fairly small number, but it's also in many ways a large enough number that this wasn't obvious, right? If the random private key that was being generated on these devices was literally like the number 0 or the number 1 every single time, people would have noticed that very quickly.
Yeah.
So this was like, in some sense, the perfect bug to both go unnoticed for a number of years since it looked sufficiently random, but it actually wasn't. And as soon as you kind of tried to poke at it with an AI or an exploit program, you're able to succeed. So that was extremely dangerous. And we can talk about maybe some of the impact of that mistake, that bug, that problem as it differed across single sig and multi-sig users. I think that's like an interesting conversation. But the root cause is this bug in creating bad random numbers.
Yeah. So, what I really want to get out of this is the distinction of different types of security that we have. And so hopefully the audience that's listening right now can start to understand the difference of taking custody of their key, having someone else custody of their key, different ways they can do that, because obviously they need to protect themselves. I can just say that I kind of understood what you said, and then someone over my head, and probably for a lot of the audience, it went way over their head. So I want to go through all that, and at the end, hopefully people have a good idea of what they can do to go protect their Bitcoin in this age of compute power getting more powerful, AI software helping that, GPU power getting more powerful, all of those types of things. And I know like you spend your career thinking about this. Let's just take it back to the impact, though, before we get into all that. I mean, do you have any idea, like, how many people were affected, like how much Bitcoin or what the US dollar value of that was at this point?
It's hard to know for sure because the attack is still ongoing. It's not over, and I want to make that very clear. For some people, it's already started to feel like old news since it's a couple weeks ago, but it's actively still happening to people out there. So it's definitely very much a current event. It's impossible to know for sure, but I think what I see being reported is on the order of hundreds of millions of dollars in Bitcoin have been stolen because of this mechanism. Again, this is an imperfect thing because it's not always obvious when an attacker is stealing the funds versus an owner is acting to move the funds. That distinction was not always clear. And largely it's being made on a heuristic basis that, hey, when the attack first triggered, like all of these funds seem to go to this place, they were authored in this way, this pattern matches. And so we think that this subsequent transaction probably is the attacker rather than an owner. So I think there's a little bit of a lack of visibility as well into this process, but we know it's at least been hundreds of millions of dollars. That seems to be like a lower bound.
Yeah. And just so everybody can catch up here, the Bitcoin network is an open source network, which means it's open and it's transparent. It's not private, but it's anonymous, right? So we can see all the transactions, but we don't know who they are, what they belong to, and things like that. And so I think what you're saying is that because it's an open source network, we can see all that, but we don't know, was it moved from a hacker or did somebody else move it on their own, number one. But also, I don't think we know, I mean, pretty sure we don't know which ones are maybe secured by a cold card or some other type of hardware device either, right? Because it's open, but we don't have that data.
It's a little bit of a mix. So anytime that you spend Bitcoin on the Bitcoin network in this open structure, right, you have to create a proof, right? Every Bitcoin payment is a proof of something. Typically, it's a proof that you own some underlying private key, because otherwise, how could you possibly have produced this signature that is included in your transaction? But part of that signature also includes public keys that were previously used to protect those funds. We can get into the difference between public key and public key hash in a second, which is an important distinction. But in general, when you're spending Bitcoin, you're saying to the Bitcoin network, hey, here are the public keys that were associated to that address. Here's my signature. This proves that I owned the private key that generated those public keys, that generated that address. Therefore, this must be my Bitcoin, or at least Bitcoin that the network will let me control, and I want to move it to somewhere else. So in that action, you're always exposing not just where the Bitcoin is going, the signatures, but the underlying public keys. There's a concept of something called a redeem script for those who maybe are a little bit more technical. That redeem script contains these public keys. And recall, the public keys are made by your hardware wallet or whatever it is your thing that stores your private keys. It keeps the private key secret and it generates public keys. And to each public key kind of corresponds an address. And then later on, when it spends from those addresses, it re-exposes those public keys back to the network.
Yeah.
And so if your hardware device had been a cold card and it had this weak entropy and it had a weak private key, the public keys that it's putting out there as it's continuously helping you spend Bitcoin and authoring transactions for you over the years, they're out there now on the blockchain. And attackers can look at the history of all public keys that exist on the blockchain. That's a finite set of things. Again, computers are powerful, so they can perform these searches, and they can search and they can say, for every single public key that I see, could this be a cold card derived public key? And that's a question that they can then begin to answer. And the more
and how would they know? And how would they know that it could be potentially a cold card?
Let's take the simplest possible example, right? Like, let's say the entropy was incredibly weak, and the only private key it generated was the number 0 or the number 1. So there's only 2 private keys that are possible to generate.
So when it's scanning that, they could see the level of entropy per key.
It's more that, so in that example, right, when we have a weak key generation algorithm, which is generating, let's say, only 2 private keys as compared to the vastly huge astronomical number we would expect, each of those private keys can generate a public key. Well, if there are only 2 private keys, there's only 2 public keys. We can just go look, do we see either of those two public keys on the blockchain? And that way we would know that, oh, this one corresponds to public key that is equal to 0, or excuse me, private key that is equal to 0. This one is the one that matches private key equal to 1. And now I know that I can break these because I know they're private keys. So you can imagine if the entropy were slightly stronger and there were 20 different possible private keys, that wouldn't really change the analysis. And similar and similar and similar. If it turns out there's only 2 to the 32 private keys, you can kind of just do the work and you can kind of figure out, okay, here's my list of all public keys that I think came from bad cold cards. And then you can scan what addresses on the Bitcoin blockchain were made using these public keys.
And over the next hour or so, we will get to as many of your questions as we can. They were submitted directly by retail and institutional investors through the company's official question form and on X. We received dozens and dozens of submissions covering a range of topics. And my job today is simply to put those questions to the company's leaders and keep us moving so we can cover as much ground as possible. If you're watching live, you can continue submitting questions in the replies, and my colleague Alex Devani will be looking out for new topics and angles that haven't already been covered by the submissions we received over the last week. And if you can't stay for the entire hour, don't worry, the full replay will be available on Strategy's platform along with mine. Now, before I introduce our guests, a brief disclosure. Some statements made during today's presentation regarding future expectations, plans, and prospects may constitute forward-looking statements. Actual results may differ materially due to important factors, including fluctuations in the price of Bitcoin and the risks described in Strategy's SEC filings, including its quarterly report on Form 10-Q filed on August 3rd, 2026. This presentation is for informational purposes only. It is not an offer to sell or a solicitation of an offer to buy any securities, and it is not investment, financial, legal, or tax advice. Any offering of securities will be made only by means of a prospectus, and additional information about Strategy is available at strategy.com. So with that, let me introduce Michael Saylor, the founder and executive chairman of Strategy, and Phong Le, Strategy's Chief Executive Officer. Michael and Phong, great to have you back.
Happy to be here.
Thanks for having us, Natalie.
All right, well, we have a lot of questions to get through, so let's jump right in. The first one came from several investors, and it's directed to you, Michael. You recently posted a chart on your X page where you outlined a digital asset monetary spectrum that included digital capital, digital credit, digital money, and digital currency. What is SR-STRC-USX, which you describe in that visual as digital money? And do you disagree that Bitcoin is money?
I think if you're using the theoretical term for money, then you would say money is a non-sovereign store of value bearer instrument like gold. But that's a classical Austrian economist view of money. The current conventional view of money is that money is a US dollar equivalent or a fiat currency equivalent asset like the US dollar that holds its peg against a fiat currency. So I think that 99% of the world thinks that money is a fiat currency and a money market is a fiat currency that generates yield. I think that there's 1% of the world that are Austrian economists that think that money is gold. Some of them think money is silver and money is Bitcoin. But I think that's an academic debate, and there's not much point in getting mired in an academic debate because about 0.1% of the capital in the world, or 0.1% of the economic value in the world, is actually invested in the Bitcoin network right now. 99.9% of all the capital, all the money, all the stuff of value is invested in stuff other than the Bitcoin ecosystem right now. A lot of that's equity capital, a lot of it's real estate capital, some of it's metallic capital like gold, some of it is credit, hundreds of trillions of dollars of credit. So I think that if you want the Bitcoin network to grow by a factor of 10 or 100, then you're going to have to attract capital from the traditional finance establishment. And that means attracting equity capital flows or credit capital flows or money market flows. So for the people that have not yet bought Bitcoin, the ones that we're actually working to serve, their view is that money is a medium exchange, a unit account, a store of value, and they would think that that's the Japanese yen in Japan or a yen money market in Japan. They would think it's a US dollar money market in the US. They think it's a euro money market or euro in the European Union. And so the TradFi or the Keynesian view of money is a fiat currency or a fiat currency equivalent that pays yield. So the chart that I'm illustrating is the digital assets taxonomy. We think that Bitcoin is capital, and so digital capital is Bitcoin, and Bitcoin competes against gold, real estate, equity capital, credit capital, or money markets held as capital, or art. Those are all the things that Bitcoin competes against. 99% or 99.9% of the economic value of the capital in the world is not Bitcoin. So if you want to get it, you need to compete against those things. You need to tell people why Bitcoin is better than gold or art or real estate or equity like the S&P index, or bar gold. STRC is digital credit. We've extracted a credit instrument from capital. It's semi-volatile. It's not as volatile as Bitcoin, but it's more volatile than a fiat currency. And the next step is to take STRC and create something that looks like a digital money. And a digital money would be the mythical Bitcoin-backed stablecoin. It's a fiat.
So we keep ourselves on time.
But pays yield. So the difference between digital currency and digital money is digital currency is deemed to be stable coins. It's like Tether or Circle or any other digital stable coin in whatever currency.
Shall we? All right, we're going to get going. Grab your seats. Thank you all. Welcome back. The second session we plan to tackle is AI and the regulatory framework around AI. And of course, as we think about artificial intelligence, we should start by framing it as an innovation supercycle. For decades, the capital markets and the derivatives markets have evolved through gradual innovation, but today, the pace of change is breathtaking and approaching exponential. It's difficult for markets and regulators to keep pace. Financial institutions, many around this room today, are deploying generative AI across trading, compliance, surveillance, customer service, and risk management to help manage this change. At the same time, we're beginning to see the emergence of agentic finance, where autonomous systems execute financial decisions with limited human intervention. Now, this represents tremendous opportunities, but also raises some important questions regarding accountability, market readiness, customer protections, operational resilience, and market integrity. So let's start with this very basic question, which is, which AI developments do you think are likely to have the greatest impact on CFTC markets? And what risks would you advise the Commission on around AI that they should be most concerned on? We'll open it up for discussion. Brian?
Yeah, so I think it's really exciting to see AI and financial services coming together, this agentic finance concept, or what we call AI-fi sometimes. There's a number of areas that I see it intersecting. So one, of course, is that these frontier models like Mythos and through Project Glasswing, I think have been really great at helping spot vulnerabilities in our financial system. And maybe a bit of a contrarian view, I think it's going to favor the defenders, not the attackers. I think there's a conventional wisdom that the attackers are going to gain all these skills and it's going to be mayhem. It's been great that financial service companies have gotten access to some of these models through Project Glasswing before the attackers have gotten it, and it's given time for remediation. It also favors the defenders in the sense that you can use these models to scan your internal code base, whereas an attacker would be typically scanning it from the outside and just hitting public endpoints. And so if every piece of code that our teams are writing gets reviewed by a frontier model before it goes to production, I think it'll actually net improve the security. And then the other exciting thing that's happening is I think stablecoins will be a default payment rail for AI in this agentic economy. So increasingly people are using AI agents to get work done on their behalf. And they're going to need to pay for goods and services. They're going to need to spin up sub-teams of other agents. And the traditional financial system, it doesn't do as well with very small and really real-time and cross-border transactions. So these AI agents might be spending a few cents, and it might get settled every second or less on chain. And so I think that's for the payments in the agentic economy, I think stablecoins are going to be a powerful rail. And then on the trading side, what's great is that these AI agents can actually act as advisors to an entire category of customer who, previously, if you didn't have a certain net worth, you wouldn't really get assigned like an RIA from a large traditional firm. And, the average AI agent, it's not necessarily going to be beating the market, like, be the best quant out there or something like that, but it could probably do as well or better than your average RIA out there in the market and help create financial literacy for an entire, even if someone has $100 in their account or something, they could get access to this to learn about portfolio allocation and dollar cost averaging and tax loss harvesting and concepts like that. I've heard there are some concerns out there about market manipulation from AI agents trading in the market, and I guess my reaction to that is that algorithmic trading or bots, this is really nothing new, right? I mean, there's been hedge funds for decades using we used to call it machine learning. Before that, we called it statistics. Now we call it AI. In many ways, it's just one continuum of the same concept. And, it's hard for me to imagine that there would be if there was one AGI that everyone in the world used and it recommended the same thing to everyone at the same moment, I guess, you could get sort of this herd behavior. But real life is just much more complicated than that. I mean, first of all, there's going to be lots of different frontier models with lots of different companies recommending various things. So it'll be a diverse ecosystem. And then even if you were to use the same AI model in one company, it's going to customize its advice to each of the clients based on their risk tolerance and what portfolio they're targeting. And so the AI model is not going to give the same advice or sell this, buy this to the different clients, even if the same model in the same firm. So I think some of these fears are overblown is the long story short. It's true already today that if the Fed cuts rates, 1 million people trade on all that information right away at the same time. I don't see a world where AI is going to create something super different than that. It's going to be a diverse set of recommendations from a diverse set of models in a diverse set of companies. And there's this kind of like temptation sometimes to think about the worst case scenario and we have to prevent it. Well, some people call that the precautionary principle. I think it's better to kind of wait to see what issues are real before we go out and try to solve them, because many of them may end up being boogeymen that never materialize, and there might be a different thing that pops up that was a real risk that none of us even contemplated.
Can I ask on the cybersecurity risk, like what would you recommend, with Mythos? I know there's Project Glasswing, which the private sector is looking to help think through those types of attacks. But what advice would you give the CFTC? Is it convening power that Frank talked about, where bringing the CISOs together from the industry to talk about these things? Is it guidance? Where can the CFTC help on that front?
You're asking me or anybody?
Anybody. Well, I guess Vlad or Tyler. Start with Vlad.
Yeah, I think Brian mentioned that the defensive capabilities of the AI agents are superior to offensive. First of all, I think we've seen lots of big cybersecurity issues in the industry. Every week you kind of hear about another protocol sort of getting breached, or some functional correctness issue leading to money being drained. And now you have AI agents that are doing like pretty extreme offensive cybersecurity work. I think there is this cat and mouse game where is basically the status quo. You have Mythos or powerful models, and you're hoping that you get them before the adversaries get them and can probe your actual code base. But I do think there's a better solution, which is, some folks here have actually been looking into this, formal verification of software, so you can actually prove that the software is correct. And I think it's in many ways the end game. Like, AI is becoming really good at this stuff, and you can actually prove that your smart contract isn't gonna double spend or do any of these really difficult things. It's sort of the same techniques that would be used to make sure that microchips have correct behavior, or your guidance system for a missile doesn't go haywire. And I think as the cost goes down, you'll start seeing it be much more feasible for these to get into domains like financial services, like derivatives trading, where frankly, up until recently, it would have just been too expensive to require everyone to do it. So I would look into that and seeing if, as the technology gets there, you guys impose more and more stringent requirements for whether code is formally verified and not just audited by hand. And the business continuity requirements that you have FCMs conform to can be kind of tightened up a little bit so that they're relevant in the modern age. And it's not just things like what address do you go to if there's a hurricane in the zip code of your data center, sort of thing. I think that could be significantly tightened.
Tyler, anything to add on cybersecurity?
Yeah, I would just add that potentially a way where regulators like the CFD could help out is connecting projects with the frontier labs that are maybe small, or the foundations or security researchers that want to help harden networks and maybe can't pick up the phone to Anthropic or OpenAI to get access to these models. A project called Zcash has modeled how to use AI effectively to find vulnerabilities and patch them and then harden the network. And Zcash is also pioneering formal verification as well, but it's a larger project. It's over a decade old, and the smaller projects may not have that connectivity to the frontier labs. So to the extent that you can facilitate that connectivity, that could be a great way where regulators could help security researchers get these AI frontier models into the hands of the right people in advance of the adversaries.
All right, I think I have Tom next.
Thanks, Walt. Thank you to the chair, the CFTC for convening us. Just a couple thoughts about AI in our markets. Has been intimated already. Utilization of systematic means of execution certainly isn't new. It's happening today. It's been happening for a long time. AI is a new tool that may or may not be better in certain instances with respect to that type of execution. And today, attribution to systematic execution engines of any kind really doesn't exist. So the question here might be, will AI accelerate the use of these means of execution, expand them into other places that perhaps we hadn't seen them use? And those are all good questions to be considered. But ultimately, the regulator today doesn't know if it came from someone's Excel spreadsheet with a script attached to it, or if someone went on an AI tool and generated a model and it runs in a high-speed fashion. So I think we should consider that it's the behavior that needs to be looked at, maybe less so than the tool. And one of the aspects of behavior is, where did this order come from? Where was this quote submitted from? So consideration to whether or not identification for systematic models might be something to be incorporated. Now, I don't want to give fear to anyone here that's been around long enough to remember Reg AT and that enjoyable experience and conversation from some time ago. But if we strip away some of the things that were less well received, such as share your source code with the regulator, which I am not supportive of, and I don't think that really adds any value at all. The idea that automated means of execution have their own interactions in the market and should potentially have some guardrails put around it with respect to identification and attribution, so that a human, an organization, et cetera, is ultimately responsible, is probably a concept that requires a bit more conversation and thoughtfulness. So I think it's unlikely that any regulator can keep up with the pace of change that AI is going to generate in terms of new models, new code, new means of execution. But holding models accountable for the same sort of behavioral requirements in markets that we hold everyone accountable for today is I think, a pretty easy principle to agree to. So just some suggestions that perhaps we think about, focus on the behavior. If we need new means of identifying and attributing responsibility and ownership, great. But attempts to get into the weeds on the latest AI model and what have you is probably going to be an effort not worth the time.
And the CFTC's principles-based outcomes regulatory structure is good. It's an outcomes-based regulatory structure. It's sort of technology agnostic, really. But Raghu, I think I have you next.
Yes, I want to talk about the other side of AI, which is the compute and the data center side, which is very, very relevant to the CFTC. I think Chairman Selig said this in the opening remarks. Compute probably, perhaps, is the greatest commodity that ever is. If you look at what's happening, US companies are investing $670 billion just this 1 year in building data centers. $670 billion. And most of these investments, we don't know what the price elasticity of H200 or the GPU is going to be in 2 years. So without knowing the price point or the user demand in 2-3 years, we're making, as a country, through private enterprise, $670 billion in. So I think there's a remarkable opportunity for CFTC to actually define compute as an asset class. Now, as some of the frontier labs are going to public markets, for the first time, they're getting questions in their IPO in terms of, hey, how are you thinking about the data center spend and hedging this data center compute? Now, as FalconX, what we're seeing is we're seeing some of these frontier labs and the data centers come and ask, could you write hedging or insurance products around the data center compute? But the more CFTC can guide us in terms of price discovery, fast tracking some of the regulation around compute, that'll actually make AI as an industry much more safer in the US. And that could help with AI in the US leading worldwide as well. So very excited about hearing other thoughts on the compute side and regulating that as a market.
I think we're going to have a few more comments on that today. Arjun, I have you next.
Thank you very much. Just kind of hearing everybody, we use the word AI, like the label, and all of a sudden it's like the scary boogeyman. And it reminds me of crypto being the boogeyman. And it reminds, or now we're going to have the next topic in a little bit, talking about prediction markets as a boogeyman. And, I think it's important that we regulate the function of an AI agent or what they're going to do, not the label of AI. And I think it's a very dangerous road when we start talking about AI as something completely different. Yes, it's awesome, compute infrastructure. There's a lot more innovation that's going to happen. There's a lot more throughput, more transactions. But what are we really talking about here? What we're talking about here is that the average individual, sorry, Don, I know you're right next to me, but everything that made Don successful over the last, 30, 40 years we can put that in the hands of every individual, or they can have an army of people or agents or entities working on their behalf. That should be scary for larger, older institutions, because that means you're inherently making the technology that they built over the last centuries inherently deflationary for all of us. So I think it's really important. Like, we should not be regulating the function. We should be regulating, we should not regulate the function. We should only regulate the label.
Thank you, Arjun. Mike?
Yeah, actually, I think we often look for what we should do from regulatory perspective. On this one, I think actually AI regulation would hurt the industry massively. We need to have the tools. The tools are going to change faster than we will be able to adopt. And until there's like a specific thing, not just a boogeyman, we should not touch it. Second thing I wanted to highlight, we could end up where, you know, like the most common failure is OPSEC rather than like cryptographic failure. Individuals are at risk when they are known to have digital assets. These are bearer instruments, and whether those are going to be people at institutions or individuals like retail, want to make sure that the regulators are also very aware of what's happened in France. You know, France has had the IRS collect information with specific amounts of Bitcoin that are held, you know, on behalf of people. So you have a specific list of here's the names, here's the amount, here's their address. And that's been stolen a couple of times, one on an insider job, the other one on some sort of a hacking attempt. So a way that you can help us against AI is actually to make sure that we're not required to collect unnecessary honeypots of information, which of course would be super desirable to an AI bot or a hacker or a, you know, any type of adversary. All right, thank you.
All right, Don.
Yeah, so as far as what can we do to reduce cyber risk and the risks associated with these innovations in AI, I think one important step is to encourage this administration to let the AI labs, the frontier labs, release their newest models as soon as they can. That reduces risk. That reduces risk to the markets, it reduces hacking risk. I think that that's super important. I agree with Brian that we don't need a new regulatory environment to address new risks in the market activity caused by AI and AI bots. Our team was heavily involved, it seems like 20 years ago, but maybe it wasn't quite that long ago, in working on best practices for automated tradings. And those controls were designed to keep markets safe regardless of the technology used. And they've proven very effective. We should evolve the framework for AI, not reinvent it. And quite frankly, I'm not seeing anything that needs to be evolved right now. I think that those frameworks, those best practices are just as applicable today with this new technology as they were when automated trading first came up. Lastly, on compute futures, we are in a race for AI supremacy with China. Risk management instruments in the compute space are essential to reducing the cost of capital, which in turn will give the US a competitive advantage. Silicon Data has successfully created indices which are robust, well-constructed, and not readily susceptible to manipulation. They leverage data from numerous neoclouds as well as from its sister company Compute Exchange. They do not rely on a small number of hyperscaler pricing. It is a mistake to delay the launch of these futures by subjecting them to a lengthy comment period. And I think that the self-certification process, where the DCM that wants to list the contract is the appropriate mechanism. I don't think that we need to reinvent the wheel here, again, just because we have a new technology and a new market. Thank you.
All right, Andre.
Thank you, Walt. Thank you, Chairman. On the cybersecurity front, I do agree with some of the statements already made, and especially by Brian, that it's both a opportunity to strengthen. So in addition to being a incoming threat, the actual utilization of it can make the organization stronger than it was before by utilizing all those capabilities. I think the thing that we could look at together is how do we ensure that everyone has that access, or how do we make sure that everyone has the ability? Because it's one thing to be, operationally ready, and we heard about people that had early access to Project Glasswing, but there were also others that didn't have access that are part of this ecosystem. So how do we ensure coverage? How do we ensure that there is a minimum requirement in terms of maintaining this resiliency across the board? In terms of whether we require, additional guidance or more like a regime, we already have a lot of existing principles. We already have model risk management, third-party risk, all things that are expected from companies like ours to support, and a lot of the AI already falls into this. So it's probably more clarifying how does that apply to AI in this particular use case. But bringing groups together like you're doing today, I think is the way to go as well.
I think I have Tushar next, but I wanted to throw one concept out there, if there's any thoughts on this, but it's around accountability. I mean, regulatory frameworks are built on holding people accountable for wrongdoing, whether they harm markets or harm customers, but that's being challenged by decentralized finance and by autonomous systems. And I think regulators and even folks that are advising policymakers struggle with how do we hold DeFi, these systems accountable, or is there a different approach that we need to think about in order to make sure that they're being accountable to the law and regulations of the agency? So as we go around and speak about this, if you have thoughts about that, this is an education opportunity because a lot of people are struggling with that concept. So let's go with Tushar.
Thank you. My name is Tushar from Multicoin Capital, and I want to thank you for putting this all together. I want to just echo everyone. It's a breath of fresh air to be able to engage in constructive dialogue rather than try to fight previous administrations. I have 3 points that I'd like to make about AI here. The first, and this goes back to what Peter said in the first session, I think what the CFTC can offer is some sort of safe harbor or innovation exemption for new types of markets, specifically thinking about the new compute derivative markets. Multicoin, my firm, is an investment firm active across private and public markets, and we are seeing a lot of new entrepreneurial ideas on how to structure these compute derivatives. They don't look exactly like traditional commodities. There are some very notable differences. And something that makes it difficult for us as an investor is, okay, you have this idea, and now how are you going to implement this in a way that is compliant and can actually serve the market? And if there was an innovation exemption for these new ideas, then we could see them tested out at a smaller scale before committing the capital to scale it up and do so in the fully compliant manner. So I would strongly urge an innovation exemption for that purpose. Second point that I would urge the Commission on is using AI tools to stress test the market. We are seeing, increasing amounts of leverage, concentration, and that can drive some very scary effects in the market. We've seen that in crypto. We've seen that in traditional markets. We saw that with things like, Archegos from a couple years ago, and the derivatives that were used there. And it was done so in an opaque way that made it hard for the market to understand all the hidden leverage. I think that the transparency that DeFi offers, which can be done in a confidential way where only the regulator and the market participants themselves see that activity. You don't have to broadcast your order to the market to be front run. But having that transparency in real time for the CFTC, I think can dramatically reduce that type of risk. And instead of being reactive afterwards, the commission can be proactive in managing that risk. And then my third and final point, pretty different, but AI has been a great wealth creation event. However, that wealth creation has been almost entirely in private markets. And what we are seeing is we see retail and just regular American citizens want to participate in this wealth creation, and they're unable to do so. And they end up oftentimes falling prey to scams and fake special purpose vehicles that don't actually own any of the underlying. They're paying excessive fees. And I think one thing the commission can consider to help these citizens is something like pre-IPO perps that would give those users a regulated and safe way to get price exposure to these private companies without those companies necessarily having to go public in order for them to do so. And I think that that would allow Americans to share in this unprecedented wealth creation in a way that is not possible today. Thank you.
Thank you, Tushar. So I have Vladimir, Peter, Joe, Scott, and Carla, I think, left on my list here. And then we're going to try to turn to prediction markets. So Vladimir?
Thank you. So I think with AI, one of the things that's really exciting is the opportunity to democratize finance. If we think about the progression here, we start with an index fund, then you have ETFs. Now with AI, you can construct baskets. If someone has a view, this is what I think will happen in the world or in the economy or a particular sector, AI can construct a trading basket or strategy for them on the fly to execute that. Only 5 years ago, this would have only been possible for high net worth individuals working with a professional money manager. So I think that's really exciting. And I think a couple folks spoke about this already, but in terms of the risks that this creates, I think it's less, I would agree with the point Brian made. I think it's less about systemic risk of all the AIs going haywire at the same time or something, and it's more about the consumer protection risks where consumer doesn't understand exactly what a particular AI model does, or someone is misrepresenting what an AI model does. I think those issues are real, and I think I would definitely agree with Vlad Tenev here on the formal verification point that having a sandbox for these models to kind of prove that they work, that they're formally verifiable before they're used at scale by consumers is pretty important, and something to think about. And I think these models are very complicated. It's not reasonable for a regulator to think about 4.7 billion parameters of a model, but it is reasonable to think about what does the model do, and what how does it stay within the guardrails of risk, of leverage, of kind of trading behavior. And I think that's all really important. I guess also touching upon the point of we talked about getting access to frontier models. I definitely agree with the point that giving, for example, folks in this room and the companies they represent kind of access to those early is going to strengthen the financial system. There might be some details to think through as to how to implement that, but very supportive of that, and have talked to some of the frontier labs about that. And last one, I think the issue of DeFi accountability. I think these are very important questions, and I think as being a DeFi company ourselves, working with the agency on getting a U.S. license like these, you really appreciate that the team here really thinks deeply about these questions, and especially with AI, I think they're particularly important, right? Like, on one hand, there's the point about developer protection. You also want to think about, if someone just puts code into the wild that is an AI model that hasn't been verified, how do you think about that? So, I think between this group here and others in the industry, I think we're going to come up with some really good solutions. Thank you.
That's very helpful. Thank you. Peter.
Thank you. A few things. First, on the model access point, I think it's always tempting to think that we can kind of gate something. We have early access to Mythos and the other models. I think it's really actually morally wrong to gate access to the models in the sense that it advantages sort of large incumbents over entrepreneurs, and that just doesn't feel very American. To wit, though, like at the same time, we run full scans with Mythos, every model that comes out. Some of the most problematic vulnerabilities that we found in our code base were actually from the latest Chemi model. And so I'm not sure that gating the access to just the US frontier models is really going to be an effective strategy for making anyone all that much safer in the first place. And so my encouragement is always like these models should come out as quickly as possible, and they should come out to as much of the market as possible, as quickly as possible, so that we're not in the business of picking winners by virtue of access to the tools to build companies and products. The second thing is around markets for compute. I think it can't be overstated how important this is. The U.S. has largely lost its place. It was historically the #1 place for crypto trading. Now that's offshore. We're all here to bring that back to the U.S., but we have to be sort of honest that we're not the #1 spot right now. Right now, the market for compute is just beginning to develop, but most of it's already developing offshore. Why? Two reasons in my view. The first is it's really hard to assign a spot value to compute, right? Which means it's hard to come up with an index price, which means it's hard to offer a futures. The second reason is that, entrepreneurs have watched the lawfare of the last few years. And while it's true that there's nothing preventing you from launching something for compute, there's no safe harbor to launch it under. And I think it's incredibly important for regulators such as the CFTC to have some kind of zone, as Tushar was saying, that allows people to experiment, to try things that frankly may or may not work, to figure out how to do this and how to keep America first. And without some sort of assurances, it's very hard as an entrepreneur to put yourself in the kind of jeopardy that you would be putting yourself in based on the last few years of the prior administration. The last thing I would just say is, I think with something moving as fast as AI, I agree with my colleague Mike, less is more. We have to figure out how to keep people responsible, how to make sure that, we're doing our absolute best for the consumer, but we're gonna have to move incredibly fast as a country to make sure that we stay at the sort of peak competitiveness globally for AI innovation and adoption. Thank you.
Thanks, Peter. Joe.
Thank you. So I agree, as others do, with Brian that there will be a positive asymmetry for the builders over the breakers of code, provided both have good access to machine intelligence. But there is a timeline to it. I read a stat a while ago that for every 1,000 lines of code, there's something like 15 bugs in the code. And so the world is saturated with terrible software. Most of the time, it doesn't matter. In our industry, it matters quite a bit. And so we do a lot of work, security auditing, and different kinds of verification. So I would encourage the CFTC and the world to really lean into the idea of open source, open protocols, to the extent that we can move away from obfuscation as a tool for security. That'll be much better for us because your software has probably been downloaded by somebody, and machine intelligence can now reverse compile it and run machine intelligence on essentially something that you think nobody has access to. And so your developers may not be quite as alert as they should be in that sort of situation. There's a timeline to the asymmetrical dominance that builders will have. So we're going to probably see a lot of exploits over the next little while because there are a lot of projects in the crypto industry and in other places that are over from the perspective of the builders, where people aren't behind the wheel, aren't paying attention to what they built. Again, there's a lot of software that doesn't run on live monetary rails, and that's less concerning. But we're going to see a bunch more exploits over the next year or so because there's just a lot of defunct live monetary rail projects out there. So we shouldn't overreact to those sorts of things. In the Ethereum ecosystem, we at the protocol level, at the smart contract or application layer, we have transparency, we have credible neutrality, we have verifiable transactions, and for well-formed transactions and well-formed programs, we have guaranteed execution. What we're moving into now is the ability, as both Vlads, I think, mentioned, the ability to formally verify, so mathematically verify the correctness of the code. So we'll be able to mathematically verify the correctness of the Ethereum protocol, and we do a lot of that work already. We're going to be able to formally verify the correctness of DeFi protocols. That's, I think we're going to move into a golden era for software. It's going to take a lot of work to get there. I would encourage you with your convening power and hopeful openness to harmonization to think about the holistic nature of the open source, open protocols ecosystem. I mentioned before that there are cracks between protocols, and that's where it's hard to reason logically to identify where vulnerabilities are. Giant machine intelligences are able to, with their breadth, with a huge amount of activity, they're able to look at a lot of the cracks between protocols and how you can line up 6 different subtle things into an exploit. And so there should be ways of not just formally verifying each individual element, but taking a holistic approach. And that's where accountability may lie. If we can proactively prove that all these different systems, if taken as a closed system, are formally verifiable and therefore correct, then we may not have to do the forensic type of work that we've had to in traditional finance.
Thank you. Thank you, Joe. I have Scott, Carla, and then Anatoly, I think, and then we'll round out today. But if we only have about 5 minutes left, if you can keep your comments concise, that'd be appreciated.
Thanks, Walt. As was mentioned by both Don and Tom, this does have very similar look and feel as the high-frequency trading algorithm discussion we had. Don, it was only 16 years, it wasn't 20 years, so we're not that old. But it was what was very kind of scary technology-first approach. How do we make sure that we don't let this run away with our markets? What we found, and just Walt, even though you did mention principles-based, it did not stop the commission from coming up with a proposal to send all code to the commission. And that's not the right response to this. What we found and what was enduring was we relied on all the infrastructures, the FCMs, the clearing houses, the trading platforms. There were several people in this room that are on this panel today that were in that discussion then. We talked about how you maintain oversight responsibility. What we found were the clearing houses and the trading platforms were the best integrators and basically frontline protection to making sure that our markets, they ran test data, they looked at different things to make sure anything that did go into the market had been pre-vetted. I appreciate AI is a bigger beast than trading algorithms that we were dealing with 15, 16 years ago. So, and the point about DeFi is going to have to be addressed as well. I think it is this commission working with the industry and on-chain providers, et cetera, as to how they're going to help us make sure that our markets are safe. is critically important, but it's going to take everybody's involvement, and I appreciate the leadership here.
And thanks for your work back in the 2010s on this issue. So, Carla.
Yeah, so 2 points. First, on the issue of AI, as someone down the line here mentioned, that we could adapt the third-party or outsourcing supply chain rules that exist to AI questions. The one thing I'd say is I'd encourage the Commission to think about how far up the software chain those obligations should be passed. It would do two things. One, it would provide clarity in that regard for AI developers, but two, the clarity itself may, as a colleague Kish Perel and I have argued in a recent paper in forthcoming in Texas A&M Law Review, it may trigger corporate governance and other private law enforcement powers that would help ensure security in AI models. Simply by clarifying at the regulatory level, you can trigger other obligations under private law. And then secondly, as to the DeFi accountability question, I just want to reiterate again the importance of focusing on function. Not all DeFi, things that are labeled DeFi function the same way or achieve the same end. And there are indeed certain DeFi protocols that operate as infrastructural resources. Generally speaking, capital markets regulation targets intermediaries as the object of regulation, and pretending that infrastructural resources that are DeFi protocols are somehow an intermediary that must be held accountable to law that doesn't apply to them is actually detrimental to the legal enterprise, as I argued in a paper called Law's Detrimental Reliance on Intermediaries out of George Washington Law Review. So simply reminding the room that not all DeFi is subject to the law that we want to hold it accountable to, and pretending that it is not helpful.
Very helpful. Thank you, Carla. Anatoly?
Just to add a bit about decentralization, I think once you guys approve like a product, whether it's perps or whatever, and you approve a certain implementation of it, if it happens to look like a centralized server where people can trade, looks and feels like Coinbase, it's very hard to come and say, here's a smart contract that is functionally equivalent that provides the same service. Can you approve this? Because once you guys have done the work to kind of do the due diligence on a certain way to do things, that becomes a standard. And it becomes very hard for systems that take longer because they're decentralized, because we're trying to do things, formally verified in an open source way to compete there. And those will get built offshore, because it's just code, right? So if those systems are better because there's all these properties that they can guarantee for users, but we can't get them approved, even though it's functionally the same, you effectively created a regulatory structure that only approves a certain implementation. And that becomes very frustrating.
Thank you, Anatoly. Well, this wraps up our discussion on AI for the day, and we want to turn to our final issue, which is prediction markets and the evolution of the regulatory structure there. I actually was at the commission in the 2000s when we approved the first prediction market. We also released the first request for information around event markets in 2008. So this issue has been percolating for a while. It's recently exploded, and now who knew it was going to be on the bingo card 2 years ago, but it is. And it's on the bingo card because it's demonstrated its immense power to bring information centrally and price discover a variety of different types of commodities and products and things. But it has come with legal and policy questions that we want to dive in today. Certain recent litigation and differing views among federal and state authorities make this an ideal time to talk about how the regulatory structure should look for prediction markets. And indeed, the CFTC has been quite active in this area. They've already released 2 rulemakings on proposals and a handful of other staff advisories as well. But given there are several prediction operators in the audience here today, and those that have invested in prediction markets, I'd like to ask, what lessons should regulators learn from the state and federal developments that have been happening over the next few months in order to evolve these types of markets? We'll open it up. Is that Luke? I'm trying to, yeah. Luke, you have your, go ahead.
Yes, thank you. My name is Luke. I'm the CEO of Binomial. We were recently acquired by Payward, and so a lot of what we do is traditional crypto business. We recently launched 2C2D retail spot margin trading. We're known for things like the first globally equivalent US perpetual futures. We also have crypto as margin collateral. But weirdly, why we're talking in this prediction market space is because we also offer a lot of infrastructure services to other companies, some of which are in this room. And so even though prediction markets are in many times vertically integrated and direct retail clearing, we offer a lot of different services with a lot of different structures for clearing those prediction markets on the exchange, on the clearinghouse. And so I guess just to keep it quick, what we would ask from the commission is please just keep an open mind when drafting new regulation and thinking about how to put all this together. I think there's a lot more differences in the ecosystem and in this space than maybe even we realized when we were first getting into it. I think in the futures world, we're very used to kind of the CMU way of doing things. It's very well established. But it's the diversity is quite a bit more pervasive than we would originally see on the surface. So thank you for having me here.
Thank you, Luke. Luana?
Hi, I'm Luana. I'm one of the co-founders of Kaushi. First of all, thank you so much. Thank you so much, Chair, and all of you for having us here. I also really want to thank the CFTC staff because we're here talking about all this innovation, but it just means an insane amount of work for them to be able to, in a very prompt manner, answer all of our questions and help us work through all of these issues, and we're really grateful. In a lot of ways, Kaushi had a very different path than the traditional, the crypto companies that talked here. We started the company in 2018, and from the start, we wanted to get regulated because, as you said, these are not, prediction markets are not necessarily new. They've been around for a very long time. And we knew that the right way to do it was coming through the front door and working with the CFTC on how to bring them here. But we had the issue was actually that even though we became regulated, it was years of the CFTC not allowing us to launch any products or do anything. And meanwhile, offshore competitors were really, really growing and taking a lot of market share. And it took, instead of the courts suing us or an agency suing us, we had to sue the CFTC to make sure that the law was being applied in the correct way. And I think a lot of the prediction market growth that we've seen after that came because of this lawsuit, really just reinforcing prediction markets and the regulatory framework here in the US. And what we learned after is that actually Americans really like regulated platforms. If you see the market share of onshore US-based prediction markets now versus in the past, it's the majority of the market is now in the US because Americans like regulation, they like consumer protections, they like having something here that they know the face, they know where it's coming from, and they know that the government is there to help and look it over. And yeah, a lot of the issues on the state regulation, as you said, state versus federal, have been around for over 100 years, multiple Supreme Court cases. And all of them ended up enforcing the CFTC's exclusive jurisdiction on regulating these markets. And a lot of these lawsuits are actually becoming very dangerous because of how broad they are. If you look at New York, for example, they're not just about sports, they're not just about prediction markets. A lot of companies here that actually never touch prediction markets could be interpreted to being under a lot of what New York State is trying to make happen. And I think it comes from a fundamental misunderstanding of the benefits of these markets. So when we started Kaushi actually in 2018, the idea for Kaushi came from our time working in Wall Street and seeing how investors actually didn't have a good option, a good alternative, a good way to hedge Brexit or elections or a lot of things that just wasn't a direct, transparent market where you could buy and sell future events. And being able to hedge this hedge this risk that was unhedgeable was one of the main reasons we started Kaushi. And on the other side, on the price basing side, it's extremely, this is the kind of like the bread and butter of why prediction markets are important. Over 75% of our users, they never traded on the platform. They just come to consume information. And actually, just earlier today, we released the largest study to date on calibration on prediction markets, showing how good these markets are at forecasting the future. So when we talk about defending these markets in the US, is less, there's obviously very important on the activity and the hedging side, but it's multiples larger on the people that use these markets for information and to have a way to have unbiased view of what's going to happen in the future, especially in a world so polarized by the news. And with that, I think the only other two things I wanted to add is on consumer protection. I think that there's a lot of the attacks is on the consumer protection side, and I've never heard a single argument on why state by state has better consumer protection than a federal framework. If you look at actually, if you go state by state, you see that very few states actually have any regulation against advertising to minors or any regulation against advertising to self-excluded or people have retail that has shown some issues. And I think this is an opportunity for the CFTC to yet again show we can be great at consumer protection. And my last point on the SEC and CFTC harmonization. Well, our take on this is that it's very important that we keep markets efficient and that we allow competition competition and users to really pick what is better for them. And I think that it's important that we let them. And I think that it's important that we let different companies compete and different models compete so that the users at the end of the day can compete and can decide which type of market, which type of structure is important and better for them. And at the end of the day, efficiency is very important. And I would urge you guys to just look at how do we bring innovation in a fast way and allow a lot of participants to participate. Thank you so much.
Thank you, Luana. One concept I want to throw out here, and I see Craig and Terry in the audience, but in the 90s when we were struggling with whether derivatives, over-the-counter derivatives, were futures or not, we brought clarity to that in 2000. And I think the concern was that these were competing products, that there was a zero-sum game. They would one for the other. But we found out, and the futures markets took off after we brought legal certainty to the over-the-counter markets. And so my question to the group is whether event contracts and prediction markets are complementary products to a lot of the derivatives we see. Are they going to enhance risk management in ways we can't do it today? To me, that seems analogous, but I would love people's opinions on that, or whether they're substitute products. I got Craig and then Terry next.
Thank you, Walt, and thank you, Chairman Seelig, for convening this group. It's an impressive group of people, and the intellectual firepower in the room is quite evident, and I think bodes well for the future of our industry and the continued growth that we have. Being probably one of the more tenured people in the room, it's a great privilege to be with a lot of the young, bright people who are bringing innovation and new ideas to our market, which I think are great. I think the work of the Commission in terms of improving legal certainty in crypto, advancing tokenization, and on-chain transactions will all be very good if done the right way for our industry. I think earlier, maybe last year, I had the chance to meet Shane, and I was very excited to meet him because I so respect his story and what he's done. And like he did with you today, Chair, he greeted me by saying, "What up?" And then he said, "Oh, you're the OG." And when he left, I had to ask my younger colleagues what was meant by that. And I was educated about what it means to be an original gangster, I guess. But which makes me feel really old. I think a lot of the topics today, while they seem new, and there are certainly new elements to them, the intersection of innovation, competition, and jurisdictional disputes and border skirmishes about products is not at all new. I think I've been in this room for almost 4 decades listening to conversations like this that are very similar. I also want to thank the chair for the recitation of the history of the development of these markets, which I think is really apropos for talking about and trying to solve a lot of the issues that I know you're looking for input on today. I had to laugh when you were talking about the floral shop underneath the Board of Trade, and many of you may not know, but I had the great privilege of knowing Terry Duffy's mother, who was an extraordinary and wonderful woman. and she owned a floral shop in Chicago. And I didn't want to interrupt you, but I wanted to just say, Terry and I were there in 1848 when that was happening. But on a more serious note, I think one of the things that I would say is, yes, it's true. Internationally, there are different regulatory paradigms that are, used to promote both securities and futures and swaps markets. I would encourage all of us to actually turn this on its head and look at the great success that we've had by having a bifurcated regulatory regime in our country. Yes, we do have border skirmishes and they happen over products, from time to time. And as an industry, we've had to fight about those things and we've had to sort them out. But we've generally done it in a really successful way. Today, the equity market capitalization of US companies is by far greater than the market capitalization of every other country in the world combined. That's pretty successful. If you look at exchange traded derivatives and over-the-counter markets, similarly, the US represents a dominant market share in what we have done. And that's because we have regulatory regimes that are tailored for entirely different markets. Customers, users, futures and options and swaps markets have typically been geared toward the professional, wholesale, institutional, highly sophisticated, large institutional market. Securities markets have obviously been geared toward protecting individual investors and retail customers. And so the ability to tailor those regimes, which are very, very different and operate very, very differently, have fostered growth and they've fostered innovation and they've fostered competition. And we wouldn't be where we are in terms of market share and the dominant place that we have in the global marketplace if we didn't have that. So I just leave you with the following, which is that, there are areas that are black and white and there are areas that are gray. And I've been doing this a long time. And a lot of the gray areas are very complex and they're difficult. And I'll just express appreciation for the difficult tasks that the commission staff at both the SEC and the CFTC have in sorting out those gray areas. But we have also the different regimes. And so, on the CFTC side, even though I'm generally a big fan of self-certification and the ability to do things quickly, especially in the context of a professional wholesale financial market with sophisticated customers, we also have securities products that are trading on CFTC markets. We have yes-no binary options contracts that were approved for trading as securities on the Chicago Board Options Exchange 15 years ago. And so we see a proliferation of those things happening on CFTC DCMs pursuant to self-certification today, but economically and legally, they are securities. And there's no question about it. The 1934 Act defines a security broadly to include any put, call, straddle, option, or privilege on a security, certificate of deposit, or group of index securities based on the value thereof. It's clearly a security, both economically and legally. The definition of a swap added to the Commodity Exchange Act excludes all those things I just said. So I would encourage the regulators, stay away from the black and white, figure out the shades of gray. There are shades of gray. We don't have time to talk about what they are today. But the consequences of not doing that, and I'd like to go back to where former Chair Walt Lucan started, which is our job, I think, as an industry is to promote responsible innovation and fair competition, and it's to effectuate safety and soundness and customer protection. We can't do that when we blur the lines on what is black and white. And there's a limit. There's a limit to what the regulators can do. They're bound by the law. They're bound by what Congress has done. And more importantly, in securities markets, they're bound by the fact that there isn't exhaustive federal preemption of securities laws. They are regulated to some degree by the states. And so when you have securities products that are unregistered trading on a DCM, no matter what the regulators want to do, at some point there's going to be litigation. At some point there'll be rescission exercised by customers on those platforms at the state level or at the federal level, because they can do it both ways. And those are risks that don't promote safety and soundness. They don't protect customers. And they do the opposite of what I think the spirit of this whole meeting today is to do, which is foster legal certainty and protect customers, give them a safe environment to execute. So thank you very much. I appreciate the opportunity to provide those comments.
Thank you, Craig. Terry.
Well, thank you all. Appreciate it very much. Chair Seelig, Mike, thank you very much for holding this event. Appreciate it. I want to thank you, Craig, for referencing my mother. I miss her dearly. She was the reason that I'm in this room today. She was a big supporter of mine 45 years ago when I got into this business. So, and she was a great florist too. Craig is right. I want to talk a little bit about a couple of things. First, I want to thank all my colleagues sitting around a table that talk so eloquently about the crypto industry in of itself. I'm a big supporter of the crypto markets. I have been since 2017. We're the largest futures exchange in the United States, largest futures exchange in the world by volume. We are a big crypto franchise. I listed crypto back in 2017 when others would not do so. And we did it because we thought the timing was right and we wanted to promote and support the product. I know that SIBO was down the path of listing it back then too, but then they got away from it. That was before I think you joined the firm, Craig. But we're a big supporter of it. So listening to the group around the table today, I'm very heartened where the crypto industry is at, where I think it can continue to grow, and I think it'll be a part of our lives for many years to come. So that being said, thank you very much for all that and educating me even further today. On the AI stuff, I mean, I believe from an exchange standpoint, from a market structure for all of us in that world, you know, we have to look to how to embrace it and what the guardrails are to make sure it's run properly. But really, when I look at artificial intelligence, I look at the algorithms that some of the firms are running today for their risk management protocols and how they are going to mitigate and manage risk for their, either as a fiduciary or on behalf of their own firm. So I think that is fabulous that AI is going into these programs as long as it's done responsibly. So thank you for that conversation. I want to talk a little bit about the prediction markets, and I'm a little concerned about this, and I'm a lot concerned about it. There's been 2,500 self-certifications since this administration has taken office in January of 2025, of which none have been opposed. And there's been a lot of self-certifications around products that are in violation of core principle 3s, which is susceptible to manipulation. There's no doubt about it. And if you don't think that's true, then you don't watch the news. Because if you looked at the Maduro situation, if you looked at the teleprompter situation from the President of the United States, there's a lot of things that are susceptible to manipulation. There's some sporting events that are not just outcome-based or individual-based, that are definitely people that are manipulating these contracts. That is not good for our industry. That is horrible for our industry. We're not a bunch of carnival barkers at a circus. We are running the most envious markets in the world in the United States of America. Chair Seelig, President Trump, has said how they want to make America the crypto capital of the world. Well, we don't want to chase our own participants out of our own markets either. And by listing susceptible markets to manipulation, it is really doing the opposite of what we're trying to effectuate. So I would hope that the commission—
record there. Those products are not listed in the United States. They never were. This occurred offshore, and that's fake news.
It's fake news. Okay, that's a cute comment too. So you're suggesting that some of these sports events are not listed in the United States?
The Maduro contract and the teleprompter-related contract were not listed in the United States.
I understand they're on Polymarket's contract. They were listed overseas. Fair? Yes, that's the answer. So regardless of the circumstances, that the president's own teleprompter operator was in the manipulation. That was not good, and I believe you are looking at the investigation to that. That's neither here nor there. I'm just bringing it up. That's not good for markets. We can get into a back and forth if you like. I'm happy to do that too. There's another really economic contract that has been massively important for the United States. That's a Nathan's hot dog eating contest. That's another prediction market that is on a US platform. It was called Kalshi. Kalshi also has a compute contract where when Don Wilson says, why are we having a 60-day period on compute? Kalshi was already approved for a prediction market on compute. Doesn't make any sense. Now, Cantor Fitzgerald is now partnering with Kalshi on that compute. Okay, we'll just call that a coincidence. Perps. I listened to all the conversation, but perps, 24/7 oil, which is something we want to do here in the United States. Why? Because these are having an impact on our markets off the decentralized finance platforms on Trade XYZ on Hyperliquid's platform. Now, these are illegal to US participants. I would have to ask the commission what they are doing to police everybody's VPN where they are not accessing these markets. They are having an impact on this, but yet we are being held up, others are being held up, Kelsey's being held up on trying to list 24/7 markets. Some people like them, some people hate them. I think all markets are going 24/7. I do believe that. That's just a matter of time. The banking system's got to get there, the federal government's got to get there, and we will get there. But I think it's truly important that we don't have double standards for people that have prediction markets on compute, but yet we will not have a listed spec contracts that we have out for compute going through these long review processes for reasons I don't know when there's already one approved by a US entity by the CFTC. So I appreciate you having this meeting, but I think it's important for us to go forward as innovators on markets to have a level playing field and make sure that the consumer is always protected. Because the best way to ruin a market, and I guess I'm old enough to recall in 2008 and 2009, when the financial industry takes bad behavior, it doesn't take a step backwards. It takes 20. It takes years to respond, to build back the financial system. We've been able to do that, and I hope we don't go backwards again. I appreciate the time today.
Yeah. Thank you. Henry.
Yeah, Harry Crane.
Oh, Harry, I'm sorry.
Professor at Rutgers University and
Apologies.
director of the graduate program in FinTech Analytics, for which all of the topics here are certainly relevant. And I appreciate the opportunity to speak here and to discuss these topics, especially on prediction markets, which I've been involved in to some degree or another for almost 20 years now, of course, going back long before the CFTC has been treating them over since Commissioner Seelig. There's a few topics specifically that I want to address on the topic of, first of all, principles-based regulation. I think is crucial for driving innovation. And I'm glad to see that the rulemaking that's been proposed by Commissioner Seelig and the CFTC is vastly different than the rules that were proposed for prediction markets several years ago. In particular, on the topic of the enumerated topics, war, terrorism, assassination, gaming, other topics that are illegal under federal or state law. It's very important to get clarity on what these terms actually mean, because that's the only way for these markets to operate properly. But one thing that I would urge the Commission is that these are also the topics that are among the most important and potentially the most useful and valuable to offer markets on from both a financial and an information standpoint. You can think of markets on war. Of course, there are huge risk exposures to these types of markets, and it's also extremely valuable information to the general public. We also have, everybody here would also, of course, agree that these are very sensitive topics, and so they have to be addressed appropriately. But I think that in the spirit of innovation, it's important to not stifle potential innovation in those markets. I think actually the sensitivities only emphasize the need for innovation rather than prohibition. As far as the state issue, well, first of all, on the topic of sports, which is related to states, it's very clear that sports have a huge economic impact. It's a $100 billion at least annual industry plus travel, hospitality industry downstream. The states are approaching sports, however, as a gambling product. We haven't seen the true value of sports markets when it's treated as a financial product. There are very few examples out there. There was one several years back in the Mattress Mac hedging case, where there was actually a very innovative marketing approach by a furniture store related to the Houston Astros winning the World Series. Well, this actually led to a $50 million liability for a furniture company, which was subsequently hedged at that time in the state-regulated sports books. So there are these use cases, and the more that these markets are allowed to flourish, we will see more and more innovation outside of the markets by being able to use them. And then finally, on the states issue, very important on the topic of consumer protection, because if you look at how the states regulate these markets, or any type of related market, these are not, the customer protection is not the first and foremost thing. They are allowing these companies, particularly the sports betting companies, they are exploiting losers, they are banning winners, they are not treating this in the same way as a properly operated financial market. And so I think that's a very clear distinction. And so I'm glad to see the CFTC is taking that on. And it's extremely important to have this principles-based approach to protect and serve not only the market participants, but also the general public and the public interest. So thank you.
Thank you, Harry. I want to give Luana a chance to quickly respond, and then I'm going to go to Vlad and Brian next.
Yeah, no, thank you. I just wanted to respond since Kaushi was called by name here. I would actually like to ask, Terry, has CME never had any issues with, any market manipulation, any issues ever in its history?
If you'd like to have a debate, I'm happy to have a debate with you. There's always
No, I'm just asking a simple yes no question. Have you guys had an issue with market surveillance? I have more people in my regulatory
department than you do in your entire company, okay? Thank you.
Maybe you should learn a bit about efficiency then.
Well, maybe you should learn about credible markets.
Okay. Let's try to keep this productive. Okay.
Yeah, I mean, I think every market has risk, and every nascent market will have risks as well. And there have been issues in every single traditional market, and every single exchange here, onshore and offshore. And I think the point of having regulation is that you find these issues, you address these issues, and there's a way to address them in a correct way. And one point to make on prediction markets. One of the reasons prediction markets have grown this much is because it has looked into events and things that a lot of the traditional industry has ignored. A lot of industries that need hedging and price basing. And a lot of the markets that the traditional industry looks at and thinks it's too small or thinks it's irrelevant is actually very important. We have actually a study coming out very soon from Kaushi Research that talks about the relevance of mainstream markets on how, for example, different words that Trump says move the S&P in a very dramatic way. And we have that coming out, and we have a lot of other studies there. And same thing goes for the Federal Reserve. And same thing goes to local and very state-specific local markets that we're happy to bring to market because we are able to list markets very fast. And again, with a robust regulatory framework, we're able to work with that. On the CFTC and SEC point, I think that I just wanted to address that a lot of great products fall in between. And there should be a path, as we talked about in the crypto part of the conversation, there should be a path for regulation and innovation on both sides. And self-certification, especially for prediction markets, is extremely important because a lot of prediction markets, again, and the price basing that comes from these markets come from the news, and something that happens, we need to be able to have these markets fast for our users. And it's important that, when we think about where certain markets land, we think about the end consumer and what's best for them and what's safer for them, and then backtrack from there on how to make these things work. But thank you so much.
Thank you, Luana. Obviously, we're at time, but we're going to keep going. I want to make sure everybody gets a chance to comment. But if we could try to wrap this up in 15 minutes, let's start with Vlad.
I'll be very quick. Thank you. First off, it's clear that customers love this new ability to trade prediction markets and to own economically the outcomes of real world events. I think I'm probably not unique in saying this.
we believe the CFTC is the correct regulator for these. We appreciate all the support and you guys actually going to bat and agreeing with this publicly. And a lot of the criticism, no doubt, from the states and other actors are folks that have a financial interest in the opposite rather than a principled interest. And as some others have mentioned, principled arguments about, a federal framework not being sufficient for surveillance or customer protection just doesn't make sense on its face. And I think that if we continue to iterate on this asset class, it's not just going to be a good trading product, but it's going to be a truth engine, a truth machine that'll make it easier and clearer for people to make important decisions. A couple of things that have come up or that are maybe less duplicative. One is on mention markets. I have mixed feelings about mention markets. So on the one hand, I agree that they can be very fun. On the other hand, certain mention markets, I think, are very prone to manipulation. And I don't think that it's necessarily even conscious or intentional, but if it's, someone giving a informal speech, you'll just see people at these events saying, hey, say this, say that, or, you never really know whether you're giving someone a thumbs up because they have a financial interest in the outcome or whether it's something more innocent. So I think it's just something to watch over. I think that the line, it doesn't feel like we have the right line in how we think about things like mention markets, and certain ones that I've seen, I think, are very prone to manipulation, and there's just a customer protection issue that that raises, although I do admit that they're very fun. So it's something to look at a little bit more carefully. I think the other one is on the disparity between direct to DCM and FCM intermediated retail access when it comes to KYC. I talk to customers from time to time, right? And I was at dinner in DC, and I caught some conversations about prediction markets, and I was like, oh, why do you use this one? Why do you use this other one? And one of the things that struck me is some people actually prefer to use direct DCM models because they don't collect their employer information. And, various reasons for that, of course, and it's not always that someone's intending to do insider trading. Sometimes they just don't like their information being collected, right? And having this idea that the employer knows what you're doing if you're a customer might raise some questions. It provides some friction. So I think my point there is really that it doesn't really make sense for there to be two different models for retail access. I think that whether you're going through a DCM directly and your retail customer versus an FCM, we should make sure that we uphold strong customer protection. And my preference would be for the FCM model to be widespread. I think it just makes sense to have more information, and the friction is probably sensible in that case. But regardless, there shouldn't be this implicit arbitrage. And whether you're a retail customer coming from FCM versus direct to DCM, I think KYC requirements should be uniform.
Thank you, Vlad.
Thank you.
Brian.
Yeah, so just a couple comments on prediction markets. The first is that the federal law is unambiguous here, that the CFTC has exclusive jurisdiction. Congress has said so explicitly, and we really appreciate you defending that territory from, even in the face of litigation. I think it's a great counterweight to what we heard earlier about the 50-state regime and the crypto markets. Here we have federal preemption already in statute, and I just want to thank you for enforcing that. The second was this, prediction markets I do think are creating a genuine public good. And while this gets to your question about, is it complementary to futures or unnecessary? And I think it's very complementary. The reason is that it helps people understand what's true in the world in a way that's really difficult to get from other sources. The breadth of the markets is important here. It's really kind of becoming an alternative, I think, to traditional media and social media, because traditional media comes with its own biases, and you're often reading not what is actually going to become true in the world. You're reading what someone wants to become true in the world, and they're pitching you with their own biases. Same thing on social media. So that's very important. There was part of the prompt here was about what principles should govern the listing of novel contracts, and I just wanted to put forth a concrete proposal to advance the conversation. And so first of all, I think just because something is novel, that doesn't mean that's not a good reason to reject it, right? And so I was trying to think of a 3-point test, and what I came up with was the first test would be, does it create public harm? Now, of course, you could say, does it create a public good or public benefit? But I actually think we should be in a default allow it to happen unless we can point to a specific harm. Somebody might say that, oh, that market it's frivolous, or who knows what it's for, but somebody might be deriving benefit out of it in a way that we didn't contemplate. So unless we can point to a specific public harm, I would default to listing, in my view. The second point would be the market would have to have a direct causal link to that harm, right? And so, the example here would be like an assassination market or something like that. But if the market was, when will the Ayatollah Khomeini be out of office? There's a variety of ways someone could come out of office. And, I think you could have a second order effect, a third order effect. You can tie yourselves into knots with this, unless I think you should hold the bar at there has to be a direct causal link. If you don't enforce that, almost anything could have an indirect link. Imagine any of us stepping down as CEO and the stock price fell that day. So if you're going to go to that extreme of saying there can't be any second or third order effect of harm, then we wouldn't even have public stock markets, right? In some ways, the public stock markets are already a prediction market on a CEO stepping down or something like that. And then the third part of the test would be this question of how subject to manipulation is it? And I think it is dangerous to have something that could be decided by one person, but we have to be careful not to go too far with this, because there could be examples where the public good outweighs the risk of it being subject to manipulation by one person. It really comes down to like a resourcing question of, can the CFTC appropriately enforce? You could say our stock markets are subject to manipulation, but we have an agency that enforces that and investigates it and gets tips. And as long as a good example would be, President Trump making a comment about the tariffs in Canada. That's to my mind, that's a mention market. It's by one person. One could say it's even subject to manipulation, but to me, the public good of that outweighs the downside. So that's the idea that I wanted to put out there of, does it have public harm? Is there a direct causal link to that harm, and how subject to manipulation is it?
Very helpful. Thank you, Brian. I think I have Don next on the list.
Yeah, so I'll be brief. I mean, just a couple of high-level thoughts. Obviously, a Brexit contract would have been incredibly useful. Will the Fed hike or not? That's an example of something that's a very useful contract. Obviously, you can also trade Fed funds futures. I haven't seen any evidence that volume in Fed funds futures has declined because of the existence of a will the Fed hike contract. So I think that they're complementary. I think that some people prefer the simplicity and ease of a prediction market around the Fed. Now, I think we can, and Brian, I like your kind of proposal around a framework of this kind of three-pronged framework. And And there are clearly some markets that just don't meet that bar that have been listed. I mean, you know, and you know, nice job to the CFTC and to Kalshi working together on this, you know, George Santos situation. But you know, the question of will George Santos attend the State of the Union address, I don't think that that was really all that important to anybody. And it was obviously readily subject to manipulation by one person with, you know, kind of no, I mean, whether he went or not was not going to have any impact on his life, really. And of course, he took advantage of that. So a good outcome in policing that, but I would argue that never should have been listed in the first place. And I think there are a bunch of other things in that category that just don't meet the bar and just should not be listed. And I think that it's in everybody's benefit in this room that we cut that bottom tier of things out, so that the important things like Brexit and Fed hike can thrive and you know, and grow. Thank you.
Thank you, Don. Jason, I think is it Jason at the very, yeah.
Hello. First, thank you to the chairman for, I think everybody said this, but I would be remiss not to pile on. The constructive, collaborative approach you've taken, I think, is an example of how government and industry should interact to everybody, and really just can't thank you enough and can't tell you how much I appreciate it, having seen many examples of the opposite, as I know everybody in this room has over the course of their time in their jobs. So thank you for that. You know, I just want to make two quick points. One, I want to add or really agree with what Vlad was saying, that the rules for customers going directly to DCM versus those going through an FCM should be identical. There really is no distinction from the consumer protection perspective, so that absolutely should be the case. The second point I want to make is more of a message for everybody in the room. I know that this is a very sensitive topic. I also know all of you have experienced regulated industry for a long time, and those who have, I'm sure, have seen infighting get in the way of constructive dialogue and solutions-oriented discussions. So I would just ask everybody, both in this hearing and then also in future communications, to try to refrain from taking shots at each other's business models or decisions that you may not 100% agree with. That doesn't advance the discussion. All it does is sow divisions and distract the discussion towards debates that really aren't productive. So that's something I think all of us should take away. And you know, I certainly have opinions, as all of you do, and there's a time and a place for it. So I think we all should make sure that we are doing that in an appropriate manner and trying to actually get things to the right people who are trying to set up these hearings to facilitate constructive dialogue so that they can do their job and get policy right. So thank you for all that.
Thank you, Jason. Prudent advice. Matt.
I will not fully reiterate Jason's sentiment, but as a new participant to this industry, I really appreciate the spirit of welcomeness and collaboration that we've experienced coming into this industry. There are a lot of issues in this room that I don't fully appreciate because I am new here. I'd say the one issue, and the one thing I know very well, is retail. I've been working with retail consumers for a long time, and I would just underscore the importance of getting a principles-based approach to consumer protection and responsible trading nailed as part of all this work. While a vast majority of customers will use these products for profit or for fun, there is a small chunk of them that will have a problem using them. And I think it's really important that we set minimum standards for all operators in the industry in order to ensure that, one, we protect customers, but two, you ultimately avoid the backlash that would be inevitable from a lot of negative stories coming out where people have used any of the platforms in this room or in this industry to their own financial harm. And I think we have an amazing opportunity because of the leadership in this room to take a leadership position around the issue and set super clear standards from day one from a proactive perspective. And that's very unique.
Thank you very much. We haven't heard from Tom Farley. So I want to jump the line here a bit. Tom?
Thanks, Walt. Tom Farley, bullish. First time I was in one of these confabs was in this room circa 2008 with Chair Walt Lucan presiding. But thanks, Chair Seelig and Mike and Amir. I just want to say, of all these I've been to, CFTC, SEC, over the last couple decades, the firepower in this one is unmatched. And this has been a really valuable session. And thanks for all that you're doing for the broader industry as well. I've told you privately how much I appreciate it. I'll say it publicly. Two quick thoughts. One, Walt, in providing some context, asked the question, is this a zero-sum game? You add some new products, I don't know, prediction markets or what have you. Is that generally good, or is it just subtract from something else? It's always good. Like when I look back, there was hand-wringing about electronic trading, there was hand-wringing about, I'm sure, equity indices, there was hand-wringing about basically every single innovation that we've all been a part. And you look back and they all added to the GDP growth, they added to risk-adjusted GDP growth, they added to this great free enterprise engine that we're a part of. So I would just say, please keep this stance of tending towards innovation and being willing to accept a little risk, knowing full well we're going to make some mistakes, like the example of the Santos mistake. I'm sure everybody was, okay, yeah, it was a mistake. You're going to get some of that, but you're getting this incredible innovation, including from Kalshi in particular. And by the way, thanks Terry and Luana for spicing it up after 3 hours. That was helpful. I'm wide awake. And then the last thing I'll say is that somebody mentioned this VPN thing. The VPN thing's a real issue, and what I mean by that is there's a playbook to getting access to the U.S. markets if you're overseas. I start overseas and I get a whole big U.S. following because they're spending 30 seconds downloading a VPN and they're logging on supposedly from Turkey, but it's the U.S. What I've seen in crypto, and I've been in and around it now since 2013, when things are successful and they have a lot of volume and a lot of customers, they have somewhere between a lot and tons of U.S. customers, even though they don't have access to the U.S. So we can ignore this VPN issue, but then that means that playbook will exist where firms will just get big overseas, they'll tap the U.S. market illegally, and then they'll come to you and they'll apply and they'll say, oh, look, we're good people, we have no U.S. customers, don't pay attention to any of this VPN business. So that's what's going on, and I think it's worth a look. Thanks again.
Thank you, Tom. Shane, turn to you.
Well, I was actually going to talk about surveillance of prediction markets. Back to what Terry was saying, and I think other people have mentioned, you look at these new asset classes, you kind of see you go and see the life cycle of a new technology or a new market, and I think like it's not going to be right from the get-go. And it's put, I think, more eloquently by Tom. But so it's you kind of got to think about like throwing the baby out with the bathwater. It is most definitely an experimental phase right now, where it's like, okay, these things were an idea, as a lot of people have mentioned. They've been an idea for a really long time. A lot of people have attempted to build them. Prediction markets. There's been some academic research from some even folks in this room dating back over a decade that are like very poignant and prescient in terms of how we think about prediction markets today. The fundamental premise is if you can go and apply the magic of price formation and price discovery to important current events, you go and give everyone just an easy way to say, hey, well, what are the odds, or how likely is this to happen, or there's no shot. You can go and extend that with markets to reality. I think people have found that immensely important. It was really the sort of core kernel insight that led me to build Polymarket. And when we think about these, like the Maduro thing and whatnot, and these things around the edges, like, yeah, those are problems. When that happened, like we worked with the commission, we worked with law enforcement. We have someone here right now who is ex-FBI, who works full-time at Polymarket, has built custom proprietary surveillance software on chain. I know this is live stream, so people are going to be upset to hear that, but we talk with our partners, Palantir, Chainalysis, and they're like, damn, you guys have this in-house, this is serious. And we're grateful to have that, and we continue to invest more in it. So, I think that, like people said, there's always throwing stones when something new comes along, especially when the dollars get involved. When people say, oh, these young people are getting so rich, and it's kind of like this fixation and sensation, kind of sensationalizing it. But, you know, this stuff has taken a long time to get here. There's been, you know, I give a lot of credit and you know, gratitude for a lot of the people who've paved the way. A lot of credit to Kalshi for going and fighting the battle, you know, in the US to go and sue for what's right and win. You know, and a lot of us have been beneficiaries of that, a large portion of us in here. And, you know, like, I think that this big facet of, oh, you know, people talk about Polymarket, they talk about Polymarket International, the DeFi version, because, you know, we have a US regulated DCM, DCO. But a lot, you know, there's all this stuff like anonymized and like, you know, insider trading. It's, first of all, it's not anonymous. It's all public. It's all on chain. It's the least anonymous financial market of all time. You can look at every single market and see every single trade and look at the trading history in full of every single participant. Like it's, you know, a level of transparency that's unprecedented. And with that, it actually brings a whole new set of data and like, you know, insights that you can go and glean from when you look at any market to go and find anomaly detection. I think that that's what we've been investing in. And, you know, the point is, when you're on the fringe and you're building something new and you're innovating, you know, as things pop up, you have to deal with, you know, you have to deal with problems that come appropriately, indulgently, and seriously, and you have to engage. And I think the most important thing is, you know, no one, I think, is here saying, hey, we don't want to be held accountable for mistakes or missteps. But, you know, when there's collaboration between public and private sector, when there is innovation and there are things that are not gotten perfect or there are problems, like, you can be so much more productive in bringing new markets, but also like maintaining American dominance. So, you know, grateful for that. And definitely by no means, you know, I'm sure I speak for, you know, all the young companies here, like, by no means coming here and saying, hey, everything's perfect, we've got it all figured out. I'm sure we have a lot to learn from all the seasoned operators in here, but, you know, we are doing our best, and we think that the pros far outweigh the cons.
Thank you, Shane. And we have to wrap up here. But Christian, we haven't heard from you. If you can wrap up in a minute, and then I'm going to turn it over to the chairman for some closing remarks.
Yeah, you can put me on the clock. First of all, thank you, Chairman, and we really appreciate, I'm from FanDuel, we appreciate our inclusion in this group and the fostering of transparency and open dialogue in this session and beyond. We're a relative newcomer to the space. I think our perspective is that the most critical thing we can do for prediction markets right now is to build consumer trust, and that the way to do that is to have clear rules of the road and a level playing field for all the participants. And so, you know, to that end, we really appreciate the rulemakings and the more public comment, and we, you know, we encourage more of that, and we're happy to be a participant in the dialogue around consumer protection, market integrity, advertising, and all the issues that we think will build that consumer trust. Thank you.
Well, thank you. That wraps up our session. I think we can all be in agreement that nobody wants contracts to be able to be manipulated in our markets. To your point on trust, that is to the detriment of everybody, and especially the CFTC. So just to make that point abundantly clear, but let me turn it over to the chairman to give some closing remarks.
Wow, this was such an incredible session. I learned so much. I think we all, I'm sure, learned a ton from everyone in this room, and it's incredible to see all of the, you know, development that's happening here in the United States. I think you all should pat yourselves on the back for being here in this country, fighting the fight against everything that you've seen in the past, and a lot of you still today with many of these state actors. You know, to me, the takeaway from this conversation really is that we've been here before. A lot of these challenges aren't new. You know, it's the first time I'm hearing Reg AT in a long time, you know, and that source code provision I know was really a challenging one. So glad we're not collecting source code here at the CFTC, especially when we're talking about honeypots earlier. But you know, I think what's really important is that we've learned so much from all of these challenges that we faced, both at the agency and in the private sector, whether it was fighting against these anti-gaming and anti-bucket shop laws back in the 30s, or fighting Chris Christie and Letitia James today. We're seeing a lot of parallels. We saw it with crypto, where, you know, you had a 50-state patchwork and the bit license, and you know, you're going to the Bahamas and offshore to build your projects, and that really was not beneficial to anyone in the country or to any of the projects that had to take those risks. I mean, I don't know how many millions and millions or hundreds of millions of dollars were spent on legal fees. I'm sure everyone can compare notes in the room, but it wasn't good for the country. And we've really tried to turn the page. We're still working to protect our jurisdiction. We're working to get the Clarity Act across the line to expand upon that, protect that even further. And I think that's something hopefully everyone takes away here, that we're working with Congress to get more protections, more preemptions, so that you're not dealing with the same sorts of things you're dealing with in the prediction markets and that you've dealt with in crypto. And we've got to make sure we win in court, because if we get judges that overturn some of this stuff, it's really problematic. So I think it's great to have everyone in this room working together. I want to thank Walt, Michael, Amir, and everyone who's organized this meeting. It really has been a productive one. And so thank you all for taking the time to be here and for your service. And I hope everyone takes away some really great thoughts on how to approach regulation and help work with us at the Commission to get things right.
Thank you, Chairman Seelig. I'm sorry. And to our MC and Chair of the IAC, Walt Lucan. I also want to thank everyone for attending and participating in the inaugural meeting. I must also add that to the extent you would like to submit written comments in connection with this meeting, you can do so electronically via the CFTC's website until August 27th, 1 week from today. And so thank you again, and the meeting is adjourned.
Oh no. Oh no. You can buy whatever you want, and they don't know, right? And so that's the first and biggest problem is the surveillance state will not stop until they can surveil everything. And the economy in transacting is the focal point for that, right? You mentioned earlier, like complaints that made in the industry when fraud actually stopped, because that stops them from being able to surveil. And I think there's a lot of signal in that. We could speak a lot about that. The cash is what enables people to stay, I don't even want to say off the grid. It's just preventing people from having every move controlled. I mean, you do want to buy raw milk, right? Because that it's healthy, and maybe you're totally crazy for thinking. Well, if all of that is done digitally, then just look at those transactions and say, here's a milk vendor, and this is approved by the FDA, so we're going to block all those transactions from happening. And that obviously scales to larger and larger problems, but I think it's a good example. And the nuclear option really is having cash and being able to buy a hard asset they can't inflate away. I mean, that's the heart of, that is really like sending into the heart of fiat currency, is the ability to do that. And so I really believe that that's why they cannot tolerate people do so.
I mean, if you go to Europe, there are a lot of places, I mean, in Amsterdam, they're not accepting cash anywhere.
Yeah.
It's all digital payments, all of it. This is why I don't do loyalty cards, by the way. This is why they're like, oh, 10% if you use the loyalty card. I was like, yeah, I'm good. I don't need to know when. I don't need you to know when and what brand of tampons I buy. Like, I'm good. We're all good here. You don't need to bombard me with advertisements and sell my data and do all of that. But what is interesting is that they absolutely want to get rid of cash, and it's slowly happening. And Michelle mentioned the whole CBDC thing. Listen, what is a CBDC? Okay, it is a central bank digital currency. Okay. Why do they want a CBDC? Okay, because a CBDC will allow them to do the same thing that they're able to do with a bank account, right? They call the bank and they say, shut this bank account or give us this information or blah, 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 blah. And the banks go and do it. It's all Bank Secrecy Act, post 9/11 stuff, all of that. All right. There's a myriad of tokens that act like a CBDC.
Yeah.
We saw, exactly. And we saw with the Canadian truckers what happened when all of the centralized exchange accounts were starting to get turned off because the government didn't like that they were protesting.
Yeah.
So like, but this happens within crypto, right? This also happens within Bitcoin, by the way, because if you have your Bitcoin in a centralized exchange and you're moving in that manner, they can shut down your account. Like, of course, if you're doing like unlawful activity, yeah, you're going to get your account shut, right? But they're moving everyone to this digital economy, right? Like stable coins and whatnot. One, to continue like printing dollars and backing dollars, and also to make sure that they're controlling like where you go, what you do. I mean, and are we going to get into like the, like the social credit systems like Palantir and Peter Thiel, and like how they're starting to centralize all that? I mean, how they bought like this massive chunk of like Aura Ring, and like all now of your data that you like an Aura Ring is now like partially like Palantir's. Like, you can't tell me that that is not setting things up for a social credit system.
Yeah, the evolution of X into everything app, the way that China has WeChat. I have been a big fan of Elon buying Twitter, and I think it's great for free speech. It's great that we can all connect, but I am absolutely not using X money. I don't want an every app.
Yeah.
No, I want a super complicated piece of technology that I don't understand how to get my Bitcoin off of. That's what I want. That's really what I want. I'm a very big fan of cash. I am a huge fan of cash. And I buy Bitcoin, of course.
Keep cash alive.
I love cash. I love cash. I dream of like one day running into like a big plot of cash at the beach in Miami. Cash, not cocaine, cash. And like, just
washing up on the shore, like,
yeah, just washing up on the shore and wrap and be like, oh, somebody sent me a gift. Yes, absolutely.
We can bury it in my yard, Tracy.
Well, no, I'm going to be like, this is abandoned property. I'm just going to, it's abandoned property. So I'm just going to if people can make that ludicrous argument with like dormant accounts on exchanges, then I can go and make that argument over cash that I find at the beach in Miami Beach. It's mine now. I'll just need to pay the taxes and then it's all mine. All mine.
Just consult the IRS. No, but it's so important. I think a lot of people like want to do the easy, convenient thing, right? And it's to like load up your phone and just do a little tapping and your dollars and numbers go through the matrix. But cash is so important. I'm based in Florida, and we, over the past few years, had these really terrible hurricanes. People were without power. I was without power for 10 days. The cell towers go out. And let me tell you how important it is to have cash in those cases. I mean, you can trade with other things, but cash is king. And when 100%. Everything goes down, it really shows. So it's important to maintain some cash, use some cash. I buy all I need from a local butcher that prefers cash, and I prefer them because of that. So
cash is a good tool. Cash is a fantastic tool. Cash is also a way of buying Bitcoin. This is why we have ATMs, Bitcoin ATMs. But I think the biggest thing that's also like offensive here on the Bitcoin ATM stuff, to go back to it for a second, it's just like the Bitcoin ATMs, like the population that it actually caters to is a completely unbanked or completely like underrepresented population of people in the banking like system. Not everybody has a bank account. Even in the United States, not everybody has a bank account, especially minorities tend to deal more in cash because they live paycheck to paycheck. So it's not like they have like a lot of money like in their accounts or anything. They like get their work check. They go to one of these places where they like get cash for it. And then they like operate with that cash throughout the week until like their next paycheck. A lot of the people that are utilizing Bitcoin ATMs are those people.
Yeah.
They're
The average
people.
buy is under $300. I mean, these are people that are saving everything they can in an asset that's not going to be inflated away.
So like that's I think what's like most offensive because the mission of the industry, you know, or the original mission before a lot of people got lost in their journey is to bring financial freedom to everybody in the world. So that what if there is no bank close to you? What do you do? How do you like transact? How do you like run a business? But then you see how like the attack of cash, I think, Michelle, I think you and I were talking about like how when you look at the QuickBooks application now, when like QuickBooks took away the tools for all the cash reporting.
Yeah, so we can do reporting, but you know, when I went to work for Byte Federal, I mean, the industry was under attack, and I assumed that the problem was with Bitcoin, right? Well, we're a crypto company, but actually, most of our problems are insane exponential expenses, are because we are a cash-based business. We've been debanked over and over and over, not necessarily because we deal with Bitcoin and crypto, but because of cash. We use QuickBooks for accounting. Yeah, I had told Tracy this earlier. There are certain features within QuickBooks that they disable simply because you are a cash-based business. That should be criminal. That is the actual crime, is claiming that the simple use of cash is a crime, because it's not. A lot of people are completely unbanked, and those people still matter, right? They do run businesses. They are a huge part of the United States. We can't forget about those people. Yeah, we pay.
You're also incentivizing people to commit a crime, because if I don't have the tools to report all this cash, what do you want me to do?
Right.
Oh, okay. The more complicated you make it, the more people are going to be like, you know what? Fuck it. Hide it under the mattress. We're just not reporting it. I mean, and that does happen. I live in an island. I live in Puerto Rico. I'm from here. Every time we have a hurricane, like Michelle said, you need to deal with cash. So like, there's all these cash transactions happening everywhere. There's a whole ecosystem of it. And there is like no way of doing things then properly because the tools are being taken away. And you have to think that. And I know, Jake, you asked me, like, do you think that this was made specifically for like the crypto and Bitcoin industry? And I was like, well, I don't know if it was done specifically, but I think that it was done with the intent of forcing businesses to then not accept cash because the mechanisms for reporting those earnings isn't there.
Question. So I think a lot of times I see the disconnect between like the average retail, like pleb, I'm just a Bitcoiner, I don't care about anything else, and then the institutions and like Bitcoin companies that operate in the space. They hear that, and to me, I see the direct connection. It's like if the regulators make it difficult for Byte Federal to run their business, the downstream effect is all of these unbanked people are unable to on-ramp. And so what would you say to the person that goes, I don't care about the institutions, I'm just a Bitcoiner, not for me? What would you say to them when there's challenges with the institutions and how that actually the downstream effects will reach them?
It's a good question. I think if they are absolutely not going to stop with Bitcoin ATMs. You might not buy your Bitcoin at an ATM, but if we don't fight for everyone to be able to access Bitcoin, if we don't defend all of the on-ramps, they're not going to stop here. once they successfully shut down the cash ramps, they're going to go after something. I don't know exactly what might be next, but they're going to continue to increase the bullseye, right? And if you just say, oh, I don't care, affect me, I don't care, that doesn't affect me, by the time you get to the point that it does affect you, there's going to be no one left to fight for you. You know, there's that famous saying, they came for me, and then there was no one left. And so, you know, I think we all need to take a step back and remember why we're here, remember why we got into Bitcoin, and take a look around and realize that it's worth fighting for. All of the on-ramps are worth fighting for, whether it's an institution or a tiny little ATM at a gas station in the middle of nowhere. Everyone in this ecosystem matters. I don't know if that answers your question, but
it matters. And it also, like, we're in this because we know that the world is going to hell in a handbasket. And at some point, and it's going to happen, and we all know it, it's why we're so frustrated by the situation. We don't know who's going to be in the next admin, or the next one after that, or the next one after that, or who's going to be in the Senate, or who's going to be in the House. And we got into this because we know that in a weird way, a social credit system is coming to the United States. It's more challenging to implement in the United States because of our Constitution and because, you know, I think we're a country of hotheads. And so, like, we'll probably, like, go to war on this. But the whole point of this thing is that when they decide, we don't like what you say, we don't like your opinions, we don't like what you think, the only way that we know to punish you is through your pocket.
Yeah.
Because we're already causing inflation. Oh, and you know what? We're going to take now all that devalued money that you have in your account, and we're going to shut it down. We're going to shut it down until you change your opinions or until you're just quiet and don't talk about anything, right? And they'll monitor you because we're already being freaking monitored with these things. They're already listening to everything that we're saying. And that's not a lie. You see it every time you talk about something. I mean, I guarantee you, I mentioned tampons earlier. Jeff, let me know later in the week how many tampon advertisements you get on your account if your phone was close by. Like, but it's the reality. So we Bitcoin because we want to make sure that when all of that happens, we can still feed our families. Yeah. And we can still help our friends. And we can still have our own community and survive whatever apocalypse whoever is in power is going to bring down against us. That's why we Bitcoin. That's why this thing is worth fighting for. That is why when we see a 3-page addendum that makes no sense because the traditional finance industry is treated completely different, we are still being discriminated against, and we still have a fight. Now, is the fight significantly less? And are we now better equipped? Yeah, of course. We absolutely taught everybody a lesson in the last election. So we have power as an industry and as a community. But to continuously label us as criminals is irresponsible and should be criminal. It should be. Because you're putting a target on everybody's back in this industry when all we want to do is make sure that when all of y'all out there mess up, we can still feed our families and help our communities.
Yeah, I think that's a good place to wrap. Michelle.
Oh, great. We're not going to get into the flock cameras. Awesome.
We'll say that for the next one, and we'll make sure we bring our tinfoil hats. Before I let you guys go, Michelle, where can listeners find you and where can they learn more about Byte Federal?
Yeah, so they can find me on X. I am only on X. I do have a no star that's mine, but I'm not active there. So it's just Michelle Weekly on X, and you can find Byte Federal there as well. I do have a fraud website where you can learn all of this. We're keeping track of all the FBI statistics, and it's a really great resource for anybody who is in the industry and maybe wants to understand either what's happening or how their little niche part of the industry can fight fraud. And so I'm and keep cash alive.
Tracy.
I'm Tracy Hoyos Lopez. On X, I am Tracy Hoyos Lopez. I work at the awesome, most amazing company out there, Kraken. And I am the head of strategic initiatives for Kraken Institutional. If I can ever be of any assistance to anybody, whether that's in my division or anywhere else, it would be my pleasure. I love my company. I love Kraken. I love our vision. I love where we are headed. This is still the future. It doesn't matter that we're in a down market. Bitcoin is still worth fighting for.
I love it. Ladies, thanks for joining me today.
Have an amazing day.
Thanks for having us.
Zero is the wrong number in terms of how much Bitcoin you should own.
Now, zooming out on Bitcoin as a whole, were you surprised by the success of the Bitcoin ETFs and Larry Fink going on TV promoting Bitcoin?
I think Bitcoin is becoming more popular. People are becoming more aware of it. I mean, the ETFs are a marketing game. I'm in favor of it because it helps people get exposure and interest in Bitcoin to sort of understand it as an asset class, start to think about it how they include it in their own capital allocation. We have sort of team members that have come up with a phrase, which I enjoy, is sort of zero is the wrong number in terms of how much Bitcoin you should own. And I think that having more products out there that encourage that adoption and the adding of Bitcoin as an asset class in terms of some shape, form of exposure into your portfolio is great. So you've got ETFs. I think, again, what Strive and Strategy are doing, allowing other ways to get sort of the income, the fixed income side. Exposure to that is great. And then for others, they're going to want to own spot and think about how do they leverage it in, based on that type of ownership.
And then competitively, how do you think about kind of the margin lending against IBIT versus against physical Bitcoin with Bitcoin-backed lending?
So right now, the space is very much, we lend against essentially spot, right?
Yeah.
In terms of the actual asset. I think it will be interesting to see how it evolves. For the most part, our decision in terms of what we lend against is against the liquidity of the asset in the market. How easily can it be traded? How fast can we sell it? What is the access to sort of liquidating it, selling it when we need to? And so I think what Michael Saylor shared yesterday in terms of how much Strategy and Strike, MSTR and Strike are being sold in the market from sort of a volume perspective is encouraging. I think you will see people start to think about how they incorporate those type of assets into portfolios, because that's been like the ultra wealthy have been playing this game for centuries, right?
Yeah.
They've accumulated business portfolios, real estate portfolios, and stock portfolios that they've been able to leverage to make additional investments, to live their life in sort of a tax-free way. And I think sort of Bitcoin and these new sort of equity options as well as sort of digital assets are going to provide that opportunity going forward, with really Bitcoin being the predominant one that's leading the way.
And with large borrowers, have you seen them kind of add derivative overlays to manage their risk, or is that kind of more uncommon?
We do know of sort of high net worth and family offices and more sophisticated borrowers. They ask questions. They do have different sort of derivative strategies that they wrap around their borrowing. I do think, again, once the capital has come on board, you will see some more of those structures come into play as sort of the market matures and it grows, right? You have more people into it, you have more money that people are looking to take advantage of, and then they can also diversify how they think about their value building strategies or their capital sort of treasury managed strategies if you're business, or your wealth your wealth building strategies if you're an individual.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
If you understand why gold is good, that's why you would want to be in Bitcoin.
Is it that the governments always just want inflation because they want to just keep stealing from you and pay for wars, or is it now baked into the system and then that's what makes it certain?
I think you can kill inflation. Theoretically, it's possible. Politically, impossible.
It might make sense, instead of paying off my 30-year mortgage early, buying Bitcoin instead, and thereby performing a speculative attack on the currency. A lot of Bitcoiners are against debt, though.
At a certain point, governments will turn around and say, you can't borrow to buy Bitcoin. If you hold Bitcoin, you can't borrow. You can't have everybody win at the casino. If everybody wins at the casino goes out of business.
It's a trade-off. It's a trade-off, right?
And it's a bad trade-off. We don't have to go to the world where everybody's using their own node on-chain for all transactions in order for us to kill inflation. And that's what matters for me.
A lot of people today make it seem like Bitcoin is the end, but is Bitcoin just one of the means to the end? All right, Saif, first thing, good to see you. Thanks for joining me for this conversation. I'm excited to have it.
My pleasure. Thank you for having me.
There are millions of people who have read your books. Of course, myself, one of them. Michael Saylor, famously, of course, one of them. And there's millions of people that are investing who did what they were seemingly told to do with their money. Worked hard, saved money, bought a house, invested in stocks, the retirement account, all of those things. But somehow they still feel like they're falling behind, and they don't understand why. So give us an understanding of what's going on with their money that's causing them to look like they're winning, but they're not.
Yeah, I think the basic problem ultimately comes down to the fact that fiat money just loses value over time. You're constantly declining in the purchasing power. And so you are essentially having to run to stay where you are. You're running on